morning and thanks so much for tuning in to India Market Open, the day after the NDTV Profit conclave. And well, there are two things that, actually there are multiple things to be honest, and we'll talk about the Indian markets in moments from now. But Alex, the two interesting bits that stood out for me, and I'm hoping we'll talk to somebody about it as well, is one, that the resolution to the Ukraine war, the first leg of it seems to be without Ukraine or Europe on board. and despite the talks of resolution, gold is doing what it does best in 2025.
No doubt. And because there are two things that you are completely uncertain about at this juncture, no matter where you're sitting in the globe, and that is geopolitics and Trump tariffs. You don't know what is going to happen on an ongoing basis. And in fact, that is exactly what Wall Street is focused on. Of course, later today, there's going to be the minutes of the Fed's meeting. We'll talk about that in just a bit. Wall Street registered narrow gains, Neeraj, yesterday, but it was in fact a record high for the S&P 500. They've edged past that previous record, but ended only about 0.2% in the green. The earnings patchwork so far, with nearly all of the companies reporting numbers for the quarter ended December, is looking reasonably good for the US stocks. So that's certainly something that has aided sentiment there. The minutes of the last Fed meeting are out later today, as you know, and the rationale for the pause in the rate cut and also the course forward will be eyed very closely. The recent data, of course, points to price growth momentum, lower consumer sentiment, and also in the most recent data point, you had retail sales that were weaker than expected. So all of that might be contextualized by what is contained in the Fed minutes. Asian markets have opened mixed. The Chinese onshore markets are trading in the green, but the rest are trading a little bit soft at this juncture. Geopolitics and Trump tariffs, as I said at the start today, remain the big developments to watch. Trump's administration said it agreed to hold more talks with Russia, and in fact, Trump administration and Russia had a 4.5 meeting in Riyadh. The high-level teams are said to be appointed to work towards a Russia-Ukraine war resolution. And interestingly, as Neeraj pointed out, Ukrainian President Zelensky was not invited to the talks. Trump said post that meeting that he would meet with Putin before the end of February, and he's also brushed aside the concerns that were raised by Ukraine at being left out, saying that they should have joined earlier, Neeraj.
Yeah, well, you know, it's just, I mean, one certainly hopes that one way or the other this comes to an end, because it's just humanitarian purposes, it's great. But yeah, I think the first leg has turned out to be interesting. But as you said, the two uncertain things, one is what happens to geopolitics and one is what happens to tariffs.
Tariffs, yeah, and tariffs in fact is the second talking point if we're talking about the global setup today. And the fact that US President Donald Trump said that he intends to impose tariffs on auto as well as pharmaceuticals and semiconductor chips in the neighborhood of 25%. Listen into what he had to say.
We're going to be announcing some very, very big, momentous decisions are being made by companies all around the world, the biggest, and they want to come back into the U.S. Car plants are being canceled in other locations now because they want to build them here. I think it's a very important thing, and you'll be seeing this over the next, probably over the next 2 years, to be honest, but you're going to see a lot of it over the next couple of weeks. A lot of big ones are going to be announcing.
Mr. President, have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%.
What about semiconductors and pharmaceuticals?
It'll be 25% and higher, and it'll go very substantially higher over a course of a year. But we want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariff.
Now, these would be interesting times for sure. But with the announcement of these reciprocal tariffs by Donald Trump, there is ongoing discussion about how the Indian economy will tackle this challenge. Union Minister of Commerce and Industry, Piyush Goyal, spoke at the NDTV Profit conclave, assuring that there is no need to worry. He believes that India and the US can provide mutual benefits to each other. Listen in.
Our situation with America is pretty much different than many other countries. And therefore, as I said earlier, we complement each other. We can give mutual concessions to each other, tariff reductions, make it easier to import and export both between the two countries. We've already taken a significant number of measures to strengthen the US-India relationship. We have both strategic, bilateral, multilateral engagements. We have defense ties. We have strong ties in education and people-to-people ties. So together, we are working on several initiatives. Trade will supplement our efforts to do much greater good for the people of US and India.
Okay. By the way, that entire chat is available on social media. We will play it through the day as well. There's a lot that was spoken about by the Union Minister, including his definition of what Viksit Bharat means. But let's talk about what happened in trade yesterday. You had foreign institution buying, but put an asterisk against that number, because if it wasn't for the Bharti Airtel block deal, it would once again have been a negative number or net sell number. Domestic institutions buying to the extent of about 3,072 crore rupees. We will talk about that Bharti Airtel block in just a bit, because the fine print has emerged. The benchmark indices recovered from the day's low to end largely unchanged, and the broader markets continued to witness heavy selling, particularly towards the broadest end of the market. The Nifty 50 once again found support at 22,800. In fact, just above that mark was the low point of the day yesterday, and it recovered quite smartly from that point. The mid-cap index has ended about 0.2% lower, and the small-cap index ended with cuts of about 1.4%. The Nifty 50 and the Nifty Bank recovered by similar amounts from the day's low, about 0.6% or thereabouts. HDFC Bank, NTPC, as well as Infi and Kotak Mahindra Bank provided support, whereas ICICI Bank, Mahindra and Mahindra, TCS, ITC and HUL led the declines in terms of contribution. Consumer durables, auto and FMCG stocks saw the most selling, and IT stocks stood out as the winners. The Nifty IT gaining as much as 1% in trade, but TCS was an outlier, losing about 0.8%, while the other IT stocks, particularly Persistent Systems, gaining quite smartly in trade yesterday. Market breadth once again tilted in favor of the declines, and the biggest losers from the broader markets, you'll see a few names here: PTC Industries, ZF Commercial, All Cargo Logistics, Carborundum. In fact, if we had pulled up the declines, they were quite substantial, and that is in fact par for the course. A few gainers, you had NLC India, Adani Wilmar, GSK Pharma, Thermax and Schaeffler India. Neeraj.
Yeah, I think the thing that stood out, by the way, so just before we get to the trade setup, there are some positives around, right? I mean, just in terms of overall flow. So Bloomberg is carrying this story that iPhone parts maker Murata is eyeing a supply chain shift towards India. There is also the frontline piece out there which says that Tesla is hiring in India, signaling that it plans to enter the market. So these are some, in an otherwise dull scenario, some really good news that are happening around India, so which is a good thing. But I think you also got to take into account the fact that this week the Nifty shown that it is respecting the January low of 22,830. Now this week, the last 2 days, the index has kind of respected that. From Jan 27th, it is now the fourth time that the Nifty was hovering in and around or below that mark, only to recover. So which is actually a really good thing. The broader market correction continues, but I think, Alex, swapping becomes a great option for investors. And just take 30 seconds out here. Hiren Ved spoke about this very eloquently in our erstwhile series Alpha Moguls about this, that if you have a stock which is down 20-25%, and you always wanted to buy another stock, but you couldn't buy it because it was very expensive, and if you know that business well, of course, and if that due to the market correction is also down 25%, there's no harm in swapping if you believe that B is better than the A in your portfolio. So book this loss. It's okay.
Yeah.
You can actually harvest loss, if you will.
For 8 financial years.
8 financial years, and get the stock that you always wanted to buy, but you couldn't buy because it was expensive. And I think this is a great way to realign your portfolio in the current times when the market is giving you the opportunity, because stocks aren't running away. You can take your time, research well, and then actually align your portfolio to what will do well in the next coming days, weeks, months and years.
And interestingly, Neeraj, I think this is what a lot of people were clamoring for over the last several years.
Correction kyun nahi aa raha?
Kyun nahi aa raha? And finally, when it's come, people are like, "Aur kitna girega?"
Yeah, so I think this is a great time for even swapping, even if you don't have excess cash, it might be a good way to do it. And I think viewers just keep in mind, I think the return to quality is looking very, very high because there will be expected selling at every rally. This market has become a sell on rally market for sure. Even if the market were to recover, you will see at the first port of resistance, there will be selling that will come in. So therefore, you would want to stay in high quality names now simply because they will absorb the selling a lot better. And I just want to make one small point. The FI number will be high yesterday, but that's a misnomer because of the Bharti Airtel bulk deal. Now, as a result of this, the FI buy number will look very, very large, but FIs haven't come back to India. It seems very certain that even today we'll see a sell number because the market doesn't have any triggers as of at the current point of time. But yesterday's FI buy number is because of the Airtel bulk deal.
Yeah, which is why it had an asterisk at the side of it. Let's talk about a few stocks. And so, Neeraj, earnings season done with, and so therefore it's a little patchy in terms of what you find, but there's still some interesting talking points that you have, right? Bharti Airtel certainly is one of the interesting talking points because the buyers are clear now.
Yeah, most certainly. Okay, so maybe just briefly talk about that before we talk
and
about
the trade setup. No, we should talk about trade setup.
Yeah, the only reason why it is interesting, Alex, is that GQG is kind of making its presence felt in Bharti now for the second time, if I'm not wrong. And it clearly shows that they have a penchant for Indian telecom, right? They like infrastructure per se, a penchant for Indian telecom because they were large buyers in Vodafone as well before I think they kind of got out of it. But Airtel second time presence, and there are a clutch of people who come out and said that telecom is amongst the sectors that they firmly believe will do well in the times to come. So it'll be interesting to see if Airtel kind of the promoter selling doesn't kind of mark the peak, if you will. The smart investors who've come in, the list is interesting as well. So could be a stock to focus on in the next few days and weeks.
In trade today, you reckon caution is par for the course?
Yeah, I would reckon, Alex. I mean, as of now, there's no reason to believe otherwise. The only good part is, as we said, that the Nifty, the benchmark Nifty is respecting 22,830. So that is great, but small caps, Alex, just getting me taken to the cleaners.
He's getting beaten up. Let's pull up the stocks and let's discuss the stocks that we've picked. I have picked 3, and the first one that I want to talk about is Bharti Airtel. Incidentally, just a little bit of a red tick expected at the start today. That's the implied open on your screen. But I've picked Bharti Airtel because, as Neeraj was just pointing out, some interesting facts emerging from the buyers list. You have GQG entities that have bought about 3,181 crore in the block deal that got conducted yesterday. The total value of the block deal stood at around 8,485 crore rupees, and the price that it took place at was at 1,660, which is not too far away from the current market price. FII participation, according to some estimates, is anywhere between 5,200 to 5,500 crore, and that's a sizable participation, which explains, of course, the number or the buy number for foreign institutional investors as a whole. Is this a significant positive? Does this change anything materially? Well, you could argue no, but then it indicates from a very large investor that has invested at strategic intervals in some very prominent names that this is a vote of confidence from this institutional investor, and it's a very large one at that, GQG. So therefore, if you are holding Bharti Airtel, this is another reason why your thesis is being supported. Let's talk about the next stock, and that is Punjab National Bank. It is not a very material development, but it is a little concerning only because of the history of this bank when it comes to fraud. You have reports of a 271 crore in an NP account of Gupta Power, Bhubaneswar, and provisions to that extent have been made. That entire amount has been provided for as per prudential norms. This is a disclosure that came through a while back. Maybe, particularly because PSU banks in trade yesterday were a little weak, you could expect a little bit of pressure on the downside. The last stock is RVNL, and I guess to a certain extent this 554 crore order from Rail Infrastructure Development is par for the course. It's for a period of 2 years. see it in the context of what the company intends to achieve in the current financial year. It's expecting an order inflow of 20,000 to 25,000 crore and to maintain its order book at 1,00,000 crore. So in that larger scheme of things, it's not very significant, but the stock has gotten battered in the recent past. It is down about 22% over the course of the last month. So maybe this might be a positive.
Could be interesting. Let's wait and watch for these. We'll talk about Hexaware Tech in detail as well, I'm sure, but it's a new listing today. I'm taking that as the first stock, not relevant for 9:15, but certainly for 10. It was large IPO, subscribed about 2.66 times. JM Financial, JM Financial says that they have a buy rating with a target price of 820. They estimate about 20% EPS CAGR growth from calendar year 23 till 26, right, in some sense. So for the next 2 years, which is current year 25 and 26 as well, they expect 20% growth. So could be interesting to see how Hexaware lists today and the post issue, considering that IT itself will be under a bit of a cloud because of Capgemini's commentary. So keep that in mind. So Hexaware, the first stock on my list. Piramal Pharma is the other one. And I know we'll talk about pharma in detail, but US FDA has issued a Form 483 with 6 observations to curb the company's Turbhe facility. So that could be interesting. In fact, Varsha is joining us in moments from now. Before her piece, we'll ask her about Piramal as well, if we can. And battery energy storage companies, call them BESS companies, but effectively the likes of Exide, Amara Raja, JSW Energy, etc. Because the government has recommended setting up of 2-hour co-located energy storage systems in future solar tenders. All solar tenders will need to have this. That's that recommendation as of now. But the estimates say that this would lead to about 14 to 28 gigawatt per hour of storage, which can be set up until 2030. So this could be very, very interesting. Top 3 on my list. I don't know if really Exide or some of the others react dramatically, Alex, but yeah, interesting things. I mean, the sound bites around power capacity creation continue to be very, very strong.
But you want to talk about Piramal Pharma, didn't you?
Yeah, I thought
and since you got Varsha standing right here,
let's ask her. Should we?
Let's ask her. Is this a significant development, Varsha? Is this a big negative?
Well, yes, 6 observation is certainly not a good thing, but one, we need to consider that this doesn't relate to any data integrity issue, so that's a relief. But yeah, stock will be under pressure because 6 observation, we need to mail to US FDA what these observations are and what is the regarding the revenue contribution for Turbhe facilities. So pharma companies normally don't give the contribution to the revenue, but yeah, company will be under pressure, and we all know the tariff, because of the tariff that Trump has decided, pharma stocks will be under pressure. Yeah.
No doubt. In fact, that's what we want to talk to you about this morning. That was just a trick question to set you up, Varsha, because the entire pack is going to be under a little bit of pressure because of that announcement, right? And I like the headline that you've chosen, that the Trump flu is catching for the pharma companies here. How significant are these expectations, though?
Yeah, for the headline, I would thank to the producers, though, Alex. But we all know that Trump has hinted at imposing 25% tariff on import of pharmaceutical. The full announcement will be made on 2nd of April, but the duties will start at 25%. Now, this may go upwards of 25% over the course of year. But if I were to talk about some data metrics, so Indian pharmaceutical companies supply 60% of generic drug volume to the US, and there was this research done, 10% tariff could reduce Indian pharma companies' EPS from 1 to 6%. Now this is according to HSBC. The bigger concern is the long-term impact on growth, as US is the major growth market when it comes to Indian pharmaceutical companies, and company might shift production to US-based plants to lessen the tariff impact. But if I were to talk about the revenue contribution of few of the companies, then if you see the Aurobindo Pharma, which has 46% of contribution from US, Cipla has 28%, Lupin 37%, Dr. Reddy's 46%, and Torrent Pharmaceuticals 10%. So not major impact for Torrent Pharmaceuticals, but yeah, Aurobindo, then Dr. Reddy's, a huge chunk of business comes from US. Just a back calculation, impact of 10% of tariff. Let's see how it impacts the pharma company's EPS. So if you see Aurobindo Pharma, the impact would be around 5.5%, while Cipla will have 4% of impact on EPS. Dr. Reddy's almost 7%, Lupin 4.5%, Sun Pharma 1%, not major impact, and Torrent Pharma 0.8%, while Zydus Life Sciences will have 6% of impact on EPS.
Okay. So, Varsha, just to simplify this, quick 10 seconds, which is the one that will get impacted the most?
You have Zydus Life Sciences and Aurobindo.
Negatively?
Yeah.
Perfect. Okay, watch out for Zydus and Aurobindo. And viewers, what we will do is we'll try and talk to our guest who will join in today a bit later on in the show about how do they see this impact and what should the resultant view on the stocks be. So keep that in mind. By the way, speaking of pharmaceuticals, Chairman, founder of Wockhardt, Habil Khurakiwala, said that the reciprocal tariffs by the US would not hurt the Indian industry. Here's why.
Basically, to make a change in formulation, for example, takes roughly 3 to 5 years. So from that context, there is, unlike steel or cement, you can switch suppliers at a day's notice. You can't do this in our industry. So the view I have is short term. Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected. Okay. But long term, one doesn't know what happens after 3 to 5 years.
Yeah. Difficult to call this really, but for now, our assessment seems to suggest that there are a couple of companies at the very least who will get impacted, and there are a few others which will also might get impacted. So do watch out. Not everything will be rosy in the healthcare sector, but it certainly seems to be a sector which will probably be the least impacted, I would reckon, simply because the US wants healthcare costs to come low. They are looking at China plus one. There are not too many other avenues out there. So, and of course, India has been a preferred supplier for a number of years. So that somehow makes me believe that blows, if any, at least in the pharma sector, could be cushioned. The question is, will there be blows in the IT sector, and can those be cushioned? And independent of that, the commentary coming from global majors may not really spur the street higher, right? Because Capgemini announced their calendar year 24 results. More importantly, they also spoke about what is the outlook for calendar year 25. And Rucha, would the results be more important for what IT does today, or would it be Capgemini's outlook?
So, of course, the outlook is more important for the Indian IT companies. But let me talk to you about Capgemini's results in just one line. Results were good, or more than consensus, and at the top end of the guidance range. But what is more important, as I mentioned, is the 2025 guidance. The company has given a guidance of -2% to +2% for its constant currency revenue growth, and operating margin guidance at 13.3% to 13.5%. Now, what does CLSA believe would be the impact on Indian IT because of this kind of outlook? Well, the guidance definitely implies more uncertainty because it is a negative kind of growth on the bottom end is what they are looking forward to. But they believe that this is more specific to Capgemini than indicating an overall trend. This is because Capgemini has more exposure to France, EU, UK, and especially the manufacturing vertical across countries. Therefore, CLSA reiterates its optimistic stance on the Indian IT companies as they believe that discretionary demand is improving in the US, especially in the banking and in the retail space. So cautiously optimistic is what we have been hearing from many analysts across the street over a couple of quarters. We have Citi also, which believes that, of course, the results were better than expected, but the CY25 outlook actually reflects disciplined execution amidst the caution on challenged end markets. So this is a very heavy term which Citi is using over here, but what they believe is, though the near-term market could be cautious, they believe that overall the trend are expected to set better, and they very clearly pointed out that this kind of guidance actually reflects the start of their conservatism that the management has rather than implying an overall trend, and this comes because 2024 was softer than expected. So it's better to be cautious than giving a guidance which the company might not be able to fulfill. Lastly, let's talk about what Infosys has guided for FY25, revenue growth of 4.5% to 5% in terms of constant currency, and HCL Technologies has guided for 4.5% to 5% in a similar range of what Infosys has guided for. So overall, positive view on Indian IT sector, and the kind of soft growth that Capgemini expects in 2025 is just specific to that company itself.
Okay, thanks so much for that. And so IT, as we pointed out at the start, by the way, was the bright spot yesterday. Let's see if that continues to be the case based on what Rucha has just told you. It gained about 1% or so. But, well, we've been talking in the recent past about QSRs as well. They've been certainly a talking point, at least between Neeraj and me, because Neeraj never eats out. He's always a very healthy eater, and so therefore he's the worst person to ask about demand trends for QSR, no, Neeraj?
Yeah, I mean, QSRs, I do eat out, but QSRs, yeah, certainly so. The dal khichdi is a preferred option.
All right, but let's find out what the other people out there that are looking at this from a different lens have to say. And we've got Mahima joining in to tell you about just that. Mahima, quite a few notes coming through.
Right, Alex. So, Citi and Goldman Sachs both have come out with their views as to how QSRs have performed this quarter. Yesterday, there was also a Morgan Stanley note. I'll start with the Citi note. What they're saying is that the near-term earnings will likely remain volatile for the entire space. They expect QSR to be the biggest beneficiary of the uptick in consumer discretionary spending. And companies in their con calls have also highlighted that consumer demand continues to remain weak as of now, and Jubilant remains their preferred pick. The two companies that they're talking about in the report include Devyani International. They're saying that acceleration in store expansion for KFC is something that will lead to higher revenue growth as well as margin expansion, and their ability to successfully scale up new brands can also further accelerate growth. For Jubilant, they're saying that it's taking multiple initiatives to kind of drive the industry leading performance, and they believe that this company should continue to outperform peers in terms of like-for-like growth, and average daily spend improvement is also the reason that will lead to margin expansion going forward. Goldman Sachs has a slightly different view. What they're saying is that QSR players are now gaining share within the food delivery market. What they're saying is that the growth gap between QSR sales and aggregators like Zomato and Swiggy, the gross order value has been narrowing. In the delivery channel, QSR players have gained market share in Q3 FY25. For dine-in, there seems to be a recovery, and this is positive for the entire space. They also said that the improved affordability and value initiatives will continue to drive the overall same-store sales growth, and they believe that value initiatives will continue to drive the order-led recovery. FY26, they're saying that QSR companies have a favorable base in FY26 as they lap in the impact of geopolitical issues, and they believe that Q3 was the beginning of this cyclical upturn for the QSR space, and tax cuts will act as a further catalyst. Lastly, they're saying that they prefer Sapphire and Devyani as they like this space from a longer term structural opportunity, and they also like Westlife given the company has bought back the focus in terms of value. So this is the overall view as to what Citi and Goldman Sachs is making of the entire QSR space.
Got it. Thanks, Mahima, for getting us those details. Now, just quickly, let's pull up the implied open. Don't be surprised if there's a pretty much sideways movement for the benchmarks. What you have to watch out for is individual names in the broader markets, and we've brought you a few stocks. We'll be talking about a lot more after this very quick break. Do stay with us.
Entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now right, back with India Market Open right here on NDTV Profit. We've gotten some ideas already, but it's good time to get in Chandan Taparia. He's Head of Technical and Derivatives Research at Motilal Oswal. Johnson on the show. Chandan, good having you. Thanks for joining in. Chandan, twice in the last 2 days, the January low has been respected by the Nifty. Do you think that's a positive sign? And does that in any way give comfort for the broader markets as well, or that is entirely different?
Good morning. Thanks for having me, and congrats for a fantastic event.
Thank you.
And really appreciate wholeheartedly, and we enjoyed and learned a lot about the Indian equity market. And the key buzz was that we need to have patience, and I think that is the buzzword we need to utilize now at this time when index is corrected by around 12 to 13% from its lifetime high of 26,277. Looking at the shorter term picture, earlier also the Nifty made low near 22,786. This time also it formed the bottom near 22,725. So we have taken support, but the important part is follow-up buying is required in Indian market. FIs are continuously selling. They sold to the tune of around 3 lakh crore in last 4 months. But at the same time, DIs are buying. So follow-up is required. We are getting a couple of signs which might indicate for oversold scenario, but follow-up is required. Mechanical indicators are giving the bullish divergence. FI's long-short ratio are at lower level. So I believe 22,700 or 22,660 needs to be respected in this market scenario. And if it manages to hold 23,000, 23,150, then I think short-term bottom could be placed for a bounce towards 23,333, 23,500. So getting an early sign, but requires a follow-up activity to get some stability beyond 23,000, 23,150 marks in the index.
Chandan, hi, good morning. And incidentally, Sudeep also has a buy on one of the stocks that you are mentioning, Bajaj Finance. Why don't you talk to us about what the thesis is here and also the second stock you've chosen?
Yeah, thanks, Alex. I think most of analysts like me, Sudeep, Mayuresh are looking for the relative strength, trying to find out the counter which is holding well even after the market decline. And I think we are recommending Bajaj Finance from last couple of weeks, and the stock is really doing well. In this market scenario, the important part is that we should generate the alpha. If market declines, for sure, most of the counter will decline. But we try to find out the counter which has resilience and has some potential upside with margin of safety. And I think that is the reason that selected to go long on Bajaj Finance. Major trend of the counter is positive. And somehow the entire thesis of the India, which has changed from capex to consumption, selective financial heavyweights could do well. So Bajaj Finance technically has formed a bullish price pattern similar to Poland flag, has been making higher top, higher bottom. In fact, on the lower time frame, symmetrical triangle formation is also visible. So recommending to buy with support of 80 to 50. And here we have a target towards 88 in Bajaj Finance.
And the second one is Tech Mahindra, right? This is a stock that was in focus yesterday. Of course, Persistent was the top gainer, if I remember correctly, on the IT index, but Tech Mahindra was not too far behind. What is the thesis here?
Yeah, so Tech Mahindra has been consolidating in a range from last almost 30 trading sessions. The good part is that Nifty IT has not corrected much compared to market decline. Falling rupee is also supporting the sentiment in selective IT name. And Tech Mahindra has taken multiple support near 1605 to 1630 zone, holding well above key moving averages, surpass a falling supply trend line. So all these factors are giving a positive stance in the counter. One can buy with support of 1665 for an upside target towards 1770, 1775 months.
Okay. Well, certainly some stuff to watch out for. Now, Mayuresh, there are some things that we picked up. So one of the things, of course, one of the key focus areas today is Pharma. The other is some chemical companies in which there has been some interesting activity. So we picked out Deepak Nitrite as one of the names simply because it's got beaten down out of shape after a very forgetful quarter, if you will. But it's come out of the FNO ban, and the promoters have bought about 30,000 shares on Feb 17th, which is day before yesterday, the details of which came out yesterday. Fundamentally, what do you think of this one?
I think we'll like to wait one more quarter, Neeraj, honestly, I think, because the numbers have been really soft, and how the spreads are going to play out is going to be very, very interesting in the next few weeks, and specifically as we head into Q4. Obviously, the expectations in terms of demand coming back for its core portfolio as we head into the first half of the next financial year looks like a base case scenario. But two things. One, I think pricing related to the core portfolio. And second, I think in terms of the inventory levels as well, not just locally, but globally as well. How do they stack up in terms of futuristic growth estimates is something to be watched out for. So at least at this juncture, Neeraj, I think we'll just wait and watch and see how Q4 plays out for the public.
Okay, point well noted. The other thing, like we said, is pharmaceuticals, right? And pharma is in the thick of things. I wonder if the initial ticks on some of the names are already weak. Sun Pharma may start off lower. For now, it's just 2 minutes, but watch out. Aurobindo, Zydus are amongst the names that should be watched out for because they perceptibly have a much larger exposure and they are looking like starting off weak, viewers. So please keep these stocks in mind. Certainly, pharma is the bucket to focus on. Sudeep, I'd like to come to you. Pure play pharma companies, and I'm distinguishing here, right? I'm not asking for views on a Syngene, Laurus, Divi's. They are CDMO. I'm not asking for views on the hospital companies or the diagnostic companies. I'm asking for the large US exposed pharma companies. So Sun, Cipla, Aurobindo, Lupin. That's the set of companies that I'm talking about, Sudeep. If they start off lower today, is there a trade out there on the short side? Do the charts anyways look weak, or is it difficult to say?
Neeraj, if you closely observe all these pharma names, whether we say Sun Pharma, Cipla, Oro Pharma, so out of these 3-4 names, I feel Oro Pharma and Sun Pharma do look as if they are giving a consolidation breakdown, and Sun Pharma, in any case, has already given a breakdown yesterday. Oro Pharma was trying to rebound and take support around 1120, 1130 mark. But in case it slips below 1110, 1115 zone, which was the prior support, there could be a case for a short trade also for 5 to 6% on the downside. The only stock which looks up relatively better on charts in terms of relative strength would be Cipla. So here I feel it is important that 1440, 1430 level gets breached, and that gets decisively breached before we think about going short on this counter. So my sense would be that, okay, if Sun Pharma and Oro are opening weaker and we are seeing any follow-up action, those are the counters that one can keep on their radar for shorting. But Cipla, if it holds 1435, 1440 level and it's not showing signs of buckling down under pressure, then yes, this could be a case for a buy on dips, or at least not going short.
Okay. Now, one more aspect that we want to discuss, it's in focus today, in news today, is energy storage companies. Now, the Ministry of Power, in a recommendation, if not a notification, has said that energy storage systems would be the key to ensure grid stability. India is targeting, of course, non-fossil fuel contribution at 500 gigawatts by 2030. And while capacity of solar and wind projects are there coming up, they will be enhanced significantly by energy storage systems for grid stability. So therefore, what is being proposed or contemplated is a mandatory clause of a 2-hour storage in all renewable energy tenders here on. All states and renewable implementing agencies will incorporate this 2-hour clause going ahead, and the estimate is that this will lead to 14 to 28 gigawatt per hour of this energy storage capacity being set up. Now, Mayuresh Joshi, our understanding is that this makes companies like JSW Energy, Exide, Amara Raja, Adani Green, or and Tata Power come into focus because all of these have some or the other plans. Have you looked at this? Do you have any concrete thoughts here?
So Neeraj, surprisingly, I think we've met a few companies in a few conferences which are going on. And a few companies do look good. So I think for obvious compliance reasons, I wouldn't be able to name them right now. But obviously as a space, I think the key takeaways that we found out were that this is one space where the government focuses, as you just mentioned. The second element is obviously, I think, as this space evolves, there is going to be incremental demand surrounding this space as well. So I think when you're probably looking at the entire battery storage components, there are a lot of parts which probably come into play. there are a lot of EPC players that come into play here as well. And there obviously is an element in terms of the offtake that is probably expected to take place when you're probably hitting your non-peak load hours. So I think when you're probably into your peak load hours, you probably need to have that evacuation mechanisms and systems and processes in place. And therefore, the target setting that the government probably has at this juncture will mean that a few players within this entire ecosystem will definitely remain in focus over the next few years. Obviously, I think JSW Energy has a significant component of additions that they're probably doing in terms of their battery storage. If I'm not mistaken, they're expected to have capacities to the extent of 40 gigawatt hours as we head into the next few years. And they're expanding those capacities with sheer incremental demand in the notifications which are coming through. So very, very interesting space, Neeraj. I think this is one space, along with the FGD equipment players, which is the flue gas desulfurization. Might actually do well.
Okay. Mayuresh, I'm delaying our regular big brokerage call because I want to ask you a follow-up on this. And while we've spoken about battery storage, the other aspect that we have to speak about is smart grid, right? Because ultimately, if you have higher renewable energy capacity and generation, you would need, as you pointed out, that evacuation becomes very critical. So are there any plays here?
So there are a few places, Alex. And again, I think when you're probably talking about the entire chain, right? I think the entire chain in terms of expectations of not just evacuating power, you've also got EPC players that will come into focus. You've obviously got your transformer players, which will come into focus as well. Your transmission line players, which will come into focus as well, the players who are probably having monopoles in place. And therefore, I think this ecosystem becomes extremely important. The FGD component that I was talking about is also a very important integral component because what you've got in terms of a market size is almost 1 lakh crore out there. You need the existing polluting thermal plants to probably ensure that this equipment is in place over the next year and a half, 2 years. And there are 90,000 crores worth of orders which are still expected to come out, and only 2 or 3 players. So if I name those players, I think BHEL is one of the biggest players within this space. You've got Techno Electric as the other player as well. When you're talking about grid stability, you're also probably talking about ensuring that the ecosystem surrounding this and the end use in terms of the smart meter usage as well also comes into play. And therefore, a player like Techno Electric probably should be on your watch list, both in terms of the FGD equipment that they probably have, the smart metering that they're probably doing, and the data center components that they probably also have.
Good. Comprehensive view there. We've delayed this conversation, but let's go straight to it. There's a brokerage call. The big brokerage call of the day is a CLSA upgrade on Tata Motors. It is on the watch list on account of that. They've upgraded to a high conviction outperform from outperform earlier. Harsh is joining in to tell you about the rationale and also the upside potential. Harsh?
Well, yeah, target price being 930, Alex. So very solid upside from here. They believe stock is down 40% odd because of weak demand outlook, JLR especially across key markets. Also, the other piece is with regard to tariffs, keeping a likely lid with regard to expectations. But JLR now, CLSA highlights, is trading at 1.2 times FY27 EV EBITDA, which is way below its 2.5 times normative multiple. And they believe that the implied value of JLR currently within the Tata Motors stock price is 200 rupees per share. So that's the attributable value to JLR. But they're building for a volume of 4% from FY25 to 27, an EBIT margin of 8.8%. If this were to play out, they're giving this a target, JLR, a target price of 450 rupees. So the JLR component in every share of Tata Motors is actually worth 450 is what they're saying. Therefore, giving it a very, very good cushion to the overall Tata Motors stock. They're building in a 5% decline in MHCV segment for FY26, but they believe that cyclical revival will aid the segment in FY27. The key concern in past cycles and down cycles, especially for JLR, has been the debt. Earlier in past cycles at 3 to 4 billion. Currently, this is what is markedly different, is what they're highlighting. It's at sub $1 billion FY25 at the end of FY25. That's the expectation that they're penciling in. And therefore, they believe that a higher target price warranted. Things to monitor though: monthly retail, both demand as well as discounting, especially for JLR in key markets, tariff implementation and the impact of that, China grabbing any market share in the OEM market, and the MHCV segment domestic. Those are some of the levers you'll want to look out for, which may indicate where the stock goes.
Okay, thanks Harsh. Thanks so much for that. Chandan, I want to come to you very quickly. About a minute you have to answer this. Tata Motors or any one of the other OEMs, Maruti, Suzuki, M&M, anything looks interesting to you?
So as of now, I'll focus on Maruti, a positive price pattern after the corrective move of last couple of days. It has seen a correction from 13,400 to 12,600 and bottoming out. I believe some buying interest could emerge here. With support of 12,450, Maruti has potential to extend the recent momentum towards 13,300 marks.
Sudeep, any comments about the wider auto plays here? Are any auto anchors perhaps on your radar?
Alex, if you see all these auto anchors, if you lot of them have corrected over 30, 35, 40% in the last several weeks, and there is no positive price action happening anywhere, or no signs of any credible reversal. So we are, as of now, we are only sticking to few stocks such as Maruti or just a couple of them in this auto space from the large cap space. But yes, no mid caps or no auto anchors as of now that we are focusing on because of the sheer negative momentum that the stocks are displaying.
Okay, so could it be pharma, could it be some other, could it be autos, which would be the top calls of the day? Chandan, maybe a 25-second answer. Now that you've seen the pre-open rates, your top call.
I'll go with Bajaj Finance, expecting 2 to 3% movement in the counter, and already given a targets towards 88 on 1 or 2 day point of view.
Okay. Chandan, thank you for that. Sudeep, can I just ask you, maybe you answered, but quick 20-second view, your top call for the day.
I feel HDFC Bank, which is my second call apart from Bajaj Finance, so that could do well.
Okay, so we between Sudeep and Chandan, we've covered two big financial names. Suddenly, everybody is now realizing the importance of large cap financials. If they are there in your portfolio, even if it's not gaining, the portfolio is not falling too badly, which is actually a great sign too. But Bajaj Finance, watch out for that one, as also HDFC Bank. The markets though start off weak, yet again near that 22,830 mark. Now today, viewers, would be the third day when the market is testing this mark. Let's see if it recovers. Banks are down. IT, I reckon, would also be looking wobbly. This is banks, of course. IT about 1/3%, not that bad. Capgemini is not disrupting the party so much. Mid caps and small caps in the red, I would reckon, by a margin. 1% for the mid cap space, small caps, 1% again. Let's get the heat map up on the screen. It's almost getting tiring watching the small caps getting beaten on the way they are. A lot of red, Dr. Reddy's, Cipla, Adani Enterprises, Sun Pharma, Adani Ports, M&M, Power Grid. So clearly the US exposed businesses, which is pharmaceuticals and M&M to an extent, maybe Tesla entry. Tesla is hiring in India is the headline by global websites, and that is impacting Mahindra and Mahindra. Interestingly, the Adani twins also are deep in the red on open, 2.5% lower for that one. Apollo Hospitals, Trent and BPCL, the others. On the gaining side, not too much, unfortunately. Alex, I'll hand it over to you because there is virtually not much to talk about. Interestingly, Alex, the index is just down 0.5%, but it's a sea of red on the large cap space.
Yeah, and I wouldn't be too surprised if this same texture is what you're going to be able to see in the broader end as well, particularly because of the downtick you're seeing at the benchmark level. Of course, that will settle down in just a bit. But let's also take a look at the sectoral picture. Yesterday, remember, you had IT that stood out as a gainer, but I would reckon it's not going to be that simple today. In fact, all of the sectors in the red at this juncture. The biggest loss, understandably, in the pharma space right here, down about 2.8%. And we were talking about it potentially being a day for pharma. Well, it has turned out to be true, at least at the first tick on your screen. Let's talk about individual stocks though, and let's see if there is an implication. There hasn't been in the recent past, I must point out. Any major positive news, of course, is getting reacted to, but this is not very significant. Trill has gotten an order we spoke about, this is up about 1.3% or thereabouts. The order to the extent of 166 crore rupees. The one on my radar was RVNL, only because it has gotten beaten down quite substantially in the recent past. It's making a bit of a comeback. There you go. It's an order of 554 crore rupees, not very large in the larger scheme of things, but it's certainly looked at positively for this particular counter. Mahindra Lifespace Developers from the real estate pack. Again, this is a pack that has gotten beaten down the recent past. This is a project that was announced, 1,650 crore or thereabouts, and it is in Mumbai, which is a key market. Let's see how that pans out for the company. Right now, it is gaining about 0.4% or so. Tata Motors was flat at the start. Let's see if anything has changed. It is up and about right now, 0.6% or so, and that is on account of this CLSA note. Likely, it is a strong outperform that is being spoken about and considerable upside from the current market price. Right now, we just saw Harsh's summation of what they're saying. Venus Pipes, Investec is seeing a 40% upside. The stock is up about 0.9%. And remember, these are the few stocks that are gaining ground in an otherwise weak setup. So therefore, this is quite a significant reaction on the upside. Battery storage companies, we were talking about this, the note that was sent out by the Ministry of Power and the requirement for energy storage systems. So we're talking about Exide, perhaps Amara Raja, both are up and about in trade today. On the downside, you have the pharma stocks, right? Because you have Piramal Pharma, let's pull that up. It's down about 3%. Oro Pharma, both of these companies receiving observations from the US FDA. For Piramal Pharma, it is for its Turbhe facility, and for Aurobindo Pharma, it is for its Andhra Pradesh facility. But the wider pharma universe also losing ground. The likes of Sun Pharma, Lupin, Cipla. You saw this, in fact, when we pulled up the heat map for the Nifty 50. But it's not looking like it's going to be a very good day for the pharma stocks, Neeraj.
And certainly looking that way. So, well, that's the long and short of the markets. It's essentially pharmaceuticals, which is looking the worst hit today. Oro, not just the US FDA news or otherwise, but also this whole tariff piece, which might really come and hit that stock or has come and hit that stock. So bear that in mind. It's the top loser across markets is Aurobindo Pharma. So bear that in mind. Shelley Engineering, Lupin are some of the other key losers. I must say though, while the Nifty and the Sensex are doing what they're doing, the small cap 250 should come up on the screen again very quickly. This is, the first few minutes, the last few days have been very, very interesting and choppy. Today too, after starting off lower, I know the intraday will look very skewed because it's just 5 minutes, but from deep in the red, about 1% in the red, we are in the green right now for the small cap 250. That is just really, really interesting. Borosil Renewables is up 5%. Zentech, after getting hammered out of shape, is up about 4%. So, well, maybe that stock is breathing a sigh of relief. And there are a few others like Hitachi Energy, the grid system, right? Up 3.5%. So keep an eye out for that one. HPL Electric, also in this space, is up about 3-4%. So there are a few names which are certainly standing out.
The mid-cap index has also turned very substantially. We focus, of course, on small cap because it was beaten down yesterday at the start as well. But the mid-cap index also flat at this juncture.
Yeah, it's very heartening actually. But
now positive.
But this may, it actually completely got smashed out of shape after being in the green on Monday as well when it opened this way. So bear that in mind. But quick opening thoughts from our viewers. Now, Chandan, before we thank you, your opening thoughts, because the index is lagging the small caps, which is now up 0.6%. There is some serious moves happening at the broader end of the spectrum.
Right. So the good part is that market is making multiple attempts to safeguard 22,725 to 22,800 zone. Even today it made low near 22,815. So it is trying its best, but important part is to surpass the key hurdle. I believe consumption theme could be focused apart from whatever the name we have discussed. Two stocks I can discuss at the beginning. First is buy on Indigo. Second is buy on Tata Consumer. So I believe the consumption theme could do well. So talking on Indigo, the stock has seen a positive price pattern with support of 42.80 it can head towards 4600 level. Tata Consumer looks good with support of almost 1010. It can head towards 1070. As on daily chart, it has been consolidating and now at the verge of breakout. So consumption could be on focus with multiple support in the index at lower levels, and Indigo and Tata Consumer could be on focus for immediate point of view.
The gain from the low for the small cap index at this juncture, 1.9% and rising. And what a run up. I'm pretty sure that the texture has changed quite dramatically. I'm going to pull up the constituents. You currently have 194 out of the 250 stocks of the Nifty small cap index that are gaining ground and only about 49 that are losing. And if you talk about the key gainers right now, we're talking about Hitachi Energy that is standing out, gaining about 5.7%. We've been speaking about this space and Mayuresh did weigh in on that. Tata Investment looking good, Borosil Renewable, Reddington, Data Patterns, all gaining over 4%. So is Gillette, by the way, not a stock that reacts and moves very, very sharply on a daily basis, but certainly up and about today, up about 3.7% or thereabouts. A few of those losers from the broader end as well. Concord Bio not doing too much, down about 3.4%. Piramal Pharma, and we spoke about this, it has also recovered, I would think, if I'm not mistaken. It has recovered a tad bit and it is currently trading about 2.5% lower.
Yep, Chandan, Chandan, we'll let you go on that note. Of course, thanks so much for joining in today and giving us your thoughts. Really appreciate your time. Sudeep, the same question to you really. By the way, as we speak, the IT index has succumbed to some selling and is down about 1%. So that's the other end of the spectrum too. But opening thoughts from you, Sudeep.
Neeraj, I echo the same thing which you were just mentioning a couple of minutes earlier, that the last 2-3 days have been kind of interesting, wherein the selling in the small caps or the mid cap side of the market has now been mellowed down. Now, if you see even today also, first tick in the red and then gradual recovery. So the best case scenario would be that Nifty holds 22,750, 22,800 for the day, and it tries to rebound closer back to 22,900, 22,930, and the mid caps stay at the current levels, or you see a gradual recovery. So in a way, in such volatile environments only, we try to see that there's a short-term bottom formation which is happening. And I feel if both of the things which I just mentioned happens, then we could see a case for some kind of a relief rally coming over the course of the next few days.
I want to pull up the sectoral picture once again because that texture has changed since the last time we spoke, and you see more green on the screen. You have the realty index that is gaining about 1% and the metal index is up about 0.5% or thereabouts. PSU banks also gaining about 0.5% or so. Any interesting plays, Sudeep? I'm coming back to you before I go to Mayuresh in the real estate space, because this is a pack that got beaten down very heavily, and perhaps to a certain extent one would argue that they had their run towards the end of last year and they had to pay the piper, I guess.
Alex, if you see all these real estate names, whether it is Oberoi, Shobha, I feel one stock where I feel if you in the long-term scheme of things, wherein we see the chart formation over the last 24 to 36 months, then there's one stock, Macrotech Developers Lodha, which is around 1170, 1175, which is yet not corrected beyond 38% of its entire rally. So that important Fibonacci retracement number of 38% has been respected yet, and the support zone is closer to 1080 to 1100 on the downside from a quarterly perspective. So what I feel is that out of all the setups within the real estate stock, if someone has to have a look at some stock within the sector, then Macrotech Developers would be the name that I would be closely watching.
Tech developers up and about and trade 1% or so. Of course, from the longer term standpoint, Mayuresh, some arguments have been made for when the tax breaks come through next year and the rate cut that has already been announced, the potential for another 25 basis points. Does that prove to be a dual fillip for the real estate industry, which is obviously rate sensitive? So what is your pick in the residential real estate space at this juncture, and why?
Well, so Alex, 2 pointers. One, I think in terms of expectations of how much of an incremental benefit will a rate cut do. Obviously, it does help the fence sitters because anybody who's probably sitting on the fence, assuming rates to go down and getting into a mortgage to buy a property, I think it's obviously lucrative for them. But with the interest rate cycle expected to get delayed or deferred, I think a lot of these fence sitters may have a longer time in terms of having their mortgages in place. The other element in terms of the expectations of numbers delivery, I think a large part of the universe has delivered a decent set of numbers. So whether you talk about the pre-sales velocity in terms of new launches that they've probably done, the collections that they have probably garnered in the first 9 months of this financial year, and the commentary that has probably come through. Players like Macroeconomic, Oberoi, DLF have delivered a very solid set of expectations that are expected to build in over the next year at least in terms of all these parameters put together. And therefore, I think the end point in terms of how inventory levels are probably stacked up, inching a tad bit higher across spaces, across geographies as we see it. And therefore, I think with the kind of supply that is expected to come through, not just from the listed universe, but a large part of the unlisted pool as well, specifically in urban areas and tier 1, tier 2 cities as well. I think those supply dynamics, how do they play on pricing? How do they play on inventory levels? And third, in terms of expectations of deleveraging of the balance sheet, which has already played out, what are the further triggers that probably come through for the space as a whole is going to be very, very interesting because a large part of these components have already been priced and baked in to a large extent. But again, looking at relative strength, the EPSRS rating that we probably see at markets with India, I think DLF and Oberoi do stand for.
Okay, Marish, very quick 30-second answer. We're talking to an EMS company or a packaging, or we're talking to Epack Durables in the next few minutes. Just wondering, what have you made of this manufacturing space? If you have any thoughts here, very quickly, Mayuresh.
No, it's very interesting. And in fact, I think, Neeraj, if you look at the market size itself, right, the HVAC market, which is the heating, ventilator and air cooler market, which is an $8 billion market in India, is expected to be a $30 billion market in the next 5 years. So very, very interesting space. And I'll finish this in 30 seconds.
Okay, Mayuresh, thank you so much for taking the time out and being with us. Really appreciate your time. And Sudeep, much appreciate you giving us your thoughts this morning as well. We're trying to talk to companies about what's the kind of business confidence that they have, and of course, company-specific news as well. And in line with that, Mr. Ajay Singhania, who's the MD and CEO of Epack Durables, joins in. Because remember, that's a bucket that is catered to an industry which had a very strong calendar year 24. And if indeed the disposable income upticks lead to further increase in demand for durables, then it might actually have a positive impact for these companies as well. Mr. Singhania, good having you. Thanks so much for taking the time out, and namaskar to you. Just wondering, we've come to the end of quarter 3. I don't think we got a chance to talk post your numbers. Did the quarter shape up as you planned? Part 1 of my question is that. And were there some anomalies which will get corrected in the quarters to come?
Yeah, so good morning. Quarter 3 definitely shaped out much better than what we had originally anticipated. And rather the entire 2024, the way growth has been for the AC industry, I mean, it's remarkable. The industry is growing at 40% plus. At Epack, we're growing at around 75-80%. So, I mean, we are having best times to grow. And Q4 and onwards also, the order book is extremely good. Already, I mean, there's been no winter per se this year, and the summer season continues. The trade inventory is at the acceptable levels, and so definitely, yes, we believe that even this season onwards is going to be extremely good growth.
Right. Ajay, obviously, we've seen margin contraction, but I believe that that's largely because of your investments in Sri City plant. Can you tell us about the plant? What kind of capacity it adds? What does that plant come through in terms of manufacturing and the contribution it can actually make to your consolidated numbers?
So in terms of our recently added capacity at South in Sri City, we almost increased our capacity by 50%. So from 2.4 million, we increased to 3.6 million. So that was an additional 1.2 million of capacities. And first year, 2024 calendar, we were utilizing, I mean, we gradually started ramping up the capacities utilization, and now this quarter definitely the capacity is fairly utilized, and we still have scope to improve further. And as we get approvals from our other customers and as the market penetration is increasing, we definitely see that by end of this calendar year the capacities should be almost completely utilized during the season time.
All right. And going forward on a consolidated basis, Ajay, what kind of expectations can we have in your operating margins or your EBITDA margins? Is an 8% or thereabout a reasonable number to perhaps assume?
So as we have been guiding previously also, we are looking at a margin of 7.5% plus minus range to continue, and then further leveraging will definitely happen, because as the market is increasing and we see that a lot of commodities have softened currently. So except dollar, I mean, everything is in favor of the industry. So definitely the margins would further improve. But yes, a guidance of 7.5% plus minus is what we have been maintaining.
Mr. Singhania, I have a question. So when you look at 7% operating profit margin, and correct me if I'm wrong, but when I look at June, September or December, you are well below that mark. The 9-month number on operating profit margins will be well and below. So two questions rolled into one. Your guidance on revenues, you'll probably meet it easily. But your guidance on EBITDA, you probably nearly need to double what you've done thus far in Q4 itself. Will Q4 be as strong on the operational front that it enables you to meet your EBITDA guidance and at the same time enable you to clock in 7% EBITDA margins for the year?
Yeah, so see, AC being a seasonal business, Q4 and Q1 are probably the only quarters wherein the entire EBITDA improvement and the margin comes in. So yes, and besides this, there are a lot of adjustments like debit notes and credit notes which are settled only towards the end of the year, and then the PLI income is majorly what we book only in the last quarter. So all this put together is last quarter is something which is the reflection of the entire year's work what we do.
Got it. Okay, so in which case you are saying that you will probably do an EBITDA margin which will enable you to clock in average 7% for the year, or that is not a guidance you are giving?
Yeah, that is absolutely the guidance we have been maintaining.
That is the guidance you are giving. Wow. And which means that you might probably nudge that guided 160 crore of EBITDA for the year as well.
Absolutely, that's what we have been maintaining throughout.
That's what you are maintaining throughout as well.
And on an annualized basis, yes, that's the kind of guidance we have, that our annual balance sheet would be something like a 7.5 plus minus kind of an consolidated EBITDA.
Now the other thing is, there is this whole thing of global manufacturers looking at quality suppliers at the back end, right? Now you've of course done this deal with Hisense as well. Beyond this, do you reckon more and more corporations are coming in, or would you deepen your engagement with the existing clients that you have, Mr. Singhania?
We have to look at both the ways to grow. Definitely deepening ties with our existing customers is a sustainable way to grow, but the real growth is also being, how can we look at the export markets and the newer products. So for this, tie-ups with foreign companies, I mean, especially certain tie-ups with like Hisense and other companies which are scouting to find right partner in India is definitely what we need to look at. And this is also something definitely which we would urge the government also to allow us, because still we have a long way to go in terms of developing the right products which are not only suitable for India market, but also for us to export. So therein, rather than reinventing the wheel, if we have tie-ups in place, we can roll out products much faster and look at a much faster growth. So yes, I mean, there are numerous opportunities which are knocking the door, and deals beyond Hisense are also something which we definitely foresee.
Right, Ajay, also, when it comes to your ramp up in the new Sri City plants, would it be safe to say that you could double your revenue from FY25 levels in the next 2 years? Will that be the kind of contribution coming through?
Yeah, something around that. Yes, that's definitely the kind of conviction we have in place.
Right.
So, like I've been shared earlier, also within the next 3 years, we are looking at a revenue of 5,000 plus crores.
Okay.
So with that kind of conviction, yes, we would definitely working in that direction.
Right. And, Ajay, you also have plans in moving further in terms of the appliances segment as well. What kind of blueprint do you have at this moment that you're working around, at least when it comes to FY26?
So for FY26, so washing machine is something definitely which we believe will scale up and start mass productions. So that's one appliance definitely. Then in small appliances, again, we have a lot of smaller appliances like air fryers and all, which we will start from Q1 of the next year, 26. So that's again something we believe will ramp up very fast. And beyond it, in terms of washing machines, as we starting with the top load, front load is something which we are working on, and we believe that's one technology product in which we need to work more deeper, and then that's definitely which will create more value for the company. So yes, we want to diversify our product portfolio in the right appliances like washing machines and smaller appliances like air fryers and others. Beyond it, if I see, there are definitely other appliances like frost-free refrigerators and all, which will give us the next impact in terms of creating the value for the company.
Okay, there are a couple of other questions. So, by the way, just wondering, when you say 5,000 crores in the next 3 years, I'm just getting the timelines correct. By FY28, you say you will reach maybe circa 5,000 crores. Fair assessment?
Yeah.
Okay. FY24, you did 1420 crores of revenues and a profit after tax of 35 crores at a EBITDA margin of circa 7-8%. Assuming that you keep the same margins, that would mean that you clock in a profit of close to 123 crores or 125 crores by when you do that number of 5,000 crores. Again, fair assessment?
Yeah, absolutely, yes. I'm keeping my fingers crossed for that. But yes,
Of
that's
course.
the kind of a plan we have, and that's what the team is working on.
Just wanted to get that out of the way. Okay, great. So you maintain EBITDA while you increase the revenues, which is a good thing. Okay. There is a question that my colleague Puneet had. Epack Prefab has filed an DRHP, if I'm not wrong. Is there any relation between the two companies?
Yeah, so I mean, the promoters are the same. So the same set of 4 promoters are the one who started Epack Prefab as well. So I mean, it's a sister concern in that sense.
Concern, but no shareholding or cross-holding between the two companies.
At company level, no shareholding or cross-holding. At promoter level, yes, both the families, the same set of shareholding.
Yeah, but so Epack Durable, the minority shareholders don't get impacted in any fashion by the IPO of Epack Prefab. Okay, good to get that out of the way. My last couple of questions from my end. I heard you mention in your earlier answer that PLI benefits, etc., come forth in Q4. Now, what is the latest on the PLI applications that you may have filed? Excuse me for not knowing this, but I'm just trying to understand. Are there some PLI applications that you filed and not gotten a response for? Are there some PLI applications that the government has put on offer which you will be applying for? Can you give us an update there?
So in terms of PLI for air conditioning components manufacturing, it's a 5-year scheme in which we, for the last 3 years, we've been consecutively filing. And for the first year, something we already received. Now, end of March is what we will receive PLI for the last financial year. So it takes almost a year by when we actually realize the PLI benefit. And similarly, for the current financial year, we'll file it in April, May, and then we expect it to get by December or January of the next year. So it's a 5-year process. And we've been meeting the target set to achieve every year.
All right. And, Ajay, a follow-up question to, the markets that you are catering and the clients that you are catering to right now. Are we looking at an expansion in that base as well? Are you having conversations with more industry players where you can look to, in fact, expand not only your clientele, but also your product line?
Definitely, yes. So again, as we have penetrated down south, we have started discussing with a lot of local players in south. So I mean, this year itself, we have added close to 15 new customers, those smaller ones, but they're the local players in south now. That's something kind of an addition we are doing in terms of acquiring new customers. At the same time, our larger clients, the top 10 brands selling ACs in India, they are growing rapidly, and hence we also have growth with them. And at the same time, a lot of brands which have in-house manufacturing, definitely the kind of growth industry is seeing their capacities in-house is not enough. And so that's another thing which is giving us a good growth.
That commentary from Ajay Singhania is maybe the one reason why the stock is excited, because it's locked on a 5% upper circuit as we speak. As the interview was going on, the stock has inched higher and now locked on a 5% upper circuit. The guidance is strong. If they actually do 125 crores of revenues by FY28, then at a 3,500 crore market cap, That's a high growth company trading at about 25 times. You can do your math. I have no recommendation, by the way. We're journalists, we don't recommend. But just laying out the numbers for you that the management has just said that they hope to do about 5,000 crores. Keeping the fingers crossed is the term. 5,000 crores revenues. And on that margins and that profitability, they're probably clocking about 125 crores of profit by FY28. I hope I got those numbers correct. Ajay Singhania, thank you so much for taking the time out and being with us, and all the best for all your plans. That's the view from Epack Durables. Cautiously confident, if I can use that term, is Epack Durables about the quarters ahead. And in fact, I think that would probably be the summation of the kind of feedback or the sentiment that we got at the NDTV Profit conclave as well. The theme was Blueprint for Viksit Bharat 2047, where we spoke to Ramdev Agarwal, and he said that the stock market is the Maha Kumbh of investors. We can compete with global players coming to India, was amongst the things that both Ramdev Agarwal and Anish Shah had to say. Rhythm Desai mentioned that he remains bullish on India and he's not worried about Trump anymore. He believed that the two countries will find an amicable solution to most issues. Mr. Piyush Goyal had mentioned that the opportunities in India in the next 20 to 25 years are massive, and again saying that we can compete with the global players coming to India. So some interesting thoughts from some of the participants. And it was, as I said, Dr. Anish Shah amongst the guests. He spoke about how Make in India can drive the Viksit Bharat project. Listen into a small slice of that conversation.
It takes time for that change to take place, and a number of efforts have been put in place already to make it easier to do business in India, to improve infrastructure, to reduce logistics costs, to have companies focus on innovation. And all of that starts coming together at some point. From a Mahindra Group standpoint, our leaders 20 years ago had a vision, and their vision was to create R&D in India, to ensure that India could create the best vehicles, and that was the birth of the Mahindra Research Valley in Chennai. As I said, it takes time, and it has taken us time as well to really be able to harness the strength of a research center. And what you've seen over the last 5 years is products that were put in place earlier but we are delivering now. What you're seeing in the last 5 weeks are our electric vehicles that are also coming, which are entirely born in India and out of research and development here. But it takes time for that to happen. And today we feel very proud that our products are of a quality that can match up to any international standard and can really compete with anyone out there in the world.
Yeah, well, that showed in the way the bookings happened on Friday, and quite stunning, really, Dr. Shah. So just trying to understand, I mean, you reckon that, and congratulations on that number, by the way, quite fascinating, though I must say that it didn't come as a surprise. I mean, the sneak peek that people got of the two vehicles that you kind of opened up, if I can use that term, it was partly anticipated because they just look so good. So great stuff there. I would love to understand, as you think of the group strategy, and you're a large group, you're the architect of that strategy, as you think of the group strategy over the course of the next 5, 10, 15 years, do you reckon the opportunity and the incentives for enhancing manufacturing are there for you and other groups to really enhance the Indian manufacturing prowess? Because without that, the goal of Viksit Bharat might not quite be achieved.
So we feel very confident about that, especially after what we've seen with our electric vehicles and what we've seen with our tractors. So India clearly has the ability to manufacture at scale, to manufacture at a lower cost. It does require a few more efforts for that to happen, but we've been able to show this with our products. And we've had many questions over the years around how will you compete with all the foreign companies coming into India. There have been many who've written us off at multiple times over the last 20, 25 years as well, saying that the entry of such and such company is going to be the death knell for us in either automobile or in farm. And our teams have been able to show that they can manufacture in India at strength and be able to compete with the global majors in a very significant way. Over the last year as well, on electric vehicles, there were a number of questions saying, how are you going to compete if such and such company comes into India? And our response has always been, our products will speak for themselves. And that's what they're doing today. And this is a strength that not just us, but we see other Indian companies also bringing to the fore and essentially setting up the opportunity for India to be a manufacturing hub for the world. And that is what we aspire to, and that is what we feel confident we will be able to deliver in our path to Viksit Bharat.
Okay. And I'm going to make this equal parts manufacturing as well as services, because less Mahindra and Mahindra, I mean, yes, the dominant share is auto. There's lots beyond that, right? And would love to talk about that too. But just for a moment, because you mentioned that point, I can't not invoke that conversation, right? This whole talk of one Tesla coming in, the Chinese companies, BYD, etc., making their presence felt. Now, your numbers, booking numbers speak for themselves, but I'm still trying to understand, not just for Mahindra Group, but for others within the auto ecosystem. How would the industry face up to deep-pocketed global car companies or vehicle companies wanting to create their foothold in India? Just trying to understand.
Neeraj, that's a question we've been answering for the last 25 years. Because that's exactly the question that was there 25 years ago when various deep-pocketed global players came into India and Mahindra was written off as dead, saying you're not going to be able to compete with them. Right? That's happened on multiple occasions. Today, we have the products that speak for themselves. And in fact, we went to the extent where at our launch, at our test center in Chennai, we actually had some of the best vehicles in the world there along with our vehicles, and we invited the folks at the launch to drive all of them. And our vehicles stood up extremely well against some of the best vehicles, some of which were priced 3 times or 4 times our vehicle as well. So that confidence today comes from the people we have, from what they've done, from what they've developed. And therefore, we feel fairly good about the fact that we can compete with various folks. And I'm glad you were talking about services as well, because we do remind everyone we talk to that auto today is just 1/3 of what we do. Mahindra plays in 70% of India's growth over the next decade, and we are in multiple sectors, and some of those are growing very well and contributing very significantly to our businesses as well.
Yeah, most certainly, and I'll come to that. Just so sorry, if my question came across that Indian companies will find it difficult to compete with global brands, no, because in some sense, Indian companies are global brands unto themselves. Your tractors in the US, I mean, making a mark, right? And Indian tech companies making a mark globally. So I didn't mean it that way. What I was just trying to understand, because a lot of these global brands are very famous per se, and there might be an allure for that. But I get the answer. You're saying that the products for you and for other companies will speak for themselves. Now, my question is the current economic momentum in India, which is maybe a bit slacking in Q2, picking up slightly in Q3, conducive for Indian companies to think big in the near term? Is this a passing phase, or is it difficult to say whether this intermediate slowdown that we have will get over in a hurry or not?
So there, Neeraj, we feel that the fundamentals in India are very strong. And they are further strengthened by some of the actions over the last few years. The digital stack today makes it much easier for us to do business across multiple sectors. Improvement in infrastructure is starting to bring logistics costs down. And a combination of all of these will enable the economy to grow even faster. We see this recent slowdown as a blip, and with some of the actions taken, we feel that we will be back on track. I personally do expect that we should be seeing growth north of 8% in the near future as well. And that's something that I think the Indian economy will be able to deliver, because we've grown at 6.3 to 6.5% over the last 30 years. And there are a number of positives that we have in place today that we didn't have over the last 30 years. So we should be able to see a faster growth rate. And we're investing in a significant manner across multiple industries. And we feel very bullish about the India story.
Yeah, there's some bit of pivot that this budget has taken, if you will, right? That there is a focus on consumption being given. It may be a small portion of the overall economy size, but it has a multiplier effect. the moves taken in the budget, if you will. Do you reckon that this move towards 8% growth, and I heard you say near future, it may be 1 year, 2 year, 3 years, depending on where you believe. In fact, would love to know that as well, if you have a kind of time gauge in mind. But two, would consumption and manufacturing both play an equal part into this, or can it ride on the plank of manufacturing alone?
It has to be both, because consumption is what will drive further private sector capex. And there has been concern, and rightly so, that private sector capex hasn't quite kept up, and government capex is really what has taken the economy forward over the last 3 or 4 years. But private sector capex comes in when capacity utilization goes higher. That's driven by consumption. And therefore, we feel that this is the right path to take. And this consumption boost will enable private sector to put in even more capex, and that creates a virtuous cycle that allows the economy to grow faster.
It's been elusive, sir. I mean, this capex, and I'm not blaming the private sector, right? The private sector will put in capex. I'm not talking about you, but in general, the private sector will put in capex when they see the right kind of IRRs for the project. But private sector capex has been elusive. Do you believe that we will sooner rather than later see this again? I mean, is there some estimated timeline that you reckon, maybe in 2025, 2026, that there's a higher probability of private sector capex coming back with a bang?
So the one metric to look at is capacity utilization across sectors.
Right.
And that has been inching up. In a number of sectors, it's over 75%. In a few sectors, it's over 80%. So as it starts getting over 80%, that's the right time for companies to start thinking about capex and making sure that they have enough capacity to meet the demand going forward. As consumption increases and we see further growth, it only accelerates the need for private sector capex. And you're right, for us, we've tripled capacity in the auto business in the last 4 years. We've added significant capacity to farm, to a number of other industries as well. And that's because we've seen demand for our products, and that will drive further private sector capex. So again, we feel that India is well positioned right now. The actions that we've seen the government take have been for the long term and to create stimulus for the economy in the recent past around the short term for consumption as well. And that's the right set of actions that will enable private sector capex to come in and provide a further boost.
Okay, you are an industry captain, but a lot of our audience are investors. I would love to know. The worry seems to be that we are not getting out of this growth quagmire. I know I'm maybe repeating this question, but I'm just trying to understand. We've seen a bit of an uptick in quarter 3 numbers relative to quarter 2 numbers. The hope is that Q4 and then Q1 onwards, some of these moves that the government has taken will take or bring about an impact. Do you reckon, I know you mentioned that there's no reason why India can't grow at 8%, but I'm not going that far. I'm trying to understand, do you in your wisdom believe that, let's say quarter 1 FY26 or maybe quarter 2 or quarter 3 onwards, we will actually see meaningful growth come back? Is there some estimate around the timelines that you have?
So if you look at rural India, we've seen growth coming back already.
Okay.
So our estimate for the fourth quarter is that tractor sales will be 15% higher than the previous year from an industry standpoint. And that's a fairly significant level of growth for tractors. It's in a very good place at this point. We see some of that momentum continuing into next year as well, though it's a little early to call next year from a rural standpoint. There is a lot of positivity around that. We've seen some slowdown in urban, but there again we feel that's more of a blip right now. So we would feel very confident that by Q1 next year we're going to see the economy on a faster track from a growth standpoint.
Okay, does the budget kind of try to address the urban slowdown as well? Because in effect, a lot of the taxpayer savings that happen impact, I would presume, the urban consumer.
That's correct. The tax effect as well as the rate cut, a combination of both of those, will provide a stimulus from an economic standpoint. The key is to ensure that inflation does not come back, and that's a fine balance. And therefore, the RBI has its task cut out, but it's a balance I think they've handled very well in the past. And as they do that, I think we will be in a good place to see growth coming back.
Okay. I'm sorry if I'm putting you in a bit of a spot, but because you have US business interests as well, and I'm just trying to understand, what are your thoughts on the India-US meets that have happened? There is, I mean, the tariffs, reciprocal tariffs, what have you. Ridham Desai was here in the morning, and his note suggests that the risk of a large impact of reciprocal tariffs is very less. Would love to understand, one, that from you. And two, somebody invoked this thought and asked me to ask you this. I mean, what if there were trade agreements which were nearly equal to a free trade agreement between India and the US, and if all of those moves were to happen, what are the impact for Indian industry per se? Any thoughts?
So the starting point is that the relationship between India and the US is very strong. And I think that's a very important factor. Each country is going to take actions based on what is required for that country at that point in time. And on a longer term, we want the world to be completely free from a trade standpoint. And that's positive. We've seen the benefits of globalization in doing that. But we've also seen each country, and whether that's the US or China or Japan or Thailand or India, take actions based on what makes sense for every industry at a particular point. And our sense is that will play out in some form. I don't see a world where there is no tariff at all across the board. That doesn't make sense for multiple countries because it depends on their phase or their life cycle at that point. So I think we will come to a place where it makes sense for both countries. There will be some industries that are hurt more than others possibly, depending on what finally happens. But I do feel that it will be in a place where it makes sense because India has to protect manufacturing in a significant way as well. And that's an important lever for India's growth for the next decade.
Yeah, I mean, and which is why my concern was that could that have an impact? Because for the last 3 years or 4 years, we've been talking about the China Plus One benefits coming into other ASEAN countries. Some of them have come to India as well. Do some of these trade agreements or reciprocal tariffs impact that manufacturing ambition in a meaningful way? You don't think that?
Given the relationship that we have between both countries, we feel that India will be possibly in the net gainer category. But as with the world right now, everything is unpredictable, so we shall just have to be agile and ready to respond.
Okay, let's move beyond manufacturing, Dr. Shah. I mean, and beyond just tractors and autos, which are, of course, doing very well for you. And by the way, I mean, it was great to see some of the large companies like yours, very few in Q3, which delivered very strong numbers, right? What's your sense about, the overall console performance for your group in the times to come? Because in some sense it will do slightly better than GDP growth, but it will be a mirror or a reflection of what the inherent growth is. You are constructive on growth picking up for the country. Would that be safe to assume, therefore, that you are constructive on growth looking better for M&M in FY26 over what you've done in FY25, which has been a commendable job already?
That's the problem with doing well, and we've had that discussion at our board as well, saying that just the fact that you've done well raises expectations significantly. So the one thing I will say is, if you look at a Q3 results, it's our businesses beyond auto and farm that have actually grown much faster, and that's really helped. And auto and farm have done very well also, so it's been a combination of all of that coming together. And we feel confident that we can continue this because from our standpoint, it's more about operational excellence and ensuring that we're delivering everything we can by having our teams perform well on the ground. We have signed up effectively for growth at 2x GDP, and that's something we feel confident we can continue to deliver over the years.
Tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Well, welcome to 2025, the big idea. And we have the top team of Citi in our studios to try and understand how is it that they think about the year ahead. We used to do a quarterly conversation with them about how results have gone by. But at the start of the year, it's pertinent to talk about how does the Citi Think Tank think about 2025 as a year. With me, Surendra Goyal, Head of India Research at Citi. Kunal Shah, Director of Indian Banks and Financials at Citi. Arvind Sharma, Director of India Autos and Transportation, and Rashi Chopra, Director, India Metals and Cement. All of you, thank you so much for taking the time out. Absolute delight to have you. And I think it's just pertinent to talk about 2025 because if people were cribbing about how Indian markets are not giving the opportunity, maybe, just maybe, this dip gives the opportunity. Surendra, let me start with you. And on hindsight, while you may not have changed your targets, etc., but suddenly a target of 26,000 makes you sound bullish related to what's happening in the markets and others. Tell us about how do you think about 2025 as a year for Indian markets?
Sure. Thanks for having us on the show. And just to give some context to the target, when towards the end of last year, the market was at more than 25,000, our target was still 25,000. So we rolled it forward and now it's 26,000. So we are more constructive on the market compared to say 3 months and 6 months back. And it's a combination of 2-3 reasons which are kind of playing out together for being more constructive. Firstly, if you look at the growth slowdown that we have had, say over the last 6 to 9 months, firstly, public capex was slow, government capex was slow for a bit. So that in December saw a good recovery and should improve going forward. Secondly, the budget did provide the tax cuts and interest rate also. We have seen cuts and we are expecting more cuts as we go forward. So I think a lot of those things should help growth as we go forward from here. And which is why at a overall earnings growth trajectory, Nifty earnings growth trajectory, we are expecting the low to mid single digit growth this year to improve to low double digit growths in the coming year. So that is the first argument. Secondly, valuations. There has been a fair bit of a pullback. Nifty had gone to even 22 times 1 year forward. Now we are below 19 times 1 year forward. So I think, and that's like the 5-year average, 19 times. So in that context, it is a lot more reasonable level. And the third thing I would say that large caps, there are enough stocks where valuations are now becoming more reasonable. So compared to our view, say some time back, we are more constructive, and that is what is reflected in the 12-13% upside that we have on the market from current levels. Having said that, I would also add a point that there is still a fair bit of uncertainty on the global side, right? There are so many announcements or comments on tariffs. right? And I think you need some kind of clarity to come on that point. That will give the market comfort, because what has happened between November and now is a stronger dollar has resulted in EM outflows, and then even within that, India was a more expensive market with a bit of a cyclical growth slowdown. So everything, that is what has impacted Indian markets. And now going forward, it looks a better kind of a situation compared to say 3 months or 6 months back.
Interesting. If 2023 and 24 were years of US exceptionalism, it doesn't seem that 2025 will be any different, even if it's concentrated for now. But my question is largely this, Surendra. When a global money manager sitting out of Chicago or New York is getting 4.5 fixed, plus currency, plus the equity risk premium missing, why would that investor want to come to an emerging market or India? And if the FI flow is not coming back, I mean, if US interest rates were to rise, who knows, then that makes the case even worse, if you will. So if the FI investor is not coming back, can Indian markets on the back of the domestic flows still give a reasonable return, or is it a difficult argument?
Yeah, so a couple of points there, Neeraj. So this discussion always comes in when we have a correction. And despite that, the Indian market in the longer term has continued to compound fairly well. And these questions typically come in when there is a lot of pessimism.
Okay.
Right? Finally, what do investors come to India for? You have a GDP growth which we expect to be, say, close to 6.5% going forward, which is the best, one of the best in the world, at least among the major markets, right? And Indian companies are generally good at converting that to earnings growth. If you look at the 10-year growth CAGR of, say, Nifty or any broad-based index, it will be like anywhere between 11 to 13%. So that is what people come in for. There will be situations, short-term events where the currency depreciates a lot, so it becomes more difficult. Flows, and we have seen foreign flows, they have been volatile. If you look at the last 4 years data, there have been months of significant outflows, couple of months, and then you see stability and then money comes in again. So I think that would be kind of taking it too far, because we have seen this play out so many times. If the underlying growth improves, okay, and things stabilize a little bit on the global front, I think that's a clear situation for money to come back in India, even on the foreign side.
Cross fingers.
And last point, I think you started by saying US. So I think even in the US, it's been one theme which has been dominating. It's not a very broad-based market performance, right?
That's true.
And even there, I think with what happened with DeepSeek and so on, we'll really need to see how that plays out. I don't think it's a given that everything continues to play out the way it's played out in the last couple of years.
By the way, at some point of time in the show, we'll talk about that, because I think the word for 2025 got set in January itself, DeepSeek. I think that's probably the biggest telling point. But okay, if FIs were to come back, one of the larger sectors that they might want to come back is BFSI, because for the longest time, very well valued, aayega paisa, it hasn't come thus far. But we're seeing signs of that, right? Signs of there being some demand at the tape, wherein companies have delivered numbers. I mean, Bajaj Finance, a case in point, some others. How constructive are you relative to how you have been over the last 2 or 3 quarters on BFSI at large?
So overall on growth side, definitely when we look at it, as Surendra was highlighting, with respect to the tax cuts that will help in terms of the consumption and the retail finance demand. Even if there is some uptick on the capex, the overall corporate credit, which has been in say somewhere high single digit, we could see some uptick out there. And in initiatives which were taken by RBI to manage the unsecured portfolio, we have already seen steep moderation out there. It seems like largely that base is set, and on that we will see relatively better growth on the unsecured side going forward. So all this can actually lead to a percentage point or 2 higher credit growth than where we are today. And many of the players, and that's where maybe we turned positive on Bajaj, we turned positive on Kotak as well, because we clearly saw the visibility in terms of growth, wherein they would outperform the industry average by a significant number. So Bajaj, we are still confident, like easily 25% plus is something which will continue for next 3 years. Kotak also, we are pretty confident that they can give like more than 15% growth. And last quarter also their growth was amongst the highest in the private banks. So these two stocks in particular from the growth perspective.
Okay, but large banks at large or large financials at large, Kunal, you would reckon that they are in a safe space right now from a valuation perspective? Would that be a fair assessment?
Yeah, so when we look at it in terms of the historical valuation, last 5 years average, we are trading at almost 20% discount to that. Okay, and when we look at it in terms of the asset quality noise which was there, now it's almost factored into the estimates as well for FY26, FY27. If growth picks up, now the only thing that needs to be watched out is margin behavior amidst the rate cut. But if it's a shallow rate cut, it should not have that much of an impact, and everyone has displayed operating efficiency. So when you look at it in terms of the ROA, that is something which has surprised quite positively, despite maybe the noise around asset quality, growth and all. Large banks have been able to manage the ROA profile. But still valuations are like almost 20% down from 5 years average. So to that extent, there is definitely the room.
Okay, and just one follow-up on the banking space, the pecking order. You mentioned Kotak, of course, that seems to be number one on your list.
And ICICI and HDFC are the other one, so we stick to that.
You stick into the large ones. Okay, I'll come back on some of the other aspects as well. But Rashi, let me get you in. I mean, and again, I'm not completely sure of the valuations, but if we can talk about banking as being below 5-year averages. Maybe some of the cement names, and let's start with that because I'll get to tariffs in a moment with both you and Arvind. But cement maybe, again, a sector which virtually has gone nowhere, right? Now, if government capex has picked up and at some point of time if private capex were to come back, is cement in a sweet spot or are you negative?
Cement is in a sweet spot. But I think it'll have to be a little bit of a selective sweet spot in the sense that, of course, we've had a low base here. The first 9 months demand hasn't really gone anywhere. But now, like we're hearing, December demand was better than November, January's been better than December, and things are clearly picking up. So in that sense, I think the growth trajectory becomes like a clear-cut one, and we're not even exposed to like global sort of, it's not exported or anything like that. It's all domestic demand in a way. Second thing is that we need to play the stocks which are essentially kind of levered or prepared to play for this growth with the cost efficiencies kind of playing out. Because despite demand moving up, the general thought process, or at least our view, is that pricing may not necessarily move up significantly. And that's because a lot of the capacity is again being added by the larger players. So that fight for market share still remains. So we need to kind of focus on the growth plays with, the cost benefits. So I think the players which are like the strong ones will continue to remain, like the valuations have come off a little bit, but not significantly. But there's a reason why they're kind of holding up. And they become a safe place to kind of be in. So stocks like Ultratech, for example, trades at about $180 a ton today. But I'd still say that would be our top pick because you're getting growth there, you're getting cost, and you're continuing to see the benefits of consolidation, and the acquisitions that they're making.
Got it. A follow-up there. Would market cap by capacity or EV per ton be the preferred way in which you gauge companies currently? Part one of my question is that because capacities are coming up, if you will, and therefore for a lot of companies they might look cheaper than what they were 5 years ago. And just question to roll into that. A lot of people are preferring some specific regional plays. I mean, investors tell me, for example, that they are bullish on the Andhra focused companies because of the Amravati setup, etc. and stuff like that. Are you kind of constructive with themes like that?
Sure. So firstly, on the EV per ton valuation, I think it just becomes like an easy benchmark to kind of look at. We know replacement cost, again, depending on the dollar value, is probably somewhere around $90, $95 today. As we speak, and like I said, Ultratech trades at 180, right? So how does one kind of say that, one should still buy it? But in the context of the fact that they're continuing to grow, the market is obviously giving them that value. Then we have stocks like, ACC, where we also have a buy, but they trade at like $80. Dalmia trades at $80. And it's very clear, visibly so, that there's not a lot of growth visibility coming out of here. So the market is willing to give them a price around replacement cost, right? So it just becomes like an easy metric to kind of work with. Of course, we work with EV, EBITDA on our valuations when we value the company. But then again, it's, 5-year averages, 10-year averages, what is the context of the market? But growth becomes the key parameter over here. Secondly, on the south, obviously there's a lot of expectation around growth. A lot of the M&A activity that you've seen happen has happened with the south-based companies. They've been the acquisition targets. Having said that, pricing has been most volatile in the south and the eastern markets. So again, I won't be very nitpicking on these southern players just because they're in the south. They have to kind of come with the other criteria to make them work.
Okay. And then to tariffs, and question to both of you specifically on your themes. But Surendra, can I just briefly, before I get to Arvind, because I have a bunch of questions for him. But tariffs by and large, I mean, everybody's talking about how the next couple of quarters, forget fundamentals, forget valuations, focus on where Trump is going, where the tariffs are coming, and that will be the key point. Now, he's said April 2nd, key reciprocal tariffs coming in. How big a negative for a clutch of sectors, including pharmaceuticals or some of the others, including the pockets that Rashi and Arvind track as well, how big an impact could that be?
Sure. So I think the first thing I would say is there are still a lot of unknowns and uncertainties around that. So like whatever I say is kind of making certain assumptions. Everything could change, right? Like it could change tomorrow, for example, right? But the point I'm trying to make here is, like, if you look at some of the sectors which are more commonly talked about, you will also have to keep in mind angles like, say, let's take an example of pharma, right? Generic pharma, a lot of the supply in the US is from India, right? So how does it really impact the cost there? Because these companies don't make very high margins. So at some point they have to pass it on to the channel and eventually to the consumer. So then how does it really work? Because it will lead to healthcare inflation. So that's the other thing to keep in mind. Like, let's take chemicals. I think there it also becomes important to keep in mind which are the other countries which manufacture chemicals and supply to the US, and how does it change the relative competitive positioning between those countries, right? So I think there are just too many unknowns at this point of time to be making a very informed decision. And then some of the other sectors where there is a tariff differential, like agri products or say jewelry, not a lot of the major listed players have an exposure there, at least to the US. So firstly, I would say India still looks relatively better placed versus a lot of other countries as far as the tariff is concerned. But there are uncertainties, and that is what I think the market is clearly pricing in, and that is why there is a lot of nervousness, and depending on the comments that come out, stocks and sectors do move.
Okay. Well,
and then finally, like, of course, like again, one of the things we'll also have to see is this more for negotiations? So what happens? That's the other angle. There is a talk of a bilateral trade agreement by, say, fall of this year. So I think a lot of those things are very unknown right now. So having a very clear picture, I don't think we'll get it at least in the next month or two.
Got it. Yeah. If Mexico and Canada, anything to go by, some of it is negotiating tactics as well. One certainly hopes that stays that way. But it puts autos firmly in the thick of things, not tariffs per se, or not just tariffs, but everything that's happening around what India could do vis-a-vis global majors setting up shop, etc. in India. Let me start with the bigger macro picture first. Then I would also love to understand from you how you thought of earnings gone by. But how big a problem could it be for Indian automakers, particularly car companies, if large global majors set up shop in India? It's not that it's not happened in the past.
Sure. If you see till now, I'm talking about say January or December, EVs in India from the Indian companies were aimed more towards people looking at value, total cost of ownership. But in the Auto Expo and over the last couple of months, we've seen companies launching more high-end models. We are targeting people who are, who want more premium cars, better features, connectivity and the likes. And therefore, they're at a higher price point also. So if we have global companies setting up shops in India, obviously their cars would be priced at a slightly higher point, right? So they are also targeting the same clientele that some of these recent models are targeting. So naturally competition is going to heat up. Again, manufacturing in India, how much localization do these companies do versus say companies in India who already have a very strong vendor network. It's not just batteries and motors, obviously they are high cost items, but apart from that, the vendor network that these legacy companies in India have, the footprint, the sales footprint that these companies have gives them an edge. But again, you're talking about customers, if they are looking at more premium end electric vehicles, naturally the competition heats up, puts a pressure on pricing and therefore margins. Again, PLI is something that some of these Indian companies have. So PLI helps them become more competitive, 10, 12%, whatever they get from the government. So the government has taken these steps in the past to protect the interest of Indian companies. Nevertheless, and it's again a situation which is still evolving. If you have global companies coming in India, setting up shop, maybe take a bit of a hit on the pricing, but try to gain market share, it is going to heat up the competition quite a lot.
Okay, so we were wondering about why is it that despite selling 30,000 EV vehicles on the day of the launch, M&M got beaten down in Monday straight, so on and so forth, right? We were talking to Anish Shah yesterday at the conclave. He was fairly confident of not just them, but every Indian company beating up or standing up to competition. What is already captured in the price for some of the four-wheeler auto companies when it comes to this? And what did you make of the results? Because Maruti's numbers, December, Jan look rock solid. M&M's December quarter numbers look very good. What have you made of the four-wheeler numbers and the commentary?
Sure. So, in our top picks, we have both Maruti, Mahindra and Hyundai. So, we are clearly very constructive on the four-wheeler space. And I think numbers have been better over the last couple of months. Even in sub-segments, even like hatchbacks and cars, which were weak for probably last 3 or 4 years, we've seen some sort of a stability, if not a revival. So to that extent, yes, things are reviving. Of course, there's a large base, so our YOY growth number might seem a little underwhelming at low to mid single digit, but clearly we have seen a revival in the numbers, especially in passenger vehicles. But again, all these three companies, Maruti, Mahindra and Hyundai, they have launched their born electric vehicles just last couple of months. So naturally, they are playing into a space which till now was not well discovered in India. Models we've had till now were more ICE models or ICE platforms converted to EVs.
Right.
Apart from some of the, again, global companies which had a few models. But most of these companies, the Indian majors, had ICE model converted to EVs. You talked about Mahindra and the launch. It's probably for the first time we are having a born electric vehicle coming into the market. Yeah. And perhaps the benchmark is set up by the previous models where you had 50, 60,000, 100,000 numbers in the first hour of booking. I guess that benchmark will have to be recalibrated. We're talking about a different price point, a different customer segment, and not only a product, but even a segment which has not been tried by customers, right? So it will take some time to play out. So, let's see how the actual volumes pan out. It's still 5,000 a month, the capacity, so they are 30,000 in a way. Theoretically, 6 months of bookings have been done. Let's see how it plays out once the car is on the road. What's the feedback? What's the word of mouth publicity? I think those things will play out.
Maybe just to add to that, your question was more on Indian companies kind of holding up to competition. See, I think from a market perspective, the market always cares about increased fragmentation in any industry. Indian companies may hold up, right? Just look at the example of what's played out in paints. The incumbent might still end up 2 years, 3 years later being like the strongest player in the market, but the market in the market business, but the stock market still cares about increasing competition and increasing fragmentation. And that does impact stocks, at least in the short term. So I think that's a point to case. So Indian companies could well hold up, they might do very well, but I think the market will be nervous about if there is a risk of increasing competition.
And this could be across sectors, not just autos, but it's interesting that with that in mind as well, he still has an overweight or the buy list on all the three large companies. So that is very, very interesting to note as well. Okay, speaking of tariffs, by the way, you can't not talk about metals, right? And what's the thought there? Please help us understand how you think about this whole situation.
It's a tough one.
Of course, which is why I'm asking you.
See, like you mentioned, when it's Mexico and Canada, it's essentially to get a deal, right? So, for example, in aluminium, the US imports about 70% of their aluminium, about 25% of their steel is all under imports, right? And on steel as well, when 232 was sort of implemented earlier, there were a lot of exemptions that came through. And at the moment, I think really only 18% gets taxed over there. So the question is, will it stay or will there be exemptions? Number one. Hypothetically, if it were to stay, right, at the moment, like from an aluminium perspective, Hindalco has been quite confident that at the moment they benefit from the premiums rising. And in their view, the exemptions will come and they won't stay. From a pure India perspective, right, and again from a reciprocal tariff perspective, etc., we're not really exposed from an export market perspective. India exports about almost like 230 to 250,000 tons of steel to the US because in any case there's a tariff, a 25% tariff on India. From aluminium side, it's a 100 KT exposure. Sorry. And the only place again where reciprocal tariffs become important is thermal coal and coking coal. Sorry. Because we import about 10 million odd thermal coal, 10 million odd coking coal. So I think that becomes a question mark. But then, there are alternate sources of coal that are available globally. So it's still all a big question mark. But purely from a, sort of a reciprocal tariff perspective also, I don't think the implications are very significant purely on tariffs.
Okay.
From an Indian equity perspective, we are still negative on steel as a sector. Because we're still sort of, banking on, or rather the view is that there's not a lot happening in China at this point in time. I think the market is still hopeful that something will come up on the safeguard side, which is why the stocks are kind of, in a range. And I'm not sure necessarily reacting completely to the tariffs. I mean, the volatility is there, but I think it's on the one side is something happening on the tariffs, the other side is something happening on the Indian government doing something about safeguard and protectionism. But we are still sort of the view that maybe nothing will really come significantly on the safeguard side because inflation is a big question mark as well.
Okay, well, in which case, for a clutch of sectors, a lot of these things might be negotiating tactics. Okay, fair call. Last two questions. The last one is on DeepSeek. The second last one, I'm asking you to pick between two, whichever you want to talk about. Whether the quantum of coverage that you may have on non-lending financials, and if that is something that falls within your ambit, and if not, you've spoken to us about large cap financials. What about the second tier? Is there some merit in trying to own them? A lot of people are saying that the valuations, for example, on an IndusInd 1x book, if something happens on MFIs because the new RBI governor might be relaxing the norms a little bit, a lot of those stocks could benefit as well. Any thoughts?
So on second tier, when we look at it, it's still better to stay with the secured lenders rather than the lenders who are more focused on the unsecured side.
Okay.
So there are players who have more than 95% exposure towards the secured lending in the second tier. And that would be the preferred bets, given that they are also available at reasonable valuations of 1.2, 1.3x. And when we look at it, in fact, for MFI in particular, what we gauged from the conference that we had last week, in fact, the pain is going to continue in 4Q as well. And we need to see in terms of 1Q, the implementation of MFIN 2.0 guardrails, how much is the disruption. So no doubt, a lot of pain has already got recognized, provided for. To that extent, it might come off, but still they are not out of the woods. Okay, so to that extent, maybe rather. And on the unsecured side, when we look at it on the personal loans, we are seeing some pain to cool off. But on the secured, there doesn't seem to be too much of worry even on the asset quality side. And they might be able to participate on the growth as well. So would prefer more of a secured lenders compared to maybe the players who have exposure to the unsecured ones.
And still the pecking order will be large cap financials and then maybe the second tier secured lenders. And then unsecured ones, if at all. Okay, fine. Yeah. Perfect. Thanks for that. The final word and the big idea for 2025, did China set it up in January itself? DeepSeek and the flutter that is brought about in the AI world. What have you thought about it? Because you look at tech so closely. Sadly, we haven't even spoken about Capgemini and the impact that it had on Indian IT. Today, IT sector is down as well, etc. But just a brief on IT and DeepSeek before we wrap up.
Sure. And before that, I think like on the market outlook, one of the points I missed out is that the weightage of FIIs versus the emerging market benchmark is the underweight is among the highest in the last 20 years. Okay, so the positioning from a FII perspective is also the lightest that we have seen in a long time.
And typically, does that bring about a change? I mean, is that a cue at times, Surendra?
Again, India historically has mostly been overweight. Of course, the benchmark weight has gone up. But like compared to, say, a year back, when there was a big overweight, today there is a significant underweight, and that to that extent, at least from an ownership perspective, it's definitely light, and that helps. Of course, flows are very difficult to predict. but it kind of provides a relatively more favorable kind of a setup going forward.
Got it.
Now, on your question on tech, again, DeepSeek, obviously I'm not an expert. The only point I would make is, rather than commenting on DeepSeek, I think open source models in general could kind of change things very meaningfully, right? Everything, right? The capex and the cost of compute, everything can change. And how it really impacts IT spending of clients. Does it free up some room for growth in some of the other areas of tech? I think a lot of those questions are a debate right now. Still too early. There is a fair bit of debate on the topic. So we'll really have to see how this plays out going forward. On IT services, again, very factually, I think the guidance yesterday was below what the market was or consensus was expecting in Europe, and which is why there was a bit of a disappointment. But in IT, what we have been saying, like at least for Indian IT, is we see a very moderate improvement in growth in FY26, and valuations in that context are still on the higher side, right? If you look at this year, all the companies we cover put together, the growth should be around 4%, FY25. Next year, it's 5.5%, 6%. So that's still a very slow recovery. And for that, the IT index is trading at maybe 28, 29 times 1 year forward. And that has been our bigger concern on these stocks. And that concern still remains.
Well, on a big idea show with a note of concern around a particular sector, but maybe some optimism around specific pockets and on tariffs. To the lady and the gentleman, thank you so much for joining in today and giving us your thoughts. Really appreciate your time.
Thank you.
And viewers, thanks so much for tuning in to 2025, The Big Idea with the Citi Think Tank.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company.
You're watching Ask Profit, a show that gets all your stock related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen right now. We have our next caller who's lined up. Ali from Delhi is calling in. Ali, a very good morning to you. I believe you have a query on Birla Cable.
Yes, madam. I have a query on Birla Cable. I'm a long-term investor.
Okay.
So last September, I bought it around 4,000 shares.
Okay.
I was expecting there'll be a lot of good move for 5G, optic fibers and everything.
Okay.
So that was my bet on. So
Right.
I would like to know, should I average it, hold it, or what should I do?
Okay, Ali, understood. This is a micro cap company with a market capitalization of around 450 odd crores. Rajesh, not sure if you have a view on this one. If not, I'll toss it to Vaishali with respect to the charts.
Well, I'm very sorry we don't track this.
Thought so. It's a very small company. And Vaishali, with respect to the charts, how is this company faring? What should he do?
So the stock has seen a lot of correction, but I would say keep 140 as the support level. We may see, if assuming market is showing signs of bottoming out, maybe we may see, because this too is an extremely oversold zone. So 140 should be taken as a stop loss, because if we see a stock falling below that, that would be really bringing in further more corrective move. So for now that he's held on for so long, continue holding with a stop loss of 140.
Okay. Just a quick answer, maybe, Rajesh, before we close that question off. Is that the best play? I would not think so, right? There are bigger players that are into optic fiber cables if he wants to play that 5G theme, what would you pick?
So you said it right. It's a very small play, and if I'm not wrong, it belongs to the MP Birla Group.
Yeah.
The only positive thing is the copper prices are being stable. So going forward, they might do some amount of good to their numbers. But it's a very small company. It's better to avoid. Better play, I would say, would be Akshakti Fiber or something of that sort. In fact, I would say why go for the maybe Sterlite would be a better play. If not, I would have to say.
Sterlite Tech, sir?
Yeah.
Okay. Yeah.
Sterlite.
Got it. All right. Yeah, and it's also a company that has seen drawdowns in the recent past, trading at about 94. Not a very large company. You're talking about a market capitalization of 4,600 crore, but still something for you to consider. All right, let's take the next question. We've got Kabir Tejwani, who's writing in from Karnataka and asking about Cyient DLM. And this is also a company that has taken quite a bit of a hit in this drawdown that we've seen across the board. It's down about 35% over the last 3 months. The question is this the right time to buy? Vaishali, on the charts, would you say that a bottom has been found?
It's totally oversold, even on the weekly chart. So this means that the stock has really corrected quite a bit. So a bounce back, for now, I would say bounce back cannot be ruled out. Look for a bounce back coming up to 500, 530, and from there on, we can have a relook.
Okay. We've got a caller from Mumbai. Manish is calling us. Hi, Manish. How can we help you today?
I wanted to check whether should I hold this Banaras Hotels.
Okay. Banaras Hotels. Can you tell me a little bit more about this company?
This is a Tata Group company.
Okay.
Listed at Bombay Stock Exchange.
Okay. And how did it get your attention?
Actually, when it was odd lot shares in the market, one of my friend wanted to get rid of it, and I just bought it, saying, "Okay, let me buy."
Interesting.
That's all.
And you're making a sizable profit in this, Manish.
Yes.
So,
very true.
Yeah, and so you have a long-term view on this?
I have already kept for more than 20 years.
Wow, sir. So what is your question, Manish?
So I wanted to know whether should I hold or sell.
Okay. Maybe even buy IHCL, with the profits that you make?
Sorry?
Would you buy IHCL if that is the advice? Indian Hotels?
Yeah, I may.
Okay. So let me go to Rajesh. Rajesh, first of all, have you tracked Banaras Hotels? It says that it is a subsidiary of the Indian Hotels company, and it is a company promoted by Tata Son. I must confess that I'm learning about this today, and I love this show because I learn about something new every day. Manish is held for 20 years. And he's making a sizable profit. If he wants to stay in the same space, in the hospitality space, which a lot of people are saying is an excellent space to be in, would you say that this is the good play, or do you say that Indian Hotels or something else?
Alexis, two things I would like to say. Even I learn a lot of things from this Q&A shows, which I do regularly for the last 20-25 years, and the kind of knowledge I would say I've gathered on mid-cap and small-cap thanks to these kind of shows only, and thanks to you guys who have helped me out. As far as hospitality sector is concerned, we are very bullish on this. We have come out with 2-3 companies covering this month only. And as far as Banaras Hotels is concerned, we have not tracked this, but as the name suggests, the hotel might be in the area of Banaras, and the kind of boom which we are witnessing due to Kumbh Mela in that area, I think this quarter numbers are going to be phenomenal. So at this point of time, one can continue to hold. As far as the entire hospitality sector is concerned, I can give you 1 or 2 picks. That's first one would be ITC Hotels, which the management has categorically said that they are going to increase 5 hotels per month, every month, and going to increase their capacity. They have a debt-free balance sheet, doing very well, and one of the best brands in the sector, I would say, with only 35,000 odd market cap, 35,000 odd crore market cap. And the other one is Park Hotels, which again has 2,500 rooms, and they are planning to make it to 5,000 rooms in the next 3 years. And they have 100 store of Floris, which they are planning to make it 200 in the next 2 years. So that is a phenomenal jump on their capacity, and it's trading at only 3,000 odd crore market cap. So ITC Hotel and APJ Surendra Park Hotel, these are the two picks from this sector which we are recommending to our clients.
Okay, Manish, hopefully that answers your question. And while Rajesh was talking about it, I was looking at the website of Banaras Hotels. It is a company that was incorporated in 1971. The company operates its hotels via the Taj Ganges and the Nandesar Palace or the Nadesar Palace in Varanasi, and it also has a Ginger Hotel in Gondia in Maharashtra. It became a subsidiary of the Indian Hotels Company in 2011. And look at that run that it's had over the last 5 years. It's quite spectacular. Yes. I'm glad that you brought this to our attention, Manish. Thanks so much.
Thank you. Thank you so much.
All right. The next query that we have is on Northern Arc Capital. Vipul Seth from Ahmedabad is holding around 120 odd shares at an average cost of 267. So he's sitting on a loss of about 11,500. He wants to know whether he can book a loss or accumulate more for an average price. What's the long-term view with respect to this? Rajesh, I'll again come back to you. Northern Arc Capital is the counter. What's the view?
Since the recently listed company did very well on listing, but at this point of time, I think all the positives have already been discounted in the prices, and no meaningful upside can be expected in the near term unless something very big happens in the results or some corporate action. So it's better to try to exit on every rise. Maybe a better NBFC company would be like Geo Financial or a Poonawalla, even Bajaj Finserv would be a better play than this.
That's the view with respect to the counter. The next caller is lined up. Santosh Kumar from Hyderabad is calling in. Santosh, a very good morning to you. How can we help you?
Yeah, thank you. Thank you, NDTV Profit. Yeah, I'm from Hyderabad. So I'm currently holding Pixicom Telesystems, 120 shares at an average of 268 rupees.
Okay.
So I just want to know whether I should average it out right now because it looks like the stock is getting recovered. So just
okay, got your query, Santosh. Vaishali, I'll quickly come to you. Exigom Telesystems is the counter. What are the charts looking like and what's the stop loss and resistance?
Well, if he has to make an entry now, today, then I would say keep a stop loss of 158. Because again, like all stocks, this too has been beaten down, but there is no sign of a reversal as yet. But if he still wishes to buy, 158 should be the stop loss to observe and wait for the stock to move about 200 levels. That would bring in some clarity as to whether the stock is ready for a good bounce or no. So right now, I would say 158 to 200 is a range to observe.
I do want to draw your attention to the markets right now. You have gains that have given up at this point for the benchmark index, down actually just about flat and off the high point of the day. Mid-cap index is also off quite considerably off the high point of the day, now trading with gains of about about 1% or so. Small cap index is given up a little bit of ground, still trading with gains of 1.5% or thereabouts. But one stock is catching my attention, and I do want to ask Vaishali what she thinks about Tata Consultancy Services. Vaishali, it was one of the IT stocks that underperformed yesterday, ended about 0.8% lower, while the rest of the pack was looking reasonably strong, and it's down over 2% today as well. Anything that you're seeing here that should be paid attention to?
So I guess with all these new policies coming in, and I think IT sector is beaten down today. And today, the way we are seeing all these stocks going down, I think this can go towards 3,500, 3,400. Today, intraday support, we can have a look. 3,700 acts as a support. But if these levels break, then 3,500, 3,400 cannot be ruled out. So IT sector is quite under threat right now.
So that's the view coming in with respect to TCS. The next counter that we're talking about is Ujjivan Small Finance Bank. Jay from Andhra Pradesh is writing in. He's bought around 130 odd quantities at an average price of 42, and he wants a long-term view with this counter. Rajesh, I'll come to you. What's the view with respect to Ujjivan Small Finance Bank?
The numbers have been pretty bad. Performance is bad, and AMs are falling, and there are a lot of concerns about the small finance bank. although they are going for a reverse merger and all, it's better to switch to a full-fledged bank, maybe in a mid-cap, one can go for Bank of Maharashtra, or in a large cap, one can have a look at ICICI Bank or a Kotak Bank. That would be a better choice, I would say.
So that's the view with respect to Ujjivan Small Finance Bank. The next caller that we have is Anant from Bengaluru. Anant, a very good morning to you. How can we help you?
Good morning, Mahima.
Good morning.
I was holding NIBE.
Okay.
22 shares.
Right.
It's a small cap company, and this quarterly results were not that great.
Right.
So the stocks have fallen a bit more.
Right.
I would like to know fundamentally how is this, and I also see that the order flow is really good.
Right.
However, the results were not great. And I would like to know fundamentally, is it better to hold? And my plan was to I have 22 shares currently, and I wanted to buy more and make it around 50 shares if it is really fundamentally good and worth holding.
Right.
So this year I want to make it to 50 shares at least.
Okay.
So I just wanted to know a fundamental view on this. Is it worth holding? That's what I want.
Understood. I got your query. If I'm not wrong, it was, there was a contract between Premier Explosives and, this NIBE as a company, which kind of boosted the stock in December. But since the market sentiments overall are, not doing well, and Q3 did not work well for the company, as you rightly mentioned, Anand, the stock is tanking. Rajesh, I'll come to you. It's a small company, but if you have a view from a longer term perspective, is it a good counter to have in your portfolio?
See, I don't think it's the kind of stock one should have in one's long-term portfolio. Although the company is into the right space, I would say aerospace doing good, but the capacity is very small. Market cap is very small. It's better to be in large cap names at this point of time when we see that defense stocks have corrected by around 50-60% from their tops. There are better choices available. We were discussing sometimes back in our show only BEL, that would be a better choice, or a BEML, rather than putting new money into NIBE. In fact, I would say if you are sitting in profit, why not switch from here to there?
Switch from NIBE is the view. Just about 1,500, 1,700 crore market capitalization of this company. All right, the next one is something that was on our list in the morning. Let's pull up RVNL and see where it's currently trading. If I remember correctly, 500 plus crore order is something that it has gotten. Wow, it is rebounding and rebounding. How? It is a stock that got beaten down post the budget because there were certain expectations that perhaps were not spoken about immediately, but then you are seeing a bounce back as things stand right now. The question is from Bhanu Prakash, who's bought at an average price of 425 rupees per share, and so is is seeing some losses at this point. 200 shares is what he has. Long-term views being sought. Rajesh, would you average your price right now on the upside? What would you do?
See, if I'm a long-term investor, I'm going to average it. The numbers have been good. They have said that around 25,000 odd crore target for next year. And some of the projects are nearing completion that they are going to add to their revenues. So it's fundamentally it's a strong company. But again, the same thing happens because entire railway pack defense is facing some pressure from their upside, and that might continue for some longer period of time. But for an investor, long-term investor, these are good times to accumulate stocks. So from my side, if you are a long-term investor, yes, it's a good time to accumulate.
Okay. All right. Tejpal Reddy is calling us from Hyderabad. Hi, Tejpal. How can we help you today?
Good morning. I like the way you carry this smile throughout the show. Very positive.
Thank you so much. Very kind of you.
I've been holding 200 shares of Jata Patents since few years. It was all-time high of 3,500 and it came all the down to 1,500. I forgot to book the profits when it was all-time high.
You forgot.
Should I continue to hold?
Tejpal, you forgot to book the profits. Is that it? You were not looking at your portfolio?
Yeah, I mean, I thought it will go much higher. I never thought it would come down almost like 70%.
Okay. No, I mean, okay. On the way up, you forgot to check, and maybe you forgot to check when it hit the all-time high. But I get that.
Small quantity. I was holding bigger shares like Tata Motors and all. I put 20-30 lakhs in Tata Motors and Kitix Garments and all. So I was just thinking it's a small investment.
So, yeah, I mean, Tejpal, I hope that this is a problem that you continue to have when you have a 1.7 lakh plus profit that you don't pay attention to. And I'm glad that this is a problem that you have. I hope that this continues to be a problem that you face. But let me go across to Vaishali to give you some perspective on what to watch out for. Data patterns, Vaishali, 700 rupees, small profit for Tejpal. What should you do with this?
According to me, the worst is over. So, but yet, nevertheless, the same. I think keep a stop loss of 1400 and continue holding, because once we see a good bounce coming in, this in all likelihood once again will come towards 2200 to 2700 levels. But now because he has held it for the worst of the times. So I think the worst is nearly over as far as the technical charts are concerned. But yet, I would say keep a stop loss of 1400 and continue holding.
All right, so that's the view coming in with respect to data patterns. The next query that we have is from Nidhi. She's from Ambala, and she wants to know the view with respect to Vedanta from a 6 months horizon. She's holding 270 odd shares bought at 426 a piece, and she wants to add more. Also, it's worthy of noting because today is the day when creditors will actually take a vote for the demerger of various business of Vedanta, and she wants to know with respect to she's a long-term hold. No, she wants to know this from a 6 months period horizon. I'll take both views on this particular counter because lots happening here. Vaishali, first with respect to the charts, is this the right time to enter Vedanta?
So 390 is a very prominent support. Just few days back, we saw it going towards 400 levels. So I don't know whether it's going to retest those levels or no. So I would say accumulate. If it falls further down, 390 should be the level to be looked at. Keeping that in mind, start accumulating.
And Rajesh, your view with respect to the entire demerger that's taking place?
See, first, the company is a full-fledged play on the entire metal space. I would say they have zinc, aluminum, copper, everything under their belt. The company has been doing well, giving good dividends. It's a strong dividend play too. And now this demerger story is again a value unlocking thing. One can go long in this.
So that's the view with respect to Vedanta. We have our next caller, Ramesh from Karnataka is calling in. Ramesh, a very good morning to you. I believe you have a question on Kalyan Jewellers.
Yes, ma'am. Actually, ma'am, I bought 250 shares last week, ma'am.
Right.
For 567 rupees.
Okay.
And I have sold yesterday, day before yesterday, I have sold it for 501.
Okay.
So I have lost already 67 rupees.
Okay.
And again, I have purchased yesterday, I have purchased it for 492.
Okay.
But still it's not improving. Is there any chance to improve in future for next 2 or 3 months? If I hold this stock, is it okay?
Okay, what's the number of shares that you're holding currently?
250, ma'am.
250. Okay, I don't think then the loss number is correct. But okay, so Kalyan, so you want? Did you see the charts while buying the counter, or you saw the fundamentals of the company? Because if you're booking, you've already booked a loss once. I believe it's the charts that you're observing.
Yes, ma'am. But in the chart, in the last 52 weeks, it has gone up to 794.
Right.
I thought at least it will go up to 650, but
right.
due to this market crash, it has happened. So.
Okay. All right. So then I think then our team just conveyed that the loss that is mentioned is correct. It's around 1.5 lakhs right now. Okay, sorry, my bad. 1.5. Oh, that's 1500 then. Okay, my bad. All right, Vaishali, I'll come to you because he's seeing the charts. As he mentioned, this stock was a street darling at one point of time. The kind of momentum it has seen was quite significant. But then a lot of things happened with respect to the company, and the stock is seen tanking since then. What are the charts looking like right now, and what should he do with respect to the buy price that he's entered at?
So the stock is showing signs of improvement. Technically speaking, it is in the process of making a higher bottom formation. So I would say, there is still not much of a clarity. Keep a stop loss of 450. And if the stock has got meaningful strength, then this can show a bounce coming towards 550 to perhaps even 600. 600 should act as a very tough resistance. So I would look at the stock like this, keep a stop loss of 450 and continue holding and wait for it to bounce.
All right, so that's the view on Kalyan Jewel. I was just offering my glasses to Mahima because she couldn't see the number on the screen. All right, let's talk about the next question. Hari is calling us from Chennai. Hari, hi, morning. How can we help you today?
Hi, Alex. Good morning. This is Hari again from Chennai.
Yes.
It's nice talking to you again.
My pleasure.
Alex, my question is regarding this PNC Infratech.
Okay.
I just started buying this somewhere around 470 or 480, and I accumulated when the price falls. Say I have currently around 50 odd of PNC Infratech around average price of 420. I just want to understand whether we can accumulate this stock at this price as the North ban is also lifted. I saw some news, but I don't see any news around the topic. So I'm just wondering whether we can go ahead with a small cap or we can switch to some bigger names like L&T in this space.
Okay. So for people that are not familiar with this, this is a company that is operating the EPC space, engineering, procurement and construction. Specific to your comment on the regulatory update, let me go across to Rajesh. If he's been tracking this development and if he has a view on PNC Infratech. Rajesh, what would you do with this if you bought at slightly elevated levels? 422 is a buy price. The stock is currently trading at 260 or thereabouts. What would you do?
Since a strong play on highways and roadways, I would say they're doing very well. Order book has good. Numbers have been fantastic. The only problem the stock has been because of market condition. The entire market has seen a beating. Mid cap, small cap have seen a cut of 40-50%. So at this point of time, somebody holding can continue to hold. But as the gentleman said, he wants to add more or put new money into infra space. I would say L&T, as he said, would be the best play with 5 trillion order book. I think no doubts L&T is the market leader and the best play in this space. So for your continuing holding, existing holding, you can continue. And for new money, you can put in L&T.
And to the update, this is actually come through a while back. Feb 6th was when the announcement happened. So yeah, you're absolutely right. The disqualification period for PNC Infratech from the Ministry of Road Transport and Highways and for the company, 2 of its subsidiaries came through and it's reduced to 4 months from 1 year. So certainly something that you should keep on your radar. It's time to hit the rapid fire segment, and this is where we throw as many questions as possible at our experts for a period of 2 minutes. Both of you, please brace yourself and give me as concise answers as you possibly can. Hindustan Copper is the first counter that we're talking about, and Sadanand wants to know, he's bought at levels of 305. Should he hold or book losses? The question is for you, Vaishali.
Hold.
All right, Tanla Platforms is the next counter. Saiti from Bengaluru is sitting on a loss of 60,000 in what she's saying. She wants to know what's the kind of growth outlook for this particular counter. Rajesh, what's the view?
Strong outlook, one can continue to hold.
Delta Corp is the name of the counter. Bought at levels of 156. Long-term investor Siddharth is asking about this. Should you hold or sell? Rajesh?
I would try to exit on upside.
All right, CEAT is the next counter. Shresh from Raipur is holding 50 shares bought at 3,200. He wants to know what should he do next. Vaishali, on the charts?
Hold.
Triveni Turbines, 300 shares bought at 566. Rajiv wants to know whether to hold or exit. Vaishali, on the charts?
I would say hold.
All right, Blue Jet Healthcare is the next counter. Rishi from Oman has 250 odd shares bought an average price of 350. Should he hold or book profits? Vaishali, on the charts?
Hold.
Trident Limited, 41.49 is a buy price. Saurabh Munoth from Pune has bought 1,200 shares. Lost ground. Rajesh, what would you do?
Try to exit.
All right, Bharti Airtel is the next counter. Gul is asking at what price a fresh entry can be made. Please suggest. Vaishali, on the charts?
So it's right now at a make or break level. So I would say accumulate with 1600 as support.
Okay. Tarun from Bengaluru is asking about Zentech. Stock in focus. It's lost ground, but it's up and about in trade today. His buy price is 441. Should he continue to hold? What's the view, Rajesh?
Continue to hold.
Okay. All right, unfortunately, we're out of time on the rapid fire round. Thank you so much, Vaishali and Rajesh, for joining in, for answering all the questions you did. Always a pleasure having you. That brings us to the end of Ask Profit. Thanks so much for tuning in. We tried and answered, or got as many questions answered as possible. We've got more lined up over the course of the day. In fact, we're talking about Zentech on KYC, so do stay tuned.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE listed company every single day. Well, today we're talking about a hospital, and one of the first hospitals to be listed on the Indian exchanges. Not the first, but certainly one of the first. That's Narayana Hrudayalaya. Well, we've been talking about this particular hospital for a while. We've been tracking the company, and we thought that it would be a good idea to, in fact, talk about the fundamentals and the ins and outs of this particular hospital, as well as how things have shaped up for this particular hospital company over the course of the last few years. So firstly, well, as I mentioned, it has a network, or rather this particular company has a network of multi-speciality and super speciality hospitals spread across many locations in India. As one might expect, it's called Hrudayalaya. By the word Hrudayalaya, or rather Hruday means, well, heart, and Alaya is, of course, house. So it started off as a hospital that specialized in heart surgeries and heart operations. Of course, through the course of the many years, it's also widened its ambit with respect to, well, many specialities. And at the moment, of course, it also deals with several of them. Well, in terms of the current capacity, it has about a little over 6,300 beds. And it has about 42 healthcare facilities across India. And in terms of operational beds, of the 6,300, it has about 5,900 beds which are operational. It's going to be an important one to keep an eye on as to what the plans of expansion are for this particular hospital, and which are the other areas, which are the other geographies that it does, in fact, look to move out and to move in. But for now, as we always do, well, we talk about the fundamentals of the company, and we give this particular company a rating. So what we usually do is that based on the ratings, we talk about your revenues, we talk about the profitability, and all that will be a part of the income statement. We also talk about the balance sheet, as well as the cash flows, and of course the return ratios too. Well, followed by that, we also talk about the shareholding valuations, street coverage, as well as street cred. And for that, well, I'm also joined by Varsha, who's going to give us an update on the same as well. So while I do have Varsha come in and talk to us about that, and as I've already mentioned, that the company focuses on many specialities, and we talk about several of these other factors. Again, we'll be watching out for the income statement and how that pans out, because that's exactly what I want Varsha to take up and talk about while we do have her. So Varsha, welcome to the show, and thanks for joining in. Let's start off by that exact factor.
Yes, Agam, thank you so much. Let me start with, income statement, how the company has done in the last 3 years, when it comes to the financial numbers. So if you see the revenue, so the 3 years CAGR for this company has been 25%, good uptick in EBITDA. EBITDA margins, if you see, has been ranging from, 18 to 23% for the company. Net profit, well, you're seeing almost 365% of CAGR in the last 3 years for the net profit. Also, because of increase in the EBITDA margin is one of the factors, and also the change in product mix that the company has done. And so overall, if you see a very good set of numbers that the company has seen, and the highlighting point here is, if we will talk about this later also, the ARPOB, which is an important metric for any hospital company, that is average revenue per occupied bed. For Narayana, if you see, the ARPOB is actually very low as compared to other hospitals. Still, this company has been delivering good, operating margins, or beating operating margins as compared to its peers. And so a win-win situation has been for this company. And because I'm speaking about the financial numbers, let me just also highlight its Q3 numbers. So overall, if you see their international business in the Q3 dipped 50%, but that was offset by the domestic business that the company had, almost double-digit growth, almost 18 to 19% growth in the domestic business that the company did. And also the Cayman Island for the company improved, which was dragging the overall performance of the company, though Cayman Island is little margin dilutive for the overall operational margins for the company. But overall, Agam, if I were to talk about, if I were to give the ratings, for this company, I think it's pretty good on the financial parameters that the company has shown.
Yeah, so it's a thumbs up for the income statement. Let's talk about the balance sheet then. And, we must remember that while there is a slightly higher debt on this particular hospital company's balance sheet, where in fact your reserves stand at around 3,200 crores, your debt stands at around 1,500 crores, well, a lot of this is being used for expansion. So the debt number does look high, but we're not going to give this a thumbs down. We're going to give this a neutral rating, because it is in fact, well, trying to lever itself in order for it to expand into many markets, and of course put up more beds in hospitals in general. That said, in terms of its cash and cash equivalents, the number is not a small one. It still has about 300 odd crores in its books. So on a net debt basis too, that number doesn't look like a very large one. But again, it's going to be a wait and watch as to how and where they use those 1,200 odd crores of net debt as far as this particular company is concerned. So, well, pretty steady, but we'll give it a neutral rating as far as the balance sheet is concerned. Varsha, now let's talk about the cash flows here.
Yeah, so, so Narayana actually enjoys good, strong cash flow, sufficient to take what are its capacity expansions. So they have a capex outlay of around 4,000 crores in the next 3 to 4 years, and the benefits of last 10 years, the work has been started, rather the benefit has been started for the work that they did in the last 10 years. So overall, if I were to talk about cash flow, the cash flow from operations stand at around almost 1,000 crores, while net cash flow is 97 crores. So, so in hospitals, what happened, especially in Narayana, which is more into, greenfield hospital. So it has enough cash flows to, sort of have their capex plans, which I just said that they have 4,000 crores in the next 3 years. So overall, a good show when it comes to cash flow that the company has given. Yeah.
Sure. All right. So that's as far as cash flows go. Let's move on and talk about some of the other factors here, and we'll talk about return ratios. Since we have the income statement, the cash flows, as well as the balance sheet out of the way, we talk and take a look at how your return ratios are panned out. So I'm going to talk about the return on equity or return on net worth specifically in this case. And firstly, they are well above the mark of around 20 to 25%, because that's a thumb rule that we move around with when it comes to the ROEs. And at the moment, their return on equity stands at around 31.5%. It has come off to a certain extent, but it is still at a very healthy number, at a very healthy level, and which is why we'll give this one a thumbs up as well. It's come off from around 33.5%, but still a substantially higher number, which is why it's a thumbs up. And now let's talk about something more interesting. So we've spoken about your various financial statements. We've spoken about a key ratio there as well based on those statements as well. Let's move beyond and talk about the other fundamentals of the particular company, and which is why I'll get Varsha to talk to us about the shareholding here as well. Varsha?
Yes, so actually very interesting, if just starting with the promoter bit, so you have 64% skin in the game kind of thing, which is a good thing. And FIIs, so 9.5% of stake is held by FIIs, followed by DIIs, which is at 8.7%. Now FIIs, especially FIIs, go or invest in the companies which has a good management pedigree and one of the reasons, and good corporate governance. And Narayana Health is one of the companies which has both of these qualities. And one more interesting thing over here is, Agam, that Kiran Majumdar Shah is the one of the investors in this company, having almost more than 2% of stake in the company. So when it comes to overall promoter holding, actually very good. All the parameters fit for this company. You have skin in the game, number one. FIIs are have a good stake in the company, followed by DIIs, and Kiran Majumdar Shah being one of the shareholders in the company. So overall, when it comes to shareholding pattern, we would rather give a thumbs up for this parameter.
Okay. So a thumbs up for, well, as far as your shareholding pattern is concerned. And from there on, well, we move on to talk about the valuations, because this is the other very, very interesting piece here. Varsha, why don't you take us through, the valuations, and especially keeping in mind the other factor which is also played in favor of margins, that is the RPOBs.
Yes, absolutely. So just, speaking about the valuation, so if you see, Narayana is trading at 36 PE. If you consider Max Healthcare, Fortis are trading at a premium valuation. Now, one of the reasons over here is RPOB, average revenue per occupied bed. So if I were to talk about the RPOB numbers, so you have Narayana Health, the RPOB for Narayana stands at around 42,000 rupees per day. For Yatharth is 30,000. For Apollo, it's almost 61,000. For Max, it's the highest. It's 77,000. One of the reasons why Max has a premium kind of valuations given by the investor. That's one of the reasons. Of course, Max has capacity expansion plans. They are on the capex free, number one. And if you see the Medanta also has almost 62,000 of RPOB. KIMS has little lower of 38,000, and that's actually showing when it comes to valuation. So for Narayana, that's trading at 36 PE on the trailing 12 months basis. While if you see Yatharth is at 29, while Fortis Health, which also has a higher RPOB, is trading at 58. Apollo Hospital is trading at 70. So, but talking about Narayana, one thing is when it comes to peers, they are trading at a very low price to earning ratio, and despite having lower RPOB, they have given a good kind of financials in the last 3 years. So overall, compared to peers, they are actually trading at a discount. And but the point is, Agam, they have always been traded at a discount, being the cost efficient kind of hospital that you were actually talking about while discussing about this company. So they've always traded at a discount to relative to their peers.
Right.
And
So
I don't think so that Narayana will ever go to an ARPOB of 77,000. That's never gonna happen when it comes to Narayana.
I mean, down the line, comparatively, when Narayana does go to 77,000, you never know. Maybe Max Healthcare at that point in time will be twice as much as what we are seeing right now.
So there's gonna always be a margin between
a differential between Narayana Hrudayalaya and Max Financial, of course, based on the current strategy which both these respective hospitals are following. But no point taken, Varsha, as far as your valuations go, as well as your average revenue per operating bed is concerned as well. I'll tell you about the analyst coverage and what they make of it based on the current valuations, as well as what we have in store with respect to the current market price. So we do have about 13 odd analysts covering this particular stock, and out of these 13 analysts, 10 of them have a buy rating, while one of them has a hold and 2 of them have a sell. The reason why we are going with a neutral on this one is because the upside is not significant from current market levels. So while Varsha mentioned, sure enough, that the valuations are not very high, certainly not as high compared to some of the other peers, but the upside indicates about a 7.2% from current market levels, given the kind of discount that the company is going in. And that's the reason why we're going to give it a neutral rating for this one. But how have the share prices done for this particular stock, Varsha?
So in the last 1 year, Agam, the company has given almost like 1.4% of return to its shareholder, versus if you see the mid cap 150, it was up almost 2%. But in the last 3 years, the company has doubled the investors' money. That's around 115% kind of return. So overall, a neutral kind of rating we would give when it comes to the returns that the company has given to its investors.
Yep. So there you have it. In comparison to the mid cap index, well, not the best, mostly in line with the mid-cap index, which is why we're going to give that one a neutral too. So let's tie all these factors up to take a look at how things have in fact panned out for Narayana Hrudayalaya in terms of the NDTV profit rating. So firstly, when it comes to your key financial statements, it's a thumbs up for the income statement, cash flows, return ratios, balance sheet are neutral, but that's also because, they are looking at expansion. Good shareholding, very well held company, valuations look good as well. It's a neutral for street coverage and street cred, so no thumbs down. But that brings us to a total of around 6.5 out of 8 at the moment, which also is not a bad rating at all. It's very close to the mark of 7, which which is slightly on the higher end as well. So certainly in a good space as far as this particular company is concerned. A lot will depend on the outlook. And speaking of outlook, we'll get you the management of the company in just a bit. But before that, want to take a look at what a handful of these broking houses are also saying about Narayana Hrudayalaya. So, firstly, I'm going to talk about not just Narayana Hrudayalaya, but the hospitals in general. So we do have a Jefferies report, and they say that brownfield expansion overrule greenfields expansion, even though I believe that Narayana Hrudayalaya is doing a little bit more greenfield expansion as compared to brownfields. And at least Jefferies is suggesting that Max and Fortis are looking at that kind of expansion, which will lead to about 20% EBITDA CAGR. But Varsha, if you can shed more light on this very aspect with respect to capacity expansion going on.
Yes, so actually, Agam, on the street, if you see, investors are more inclined towards hospitals going into brownfield capex versus greenfield capex, because there you don't have to put much of capital. Already you have your hospital, you just have to put up a building there or put up a floor there. So the capex outlay is not that much, and then margins would also improve for the company. So investors are actually picking for that. So for Jefferies, which you are talking about, the Max and Fortis they are their top picks now. Why? Because of the brownfield expansion that the company has been going. Like I said, that Max has a very, very high, or rather aggressive expansion plans that the company has set out, and because of that the potential upside in EBITDA is almost 20% CAGR. Strong volume growth is expected in 2025, driven by the new bed additions that all the hospitals are going into, including Narayana, if the brownfield capex is actually preferred, and Max has the most expansion plans, followed by Apollo, Fortis and Medanta. Now this is as per Jeffries, and ramp up is actually a key factor when it comes to, because you have set the capex, you have laid down all the beds, but now you have to ramp up that capacity, which will actually flow down into the financials. If I were to talk about the brownfield and greenfield, which is a key highlight of this report, Max and Fortis are favored because of the brownfield expansions versus Apollo and Medanta, which is more into greenfield. And RPOP growth, if I were to talk about, they are expecting mid-single digit RPOP growth expected due to new beds. Now, because the new beds have come, the RPOP will little go down unless the expansion is, or rather the utilization is very high. And payer mix optimization to slow or decline, but brownfield cost advantage will actually offset all this.
Right. Well, fair enough. Well, on that note, let's hear from the management itself. Well, we have caught up with Sandhya J. She's a Group Chief Financial Officer at Narayana Hrudayalaya, talking about the quarter gone by and the road ahead. Listen in.
So we have historically indicated that the international business is a temporary phenomenon. Eventually, it will decline. It is not our focus from a growth driver point of view. And we also believe that there will be the geopolitical conditions will play out at some point in time. Just that it played out much faster than what we had anticipated because of the political turmoil. We are seeing some footfall coming from the international patients now. The visa restrictions have been relaxed to an extent. So there is some sort of a recovery we are seeing, but we are not counting on that recovery for our business outlook. Our focus continues to be domestic business. And if you see our domestic numbers for Q3, we have shown a very healthy growth on the domestic business. So while international, like you rightly said, declined 50%, the India book of business grew by 18.7% YOY. So we will continue to pivot on that, and we'll try to continue to grow our domestic business further.
Got it. Speaking about the domestic business, I was actually on to ask you that. So what's the outlook there? I mean, for the full year, that is FY25, and of course for the next year, FY26. Now, because you are seeing some pressure in international business, what is the outlook in domestic business? Where you want to take this growth to?
So there are two layers to the domestic business. One is the organic growth that comes because of better patient footfall, improved throughput, improved payer mix. And the second is the inorganic growth for the business, which comes from capacity addition and expansions. So as far as the organic book of business is concerned, I think that will be the trend for the next 2 to 3 years, where we are going to continue to keep driving better throughput through the system and keep trying to aspire for meaningful growth, as you have seen in the past few quarters. As far as the inorganic business is concerned, we have indicated that we are going to add at least 1,400 beds over the next 3 years. These are confirmed additions, which are capacities we have locked up. And we are also looking at more opportunities in pipeline to increase our bed count. Our bed count will be focused around Bangalore, Kolkata and Raipur to start with, because those are our strong markets and where we are able to get much higher confidence in terms of our growth ambitions. Once we have exhausted the potential of these markets, then we will start looking at the next set of markets.
Got it. Also, Sandhya, how has been the occupancy this quarter? Number one, and since you more focus on revenue per patient, so wanted to know how has the trend been there, and what's the outlook in both the cases?
Sure. So historically, we have not measured occupancy as a key measure. We always say that occupancy is a little misguided because it does not take care of the realities of the business. Having said that, our occupancy is normally in the range of 60 to 65%, and in a quarter like Q3, which is seasonally a weaker quarter for us, it typically comes in at the lower end of that. Now, as far as our ARPP, which is average revenue per patient, is concerned, we have seen a healthy growth in our ARPP, both year-on-year and quarter-on-quarter, and we believe that this trend will continue, not because of price. As you are aware, we don't look at price as a very significant lever for ARPP growth. We do take price increases, but they are low single-digit price increases. But the growth is coming from a couple of factors. One is the improved payer mix and better realization from the existing patients. And the second, which is coming through, is being able to keep moving up the value chain in terms of the type of the procedures that we are doing. So both of it is coming together and contributing to the ARPP growth that we have reported on.
Got it. Sanjay, talking about Cayman, so if I'm not wrong, the business over there has improved. So what's the outlook there? Because you have this new multi-speciality hospital also which came up there.
Yes. So our hospital got commissioned in the last couple of quarters, and we were working through all the approvals and starting up. So in Q3, the most of the OPD started getting done from the Camana Bay Hospital, though IP took some time and we had only a few weeks of IP service coming out of the hospital. But the full costs of the new hospital was on the baseline, and to that extent, you are able to see that little impact on the margins. Having said that, the hospital has gained good traction, as we are seeing in January. We are seeing good throughput, good volumes, and a healthy growth trend in the hospital. So we are anticipating to break even and start delivering good performance much ahead of what we had originally projected.
Got it. And what was the growth there when it comes to Cayman?
So this quarter, if you would see for Cayman, we had a substantial improvement. Our revenues were 30 million, same 30.5 million, same quarter last year, 29 million last quarter. This quarter, we had a $35 million revenue coming out of Cayman. This, like I said, was one, the existing hospital also improved, and the new hospital also started picking up good traction.
Sanjay, on the margin side, because the margin dilution, if you see, is mostly caused by Cayman. So what's the outlook when it comes to margin? Because it was little lower than last year.
Yes. So there are two reasons for the margin dilution. One, of course, is there is some dilution coming from Cayman, given that Cayman has got all the costs on board and the revenue is still coming in. So there is that little bit of recovery time that comes through for the new hospital to fully be able to deliver. So that is one part of the margin dilution. The other part is the integrated care business. As you know, we are reporting out 12 to 15 crore of cash burn every quarter in the integrated care business. This is the new book of business we are building with clinics and insurance. And that is also causing some of the margin dilution, which we believe will continue into a few years because this is a new business line we are building and it will continue to dilute margins for some time. But we are of the hope that our India business has shown steady margin growth over the past several quarters and will continue to be able to keep up with that trend, and Cayman will also start recovering, and therefore our outlook to margin is positive.
And that is all the time that we have for this edition of KYC. But stay tuned for more. You're watching NDTV Profit.
भाषण सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर
Hello and welcome to Profit Buzzers. This is Anushi Vakharia and with me is Varsha Chandnani. We'll take you across to the what's happening in the markets and the key stocks which are in focus today on the back of updates and developments taking place. But before we do that, let's take a quick look at how the markets are doing currently. In terms of where the benchmark indices are headed, let's pull out the Nifty 50 chart, currently seeing gains of around 0.11%. Now, in the past few sessions, we've seen Nifty remaining range bound, seeing a flat sort of a session, but today it is in the positive territory as we are seeing, clocking in gains and holding ground as well. Let's see some of the key contributors leading to this gains that we are looking at. We have the likes of ICICI Bank, L&T, Axis Bank, some of the counters in the green today, while TCS enforces some of these IT pack is in pressure because of the revenue guidance and the outlook given by Capgemini. Bharti Airtel, HUL, some of the other counters in pressure in trade today. Well, this is in terms of where the key contributors are in terms of the losers and the gainers in trade today. But let's also see how the sectoral indices are faring in trade today. Now, one sector which stands out today is the Nifty Realty Pack. In fact, if we have seen in the previous few sessions that the Nifty Realty Pack is the one of the worst hit sectors after the correction which has taken place in the market, up over 2% in trade today, while PSU banks and media is also clocking in gains of around 1.4%. Now, IT under pressure on the back of the Capgemini outlook given, seeing cuts of around 0.72%. Pharma also another standout of a sector, seeing cuts of 0.6% after Trump tariff impositions of around 25% on the pharmaceutical pack. So there you go, that's the overall breadth that we are seeing in terms of where the benchmark indices are concerned. But Varsha, it's a solid recovery that we are looking in terms of where the broader market indices are, right?
Yes, actually. So broader markets are mirroring, benchmark indices as well. If I were to talk about Nifty Midcap 150, it's up almost 1.3%. If just a constituents, let's talk about who are the gainers when it comes to, Midcap 150. You have Tata Invest. You have RVNL, which is up because of the order win that the company has seen. But in the last 1 month, if I were to talk about RVNL, the stock was down almost 31%. So good recovery there. You have Masdok, actually even Cochin Shipyard, all defense stocks are in fact buzzing today. You have Zentech is also, I think, in the last two sessions, Zentech was down almost 30-40%, but good recovery when it comes to, there you go, it's almost 10% up in trade. Then you have BSE also, which is one of the gainers list when it comes to, Midcap 150, Nifty Midcap 150. If I were to talk about losers, now all the pharma stocks are actually, under pressure. On the back of Trump tariffs, potential Trump tariffs of 25%, as Anushi said. But, Aurobindo Pharma is one of the losers when it comes to Nifty Midcap 150. Now, one is, of course, the Trump tariffs, and the other thing is the US FDA observations received by the company. We'll speak about that as well. Then Lupin is also under pressure because of the Trump tariffs. Then you have CRISIL, which is, dragging the Midcap 150. You have NLC India, you have Ajanta Pharma, again on the back of Trump tariffs, and Glaxo. Yeah, so pretty much, mirroring this benchmark.
Well, that's where we are looking at the secondary markets, but also let's shift focus to what was happening in the primary markets. Now, we have a new market debutant in focus, and that's Hexaware Technologies. In fact, Rucha, we were discussing about this, and we are also going to have a chat with the management. So go ahead, carry on.
Yeah, so Hexaware is in focus. Actually the whole IT pack, as you mentioned, is in focus right now, but let's currently focus on Hexaware Technologies. We'll talk about the final subscription. The total subscription came in at about 2.3 times, wherein the QI piece was at 9.55 times. The key investors include mutual funds, which hold about 8.25%. Of which HDFC MF holds about 1.84, and as you can see on our screen, the issue size is 8,750 crore rupees with an offer for sale of the entire issue size. So the kind of the opening price, the issue price was at about 674 to 708, as you can see on our screens. These are the kind of financial matrix for CY 22-23 and 9 months of FY25 over here. But To talk to us more about this, we are being joined by the management of Hexaware Technologies, Shri Krishna Ramakarthikeya, the Chief Executive Officer at the company, and Mr. Vikash Kumar Jain, the CFO of Hexaware Technologies. Well, thank you so much for joining us, gentlemen, and congratulations on the debut that you've made today.
Hello.
A stellar one that we could see. My first question to you is, of course, will be the kind of listing, the markets are taking a toll. It's a bloodbath all across, and a listing over here is I mean, it's a brave move. So I would really want to ask you about the kind of growth prospects, especially in an IT environment wherein people are not very sure where IT will head from here on. So what are your views, number one, on growth in the near term and also on the kind of margin expansion?
So three things, okay. First is, I think a tepid or a volatile market is a great time for investors to join great businesses like ours, okay. And we're not worried about market downturn for 1 week or 1 month. We are focused on delivering outstanding performance every quarter for the next 10 years. The stock price will take care of itself. Now, immediate demand, I think, is improving, has been improving now for 2 or 3 quarters consistently. I think Trump administration policies or likely policies are all a net positive. Okay, ultimately the animal spirits from potentially reduced regulation, stable tax environment, support generally business-friendly environment, I think far outweighs any potential negatives from tariffs, right? Also specific to our business, manufacturing sector, which is most impacted by tariffs, is only 16% of our revenues.
Okay, Mr. Vikash, if you can give us some kind of outlook on the margin front and on the organic expansion front. What kind of growth are you looking forward to in the near term? Because I'm sure investors are more concerned about the near term than a medium term in this kind of market.
Well, I'll generally say that our ambition is to do better than what we've done in the past. Okay, last 10 years CAGR is just shy of 13%, and our ambition is to do better organically. And then we have a war chest for acquisitions, and I think you add on top of that, I think that's clearly our ambition. We also set a medium-term goal for us to get to a $3 billion revenue. Okay. And so that's what our growth ambition is, and we feel good about an improving demand environment.
Improving demand environment is what everyone.
I'll just say that.
Go ahead, sir, please.
So, I was just saying to your question in terms of the margins. We delivered in the last year, in the CY24, more likely than not, close to 17.4% adjusted margins from an EBITDA. On a go-forward basis, our margins are going to be in the range of 17.4%, or around about that. More from a reported perspective, we won't have any adjustments because all the one-time adjustments would be closed within CY24 primarily.
Okay, understood. So just to give our viewers a kind of intimation wherein this is a calendar year basis financial that Hexaware is reporting. So are you looking forward to, maybe reporting on a financial year basis, Mr. Vikash?
We haven't thought about it. I mean, there might have been some history. Don't know exactly the reason why calendar year was chosen, but there are some advantages associated with it, particularly in geographies outside of India. So we haven't given this a serious thought.
Okay, and as you mentioned, Mr. Sri Krishna, that your exposure in the manufacturing side is important for you. Can you give us some more kind of a split with respect to vertical and also with respect to manufacturing? Because manufacturing has been under pressure for most of the IT companies. My first question, and another question will be around the recovery in the US, because that is what is positive for Indian IT company. And I think the only positive point of US recovering is what is allowing the IT companies to stay where they are and not downfall from here on.
Yeah. So our kind of largest sector is financial services. That's 28%. Banking is a separate sector that we formed just 3 years ago. That's about 9%. And if you think of positives, I think these two sectors likely have the biggest positives from administration policies. If M&A, IPO activity picks up, this sector is going to see a pickup. Okay. Broad-based consumer sentiment picks up, this sector will see a pickup. So, in manufacturing, there are a few different sub-segments, but I think what I will call out is where we are absent. Okay, we are not in auto. Okay, and again, while I said in general goods gets impacted more by tariffs, within goods, if you think about it, whether it's the potential tariffs in Canada or Mexico or the tariffs for steel, aluminum, they both have an impact on auto, and we're actually not in auto.
Okay. Any comments on this one, Mr. Vikash?
Nothing more to add to what Keech already mentioned.
Okay, sure. Thank you so much, gentlemen. Because of crunch of time, I'll have to wrap this conversation. But congratulations on a stellar listing. The stock is up about 7.5% as we speak. But thank you, Mr. Vikash and Mr. Sri Krishna, for joining us on the show, and all the best for the upcoming quarters. Well, it's back to you, Anushi and Varsha. It's your show. Please take it over.
Yeah, right. So now we had Hexaware Technologies in focus. Another stock which is in focus is Sky Gold. In fact, we had a conversation with Mangesh Chauhan, the managing director and CFO of the company. So listen to what he had to say as well.
Sure. We are into B2B model. We are a manufacturer of jewelry. We make 22 carat and 18 carat jewelry for corporates like Malabar Gold, Senco Gold, Kalyan Jewellers, Sangamail, and all big, large corporates. So last December quarter was very good for us. We reached average 475 kg per month, a volume of 475 kg per month, which was quarter-on-quarter increase of 25%. And we had reached a volume of 1,000 crore approximately in the rupees wise, which was year-on-year growth of 30%. Quarterly growth of 30%. So it was a very good wedding season for us. Wedding season, the orders were lined up in total quarters, and we delivered it for the wedding quarters. So demand for jewelry is good, but the inventory size is changing. We are into inventory of we make inventory below 1 lakh, majorly 80%, and below 2 lakh of 20%. So every ticket size is changing. Earlier it was 60,000, now it is changing to 45 to 50,000 as per the rates are going up. But grammage is changing, but rupee wise volume is good.
And your ticket size changes based on the demand from your clients. Is that how it works?
Pardon?
How does your ticket size change? Is it based on the demand from your clients?
Sure, yeah. So our clients' demand just changes, and based on the rates, the average the person wants to buy a 5 gram chain. If he wants to buy, earlier he used to buy 5 gram chains. He used to get a budget of 40,000. Now his budget has increased to 50,000. So he will buy 4 grams ticket size. So we used to make the inventory as per the ticket size. So we change our model as per the weights that suits the budget of the customer. So the ticket size is changing a little bit, 10% below because of the rate increase.
Sure. So Mangesh, what does it mean when it comes to collections and designer jewelry? When it comes to your clients, how does that work? What can you tell us about volumes, and what can you then in that case also tell us about pricing, which I suspect will also impact margins for you?
So we design as per the customer's need. Customers has all over. Some customer has 300 stores, 400 stores all over the world. So we read that customer as Andhra has different tastes, Karnataka has different tastes, UP has different tastes, Delhi has different tastes. We have a designer team of 150 designer team which works on each and every state model and read the customer which customer will pick which design in the store of the client. So we are available in all the stores of the client. Approximately, if one client has 300 stores in India, we are available in every stores. But we have to keep different design inventory as per the customer. Which in India, you can see every 200 kilometers, taste and taste changes about the designing and all. So we make the designs as per the customer requirements of the showrooms, and the ticket sizes also change as per the city and 2-tier and 3-tier volumes.
Okay. Going forward, do you foresee the requirements of your clients change with respect to their demands, or is it, there isn't much change? And when I'm saying with respect to demand is the kind of specifications that you are making. Now, you did mention that the ticket size has come off. Does that also mean that volumes are also increasing because of the ticket size while reducing? How does this work?
Yeah, 100%. When we control our weight of the inventory, our volumes goes up because we give a budget to we give a good weight and a good budget to the customers. So our volumes also go up. You can see on last quarter only, our volumes are gone up to 475 kg per month. We were earlier 2-3 quarters before we were at 360 kg per month. So our volumes grows up because of the reasonable ticket size and reasonable weight range of the gold we offer to the consumer and customers.
Right. Now on to NDTV Profit exclusive. Tesla aims to enter the Indian market. Tushar joins us now to tell us more about that.
Yeah, hi. So what we can confirm from our sources at this point of time is that Tesla plans to enter India in the second half of 2025 and not as early as April. And it will be coming with the Model Y and not the Model 3, which is currently the cheapest offering by the American car maker. So first, Tesla will enter India with completely or fully built up cars through the CBU route, called the completely built up route, and is not looking at assembling cars in India immediately. The Model Y is going to be preferred because the car gets assembled, is actually a right-hand drive car which gets assembled in Berlin. The Model 3 is the right-hand drive version of the Model 3 is assembled in Shanghai, but that's unlikely because both the parties, as in Tesla as well as India, have to figure out how the import duty will work in case of imports from China. That's not as big an issue while importing from Germany. A Model 2 is said to be in the works, but not in Berlin, but in Texas. But again, it's still some time away, this particular model. Remember, this particular model was earlier shelved and actually re-emerged as a robo-taxi sometime late last year. What we also have come to know that there is a new job opening in Pune for the engineering as well as for the IT job posting. The designation is called PCB Design Engineer Electronic Systems. This job can be for R&D, supply chain, or manufacturing. Additionally, Tesla has also increased the number of supply chain employees that it has in India. Remember, it already imports about $1 billion worth of auto components from India. So essentially, retail operations seem largely locked in the second half of the year. When the company starts manufacturing in India, it remains to be seen.
Right. Thank you so much, Tushar, for all the details. But the talk of the day is the new tariffs announced by President Donald Trump. Earlier today, he declared a 25% tariff on autos, pharmaceuticals and semiconductors, and raising questions about the impact on Indian companies. But let's start with the pharma, what its impact will be. So the full announcement will be made on April 2nd. Import duties will likely be to start at 25%. Tariff, according to him, may go very substantially higher over the course of the year. And if just a few data points, Indian companies supply almost 60% of generic drug volumes to the US. So very important. So US is actually a very important market when it comes to Indian pharmaceutical companies. A hypothetical 10% tariff calculation that was done by HSBC could reduce Indian pharma companies' earnings by 1 to 6.5%. Now, bigger concern is the long-term impact on growth, and the US is actually a major market. As I said, companies might shift production to US-based plans to lessen the tariff impact, but few analysts are of view that maybe this won't affect Indian pharmaceutical earnings because as compared to US, after these tariffs, Indian companies will will have that cost advantage. So the margins will always be there. That's according to some of the analysts, but we need to wait and watch, because the higher cost of the tariffs would actually be passed on to the customers. But let's just talk about what are the revenue contribution of Indian companies when it comes to US. So you have Aurobindo Pharma, which the US contributes almost 46%, and one of the reasons, you know, why all the pharma companies are actually down. You see Aurobindo Pharma is down because 46% of revenue comes from the US. Cipla, 28% of revenue comes from the US. You have Lupin, which has 37%. Dr. Reddy's, 46%. Torrent Pharmaceuticals, not much impact there, 10% of revenues that comes from the US. But if I were to talk about the impact of 10%, you know, tariff on earnings per share as calculated by HSBC. If you see, Aurobindo Pharma will have 5.5% negative impact in earning per share. Cipla will have 4%, Dr. Reddy's will have 6.5%, Zydus Life Sciences will have almost 6% impact on their EPS. So, but as I said, few analysts are saying that this won't impact much of the pharmaceutical companies, because of the still they'll be at a cost advantage as compared to the US market. But you know, to speak about more that, let's invite Gaurang Shah, who's the head investment strategist at Geojit Financial Services. Gaurang, welcome to the show. So
thank you so much.
Yeah, Gaurang, so we all know the talk of the day is the tariffs, and when it comes to pharmaceuticals, all the stocks are under pressure. What is your view, and what would you advise investors?
Well, first of all, thank you very much for having me on this platform. Good afternoon to all of you all. So this is not the first time that India is witnessing a situation like this. In the history, we have come across these kind of situations, and we are able to, recoup from those levels. April onwards, these tariffs will be implemented. A lot of clarity will emerge post that. We still remain structurally positive on the pharma sector. We have virtually more than 8 to 10 companies under coverage in the pharma universe, involved into contract drug manufacturing, into APIs, into generics, and likewise. Short to medium term, I think the impact will be felt depending upon the news flow and clarity as we go forward. But, one also has to introspect in terms of, if this 25% tariff is going to come through in the month of April, then the viability in US in terms of substituting, how big is that? Whether they are able to do that or not. And the fact remains that other than US, there is also a big market within India, and minus the US, the rest of the world. And one also has to always remember that India was, India is, and India will always remain a pharmacy to the world. I think this position remains undisputed because of the capability, capacity, experience, and the knowledge, R&D. So it is a short to medium term negative. April, we'll have a lot of clarity. But our sense is that as of now, given the situation, the impact should be minimal.
Okay, a minimal impact is what we are looking in terms of where the pharma space is headed. But you know what, let's also go across to Puneet to get us a better perspective on the impact of these Trump tariffs, which are also going to be levied on the automobile sector. Over to you, Puneet.
Now, the Trump administration has come out and announced another essential 25% tariffs on automotives, pharmaceuticals, as well as semiconductors. And we speak about the automotive part currently because, while India's overall share of export of automobiles is quite minimal, the auto component and the tire makers might get impacted because of this particular move. Now, we've spoken about this in the past as well, that, companies like Sona BLW as well as Samvardhana Motherson are key focus on the export markets, while, players in the tire space like JK Tires as well as Balakrishna Industries have focus on revenues and have local manufacturing facilities as well. So we just break down some of the key companies to watch out for in case these tariffs do come in. The first one is, of course, Sona BLW. They have roughly 40% of revenues coming from the North America region, region. Now what is unknown is how much is it which is localized, which won't get any kind of tariffs. That is the kind of number that the company doesn't give out, but they have an overall exposure of 40% in terms of revenue. They also have an operational plant in Mexico and another one coming in about 3 to 4 quarters time. So any kind of tariffs will be detrimental for the company. The second one, Samvardhana Motherson. Now they have roughly about 400 facilities all over the world. Some of them are of course in the North American region, but currently about 18% of the revenue comes from the US, while roughly about 4% is coming from Mexico, and they already have and are commissioning one more plant in Mexico in this particular quarter itself. So any kind of measures will of course be very weakening in terms of the profit margin for the company. And the third one is JK Tyre. They have 3 plants in Mexico which is exported in the North American region, will get affected as well. And finally is Balakrishna Industries. Now the company has roughly about 16% of their total revenue coming from across the Americas region, but they majorly of course they export it from the Indian market itself. They don't have any kind of manufacturing facility in the international markets, and that could also come under tariff. So while India currently deploys 7.5% tariffs on imports of these kind of expensive auto components, those kind of tariffs could come into the picture, and companies have been mentioning and calling this out in the previous commentary as well. But watch out for these in case these tariffs come in on April 2nd.
Very interesting set of data. In fact, thanks for that, Puneet. Gaurang, some of the names that Puneet was talking about, this included the likes of Sona, BLW, Samvardhana Motherson, JK Tyre, as well as Balakrishna. Want to understand firstly your outlook. Now you've spoken about the pharma sector, but also want to understand the outlook on the automobile sector and some of the key players, how there could be an impact on some of these names.
Well, so like your colleague was mentioning, I think impact will be visible. Undoubtedly. Some of the names that your colleague was mentioning, Balakrishna Industries, we have a positive coverage over there. I think JK Tyre was the one other company that you mentioned. We have coverage over there as well. Impact from a short to medium term point of view would be felt. Samvardhana Motherson International is something that we have under our coverage also. So these are the 3 companies. Other than this, in the auto ancillary pack, we have coverage on CIE Automotive, Uno Minda. And we are also of the belief that if auto sector has to do well, then the reciprocal positive impact will fall onto original equipment manufacturing companies, OEM, auto ancillaries, battery manufacturing companies, and tire manufacturing companies. For case in point, Balakrishna Industries, which are basically into truck and bus radial tires. Bakery tires is the product which is well known for, and they have got a decent market share. Having manufacturing facilities in Mexico, or in case where they are planning to open up a new manufacturing facility in the next couple of months. And of course, the fact that US has imposed quite a bit of tariff-related issues with Mexico and with Canada. Of course, it has been put to rest for about a month time, but I think by this end of this month or early next month, March, we'll have clarity emerging in terms of what are those tariffs, which are the products, etc., etc. So like I said, these, news-based reactions would be there on the specific stocks from a short to medium term point of view. Long-term impact will only be visible once we have earnings, and in case if there is going to be a sizable amount of contribution coming onto the balance sheet from this part of the world, then those companies we might have to have a look in terms of earnings visibility and scalability.
Right. Now, thank you, Gaurang, for that. But sticking to, tariffs, let's see what impact this will lead to Indian chemical companies. So we do have Citi's note wherein they talk about the implications of the possible reciprocal tariffs when it comes to chemical companies in India, and they say that the chemical sector has been identified as vulnerable to US tariffs, and the India's tariffs on organic or miscellaneous chemicals is higher than US at 10%, while US is at 3%. And EU and China have average tariffs of around 5 to 6%, and they believe that the actual impact likely to be lower owing to offset from tariffs on the other exporters. Let's just talk about what are the impact on companies, how this will be impacted. If, for an example, we take 7% of tariff impact. So PI Industries, if I were to talk about, there will be a negative impact of 12% when it comes to EBITDA of PI Industries according to Citi. SRF will have an impact of almost 4% to EBITDA. Navin Fluorine will have 5% impact on their EBITDA, while actual impact will be likely lower due to other exporters and tariff and potential US price increases. If I want to talk about the exposure, the company's exposure when it comes to US market, then PI Industries, almost 44% of revenue comes from North America, 10% comes from, for SRF, 10% of revenue comes from, North America, and for Navin, 15% business comes from North America. This is almost the estimated numbers. So Gaurang, we already know that there's been pressure when it comes to, chemical industries, number one, because of the China destocking, then, the prices, the realizations of the product not going up, and now you have this tariff situation. So your view when it comes to chemical sector and any possible counters that you are either bearish or bullish on?
Well, so I think again, over here, we were all quite positive on this sector, China plus one, post-COVID. We were also positive in terms of Europe plus one. We expected chemical and specialty and agrochemical sector to do well, but somehow the contribution was lagging in terms of earnings and scalability of exports to the rest of the world from India. Whereas the companies have invested quite a lot in their capex as well as in R&D in terms of coming out with new products. Amongst the names that you mentioned in terms of coverage, we have coverage on SRF Limited, PI Industries, Vinati Organics, Pidilite, UPL, Aarti Industries. These are the companies which are under coverage on the positive side. On the negative side, we have a reduced recommendation on Tata Chemicals. We believe that the earnings, if you actually look at the last couple of quarters, has been disappointing and the stock has been an underperformer within the sector. Again, see, when you talk about tariffs on rest of the world, I'm talking about US, you also have to take into consideration that it is not going to be easy for companies to shift their base from one country into US. And all that process takes a little bit of time. During that time process, if you are aggressive with your tariffs and if you go ahead with your planned tariffs, then your own economy is also going to have a setback in terms of growth, in terms of GDP, etc., etc. What I'm trying to say is you have to be prepared in terms of substitute before venturing into this high-level tariff across the world.
Okay, so that's the outlook for the chemical sector along with pharma and automobiles on the Trump tariff outlook and what could the implication be. But with that, it's time for a break. But before that, in fact, why don't we listen to the man himself? And by the way, as many of you might know by now, NDTV Profit successfully concluded its maiden conclave yesterday. We saw a slew of corporate leaders and market voices speaking about tariffs as well as the other things that this includes the likes of Piyush Goyal, Nadir Godrej of Godrej Group, Anisha of M&M and many more. So let's listen into what they had to say.
Announcing some very, very big momentous decisions are being made by companies all around the world, the biggest, and they want to come back into the U.S. Car plants are being canceled in other locations now because they want to build them here. I think it's a very important thing, and you'll be seeing this over the next, probably over the next 2 years, to be honest, but you're going to see a lot of it over the next couple of weeks. A lot of big ones are going to be announcing.
Mr. President, have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%.
What about semiconductors and pharmaceuticals?
It'll be 25% and higher, and it'll go very substantially higher over a course of a year. But we want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariff.
Our situation with America is pretty much different than many other countries. And therefore, as I said earlier, we complement each other. We can give mutual concessions to each other, tariff reductions, make it easier to import and export both between the two countries. We've already taken a significant number of measures to strengthen the US-India relationship. We have both strategic bilateral, multilateral engagements. We have defense ties. We have strong ties in education and people-to-people ties. So together, we are working on several initiatives. Trade will supplement our efforts to do much greater good for the people of US and India.
I think we will come to a place where it makes sense for both countries. There will be some industries that are hurt more than others, possibly, depending on what finally happens. But I do feel that it will be in a place where it makes sense, because India has to protect manufacturing in a significant way as well, and that's an important lever for India's growth for the next decade.
It's possible that the global situation with shockwaves coming from Washington DC regularly might be something, it might be the reason for this. But the good news is that the price earnings ratio of the Indian stock market is very reasonable now, and I wouldn't be surprised if there's a revival of the stock market very soon.
Basically, to make a change in formulation, for example, takes roughly 3 to 5 years. So from that context, there is, unlike steel or cement, you can switch suppliers at a day's notice. You can't do this in our industry. So the view I have is short term. Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected. Okay. But long term, one doesn't know what happens after 3 to 5 years.
Yeah. While we talk about the tariffs, I think, first of all, I think it's going to be more bilateral, because I think when we're talking about two countries, they've already come to a conversation where they're going to be talking about growth in both the countries, and it's going to be beneficial to both the countries. So I think for me, I am more positive about it. To Mr. Khurakwala, when he talked about it'll be passed on to the consumer, for us in home textiles, it is a very small part of that wallet share where, you know, we are that towel or a sheet or that rug that they use, and it is very, very sensitive. Yeah. So I think it will be something that we will have to work mutually.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
This entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome. We are watching Top Trades on NDTV Profit with me, Soumit Sarkar. When it comes to the Indian benchmark, that is the Nifty 50 index, it has been range bound for the third consecutive session in the range of around 22,930 to 22,960. Not much of an action when it comes to the large cap stocks, but it's the mid cap and the small cap indices that have been gaining anywhere between 1.5% to 2% in trade. And this comes as a relief rally for the mid and the small cap indices. When it comes to FNO stocks, as the BSE, that is the top gainer when it comes to FNO stocks. The stock is up around 7.5%, followed by RBL Bank, which is up 5.5%. Manappuram, HFCL, Union Bank up anywhere between 4 to 5% in trade. When it comes to cash stocks, it's D-Ref Plastic, Veranda Learning, which are gaining anywhere between 15 to 16% in trade. Hindware Home Innovation again up 15%. Tata Investment Corp, that stock is also up around 14% in trade. On the losing side is the sectoral wise, if you look at, is the Nifty IT index, which is down in trade. That is after Capgemini came out with its numbers today and has said that 2025 as a calendar year could be muted for them, and hence we are seeing such kind of a downtick when it comes to the Nifty IT index. Stock specific, it's the LTI Mindtree and TCS which have declined the most in the IT index. LTI Mindtree is down around 3.5%, TCS is down around 2.7%. On the gaining side is the Nifty Realty Index, which is up around 1.9% in trade, followed by PSU Bank, which is up around 1.1% in trade. Real Estate Index, in fact, if you look at that, has been down around 19% on a YTD basis, and hence we are seeing such kind of a bounce back when the market is gaining on the Real Estate Index. Well, let's also get in Mahesh Ojha, the AVP Research and Business Development at Hensex. Firstly, sir, do you see this bounce back when it comes to the mid and small cap as a technical bounce back, or do you expect that the bottom is now near for at least the broader indices?
Good afternoon. I think the bounce back in mid and small cap is selectively, and there is a valuation. So current time is selective buying of mid cap and small cap, which we are also suggesting to our clients, and as well as market is also participating on that. So there is a segregation in mid and small cap, and selective buying we are seeing where is a fundamental is strong, and there is some buying visible in the market. So I think it's a good time to selective buying for a mid and small cap, and hope that is a valuation where is a valuation exists. There is some more buying will come in followed by in next few sessions.
Right, selective buying is the advice coming in from Mahesh. But it's the pharma index or the pharma stocks that have been in focus on the back of the recent announcements or recent indications coming in from the US president on there could be a possibility of a 25% tariff on pharma products. We have Varsha joining us to give us more details on which companies stand to get impacted the most, if at all there is a tariff that comes in.
Yes, thank you for that. So yes, as we all know that Donald Trump hints at imposing 25% tariff on pharmaceuticals. Now, full announcement will be made on April 2nd. Import duties would likely start at 25%. Tariff may go substantially high over the course of the year. And just to give a data point, Indian companies supply 60% of generic drug volume to US. A hypothetical 10% US tariff could reduce Indian pharma companies' earnings by $1 to 6.5%. Bigger concern is a long-term impact on growth because US is being a major market for Indian pharmaceutical companies. Companies might shift production to US-based plants to lessen the tariff impact. Just to give you a context, revenue contribution of few companies from US, if I were to talk about Aurobindo, for Aurobindo Pharma, almost 46% of revenue comes from the US. For Cipla, 28%. For Dr. Reddy's, you have 46% of revenue contribution. For Torrent, it's just very little, that is 10%. And for Lupin, it is 37%. According to HSBC, if you see the impact of 10% tariff on earnings per share of these companies, Aurobindo Pharma will have a negative impact on EPS of 5.5%, while Dr. Reddy's will have an impact of almost 6.5%. Zydus will have a 6%, Lupin will have a 4.5%, while Sun Pharma will have only 1%.
Along with Pharma, it's the auto stocks also that could get impacted, because yesterday's commentary also did indicate that there could be a 25% tariff coming in on automobile products as well. Let's get in, Puneet, to understand what could be the impact of that.
Now, the Trump administration has come out and announced another essential 25% tariffs on automotives, pharmaceuticals, as well as semiconductors. And we speak about the automotive part currently because, while India's overall share of export of automobiles is quite minimal, the auto component and the tire makers might get impacted because of this particular move. Now, we've spoken about this in the past as well, that, companies like Sona BLW as well as Samvardhana Motherson are key focus on the export markets, while, players in the tire space like JK Tires as well as Balakrishna Industries have focused on revenues and have local manufacturing facilities as well. So we just break down some of the key companies to watch out for in case these tariffs do come in. The first one is, of course, Sona BLW. They have roughly 40% of revenues coming from the North America region. Now, what is unknown is how much is it which is localized, which won't get any kind of tariffs. That is the kind of number that the company doesn't give out, but they have an overall exposure of 40% in terms of revenue. They also have an operational plant in Mexico and another one coming in about 3 to 4 quarters time. So any kind of tariffs will be detrimental for the company. The second one, Samvardhana Motherson. Now, they have roughly about 400 facilities all over the world. Some of them are, of course, in the North American region, but currently about 18% of the revenue comes from the US, while roughly about 4% is coming from Mexico, and they already have and are commissioning one more plant in Mexico in this particular quarter itself. So any kind of measures will, of course, be very weakening in terms of the profit margin for the company. And the third one is JK Tire. They have 3 plants in Mexico which is exported in the North American region, will get affected as well. And finally is Balakrishna Industries. Now, the company has roughly about 16% of their total revenue coming from across the Americas region, but they majorly, of course, they export it from the Indian market itself. They don't have any kind of manufacturing facility in the international markets, and that could also come under tariff. So while India currently deploys 7.5% tariffs on imports of these kind of expensive auto components, those kind of tariffs could come into the picture, and companies have been mentioning and calling this out in the previous commentary as well. But watch out for these in case these tariffs come in on April 2nd.
Right. Mahesh, coming to you first on the pharma stocks. One day it's like there won't be any tariff. Second day there could be a 10% tariff. Now we are listening to 25% tariff. How are you advising your clients to react to these kind of announcements that have been coming in? And actually, do you even think that it is possible for US to impose a 25% tariff on pharma products, given that it is essential and a lot of pharma products actually get imported from the Indian market?
Sumit, I think there is a sound more on the basis of tariff. I don't think the Indian companies might impact much more due to these tariff type of bargaining. I think there is a negotiation could be there, and there is a marginal impact could be come on Indian pharma companies, because there is a revenue percent. If you see, there is a minimum revenue percent coming from US, and overall pharma sector is growing. And I think some negotiation could be there, as government is also participating for negotiation. And if they hike up to 25%, then US could also face some inflation type of trigger. So I don't think the margin could tariff could till 25%, but yet let us see what negotiation could be there. But I don't think the pharma could be impact more from an Indian perspective, because Indian companies are required by US. So I think there is a minimum impact could come on pharma companies space, but as well as we are seeing the growth of pharma sector is also quite. So there is a minimum impact on a longer term basis. So I don't think the much tense on pharma sector particular.
Right. On the inaugural edition of NDTV Profit Conclave, we spoke to Eminem's Anisha, and let's listen to what he has to say on what could be the impact of Trump tariff on automotive sector.
I think we will come to a place where it makes sense for both countries. There will be some industries that are hurt more than others, possibly, depending on what finally happens. But I do feel that it will be in a place where it makes sense, because India has to protect manufacturing in a significant way as well, and that's an important lever for India's growth for the next decade.
Right. Another pack of stocks that remain in focus is the IT index. In fact, we have seen a sharp selling coming in the IT stocks, specifically in the last 1 hour of trade. And one of the announcements or one of the news that is there in the IT sector is the fact that Capgemini came out with its Q4 CY24 numbers, and the guidance that they have given for 2025 also remains kind of muted. We have Rucha joining us with more details on that.
So for sure, Nifty IT is buzzing in trade, and this is on the back of Capgemini reporting its CY24 results. Now, Capgemini is a global IT company. It has reported its numbers slightly above consensus estimates and towards the top end of its guided range. But what is more important for Indian IT companies is the 2025 guidance which it has given. Now, in terms of constant currency revenue growth, the guidance range stands at -2% to +2%. Operating margin range stands at 13.3% to 13.5%. But what are the implications for the Indian IT sector? Let's talk about what CLSA believes. Well, CLSA believes that the guidance definitely implies more uncertainty. However, this is more specific to Capgemini than setting an overall trend over here. And this is also because Capgemini has largely proved to be a laggard because of its high exposure to France, EU, UK, and also the manufacturing vertical, which has been under pressure over the past few quarters. Therefore, they reiterate their optimistic stance on Indian IT companies. They also believe that discretionary demand is now picking up, especially in the US and in the banking and retail space. And remember that this is what we had heard from most of the management in the latest earnings as well. Now, in terms of what Infosys has guided for its FY25 number, the FY25 constant currency revenue growth guidance stands at about 4.5% to 5%. HCL Technologies have also guided in a similar range, in actually a same range, 4.5% to 5%. But we'll definitely watch out for what the management are actually talking about discretionary demand and demand pickup in the US. So this can be sentimentally weak for Indian IT companies, but as CLSA believes that this is more specific to Capgemini than setting an overall trend.
Right, Rucha. Mahesh, what are your views when it comes to Capgemini earnings? Do you think that there would be a negative impact, or there would be a negative impact on the Indian IT companies of the same?
I think this year for the IT sector specific, if we see then not much aggressive, but guidelines which are given by the other company, which are we have to see that they can deliver or not, but because of some tariff and other news. So we are not much more optimistic for IT sector specific if we see on price wise. So already IT sector was up in last 1 year horizon, but so could be consolidation could be there, but I don't think much more upside could be in immediate time horizon. And if we look on dollar to rupee terms, and on that part also I am looking for some consolidation. I think rupee dollar could come 85, 84 then slowly. So from that perspective also I'm not much more optimistic for a particular IT sector, and the guideline which they have given already, that would also be watchable.
Right. Thank you, Mahesh.
We are giving our advice our client to wait and watch for this sector.
Right. Well, thank you, Mahesh, for joining us and giving us your perspective about the markets and the stocks that we spoke about. Moving on, the inaugural edition of NDTV Profit Conclave saw industry leaders offering insights into the India opportunity. On the sidelines of the event, my colleague Harsh spoke to Wellspun Living's MD and CEO Deepali Goenka, listening to what she had to say about India's manufacturing potential going forward.
Welcome. We're at the sidelines of the NDTV Profit Conclave, and interesting conversations already starting off. And we have with us Deepali Goenka, great speaking and always great having that perspective. So, the agenda, Deepali, is Viksit Bharat by 2047. What do you think is going to get us there?
I think the main thing that we see is the organized supply chain that we're talking about, and ease of doing business, which we already are moving in. I think the skilled manpower that we already are working towards, and if I look at the complete ecosystem, when I talk about the PLI, when I talk about the Gati Shakti or these Samarth schemes, I think in totality it's going to be about ease of doing business. And I think India, when we talk about, is at the heart of all these conversations globally, being an integral part of the supply chain for everybody. And I mean, for me, it is such a pleasant thing to see where India is in the boardrooms of discussion for the sourcing destination. And I think that's going to be a very important but I think a rider, how are we going to skill the youth of this country?
Yeah, I was going to come to that. Challenges, Deepali.
So the important thing is how we're going to skill the youth of the country. How does digitization, AI, Industry 4.0 play a very big role in the whole industrialization? Because now we're talking about another industrial revolution which is going to be so huge, which has already put India on the world map.
Fair point. How are you as a company navigating the current global macro? Because it's a tricky one, right?
I think, post-COVID, the world hasn't been the same. And I again say that, all the time. I think it's about the resilience of, an organization that really holds you on. The importance is about laying your complete supply chain in order, your whole digitization technology. And I think looking at not just today, but I think the long term where we are off to. And I think that's a very key thing. For me, when I talk about Wellspun Living here, the predictive analytics for the consumer across, whether it's in America or in UK, Europe or in India, what that person's going to buy, to the kind of supply chain in the terms of the raw material, that's cotton, the whole traceability and blockchain, to my vendors, the MSMEs, in the terms of which make the bedrock of the entire supply chain, in the dyes and chemicals, getting them on board to the whole sustainability index, to delivering the product on time, and also maneuvering towards the Red Sea. I think it's a lot of things, but I think again the bottom line is about a resilient organization.
Okay, resilient organization in this tricky macro. But thanks so much, Deepali, for spending time speaking with us.
Well, right. Moving on. We also spoke to other people. We also spoke to Dinesh Thakkar, and let's listen in what he has to say.
We are in conversation with Mr. Dinesh Thakkar of Angel One, and we did a conversation with you, right, wherein we spoke a little bit about the evolution and where we might possibly go to. I would love to understand from you, because you've seen that cycle, Mr. Thakkar. How do you see Indian capital markets and the Indian investor over the course of the next 15 to 25 years? Because we spoke about the last 25. What do the next 25 have?
See, I believe that disruption we saw in capital market in 1920 post-COVID, it is just a beginning. And that was the first phase where retail investors started coming to the market in a big way. So what was stopping them was awareness. Always feeling is that stock market is risky. But somehow, because of their access to social media and because of young crowd, they started learning about this equity as an asset class. And yes, definitely they will take some wrong steps and all that. But if you see, their AUM in equity has increased. They might have made losses in trading, but proportionately, if you see their investment in SIP, mutual fund, equity has really given them a good return. So what I am seeing is that, okay, if you fast forward India for next 15-20 years, I feel this is just a beginning. At this median age of 28, 29, they have just started their relationship with money. And when they get into a serious phase of their life, when they want to do some kind of planning for their housing, for their retirement, for education of kids and all that, equity is an asset class which can give them a good compounding for a long term. So I feel that, okay, time has come for brokerage houses like us to build intelligence in our app. Today we are giving an access to customers.
That's true.
They can decide what they want to. We may give them, okay, what is a popular stocks or popular mutual fund. But we need to build that capabilities in an app where I'm able to understand persona of this person, requirement of this person, and scan the ecosystem. What are the things rightly suited for this person? Until now, what was happening, because the relationship management is really very costly, they used to sell what suits a relationship manager, not a customer. But now, if we are talking about app, we can build an intelligence where we can train our app to say what is good for an individual for next 5 years, 10 years, 15 years. That trust has to get built on this app. That is where I am very bullish on AI, ML, plus I am very bullish on tokenization of assets, where blockchain can be used not for crypto, but all asset class can be an underlying asset, and blockchain can help to tokenize and fractionalize. What is important is fractionalizing of asset, wherein retail investor is able to build the trust on that token. So regulator has to work a lot on creating a proper audit system, creating a proper custodian of those assets. So I am very bullish on this, looking at next 20-25 years, when India would be having the largest working population, and we would be having a median age of around, say, 38, 39 by the time Viksit Bharat 2047 happens. So I am very bullish that, okay, you will see more participation from retail in all asset class, especially equity.
Okay, but tokenization, I mean, in equities you might not need that. You saying in a lot of other asset classes, tokenization and blockchain could actually play a part?
See what happens today, if you talk to anyone in terms of wealth management, they will say a ticket size has to be 5 crore, 10 crore.
Okay.
Otherwise they can't manage it.
Yeah.
If I train my AI with all that logic, we have seen market 20 by 30 years. There are lots of intelligence available by lots of good fund managers. I can build those intelligence in terms of what diversification means and where it has to be diversified. But I need all this asset class at a very fractional kind of value. That is where this tokenization and fractionalization is going to help this retail audience to get a wealth management kind of service, even with a ticket size of 5,000 rupees.
Got it. Okay, yeah, that's okay. That's a fabulous thought. And Mr. Thakkar, tell us, do you reckon that the kind of intelligence that we are talking about can happen in a cost structure which is a lot more suitable? Because what you've done, right, through your app for the DIY investor on mutual funds or on stocks is fabulous. Costs have come down. Can that same thing happen, not in the similar way, but in a proportionate way for personalized wealth management as well?
Yes. I believe we don't have to invent everything. We have to build our models based on LLM models available. So it is just we have to train those models in terms of how they have to understand these personas and how they have to give them solution. So I think this investment and scale that we are looking at India, I think it makes sense because same thing like when we are talking about, say, digital brokers, investment in technology is quite huge, but investment per client is so low.
Right.
So when we are talking about that 60 crore population coming into this market, and if you are investing, which can be a bit upfronted, but what I believe it is worth investing in all these technologies. When we put unit-wise kind of cost, it would be very minimum thanks to our huge population.
Got it. I have one final question because I know that you will be talking a lot about this in our forthcoming show Disruptors as well. But I have one final question, and which is the one that the number of investors who've come into the fold for investing into equities, which I believe is the best asset class, I may be wrong, but I believe so, is good. But it's nowhere close to the number of, let's say, the PAN cards that exist, etc., etc. We seem to have a very fast train up in the last 4 years, and they now seem to be plateauing. I may be wrong here, so please correct me, but we seem to be plateauing a little bit. Why is that happening, and do you think there is a next surge coming?
First, I don't agree it is plateauing.
Okay.
It is already, we are seeing a good surge. If you look at our investor base from 2015 to 19, it was growing at the rate of 15-16%.
Right.
If I take from 19 to till date, it is around 32% growth in Demat account.
But has it slowed down in the last 12 months?
No, not at all.
It hasn't.
No,
Okay.
no. So I believe that all this kind of like potential customers or potential investors who are on the who are fence sitter right now, or maybe who haven't started earning serious money, they are going to come to the market. So it is not that we believe it is in best asset class. Statistics also shows the compounding return of this is good. It is liquid. It can be invested in very small amounts, and one can get a good average price and a good average return. So I believe that still, like people who have opened the Demat account, still they are struggling to get confidence on these apps. They want to understand that what are the steps I am taking and how do I evaluate opportunities that I am seeing on the app. That's the reason I feel now that investment is going into AI and ML, we'll be able to help investor a lot. Today also, if you look at our interface, lots of help is provided in terms of showcasing what people are buying who are similar profile, similar cohort. But I think more intelligence will come where people will build more trust on this app, and they can really take a call for next 3 years, 5 years. Today mostly they are coming, the young population. They are coming, they want to trade, they want to beat the market, which is not possible. Even smartest of fund manager cannot beat the way they are aspiring. Let them learn all this. Once that learning phase completes, I feel that serious money will come over here. That is where I want them to avail of wealth management service at a small ticket size.
Well, wishing you all the best for that, because it will improve the life quality of so many people who will be investing through your app or similar apps as well. But thank you, Mr. Thakkar. It was lovely talking to you today.
Same over here. Thank you very much.
Well, with that, it's a wrap on this edition of Top Trades. Stay tuned to NDTV Profit and keep watching NDTV Profit.
Entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now
Welcome. This is India Market Close. I am Akam Vakil, and with me is Harsh Saita. Let's take a look at how markets are faring. At this point in time, it's turned out to be yet another very, very quiet session. And while we have seen, well, some volatility in a very narrow range, which means that there has been a lack of volatility, well, the VIX continues to remain high. But I'm going to talk about the benchmark, and the Nifty continues to move around 22,900. 23,000 remains elusive for yet another day, but we still have another hour to go, an hour and a half to be precise to go, so you never know. But for now, that hasn't come through. The Bank Nifty as well, that's in fact actually outperforming the benchmark, so that's clearly a positive here. And that's also the reason why we have a bunch of these banks in fact moving in favor of the Bank Nifty. So if you can actually pull up the constituents of the Nifty and see where there's a pull and push, and reckon that it will be the banks which will actually give you that impetus on the upside. It's something like an HDFC Bank, or for that matter something like a Kotak Mahindra Bank, Axis Bank advancing, ICICI Bank advancing 1% as well, is giving you that weightage for the Nifty to remain well flat at the moment. But there are plenty of other counters which on the Nifty are weighing down on it, Well, case in point, TCS and Infosys, both of them losing out around, 2.5% for TCS, 1.9% for Infi, and these are relatively heavier weighted companies, along with something like a Hindustan Unilever, which is down 2%, Dr. Reddy's down 6%. Just want to make a very quick mention of Bharat Electronics. It does look like it's looking at a little bit of short covering there, along with Hindalco up around 2.3% and L&T up around 2.2%. So this is as far as the benchmarks are concerned. 50 stocks, more gainers than losers. So that's again a little bit of reversal from what we saw yesterday. Let's move on and talk about the advanced decline ratio, and after which I will hand it over to Harsh to take us through the broader market. So in terms of the advanced decline ratio overall, at least those stocks on the NSE, there's a complete reversal from what we saw yesterday. There are about 5 odd stocks losing out as against 19 odd stocks gaining on the National Stock Exchange. When it comes to the Sensex, it's 50-50. On the Nifty 50, it's a little bit more towards the gainers end. So overall, the market breadth looks pretty favorable, and I reckon that is one of the positives. But when it comes to the benchmark specifically, that's flat. Harsh, how are the broader markets looking?
Well, broader markets looking much more positive, in fact, Agam, than the benchmark. Look at the Nifty mid-cap up 1%, so you're seeing a bit of a bounce on that, a recovery at play. The Nifty small cap too doing fairly well for itself, nearly 2% higher, of course off the day's highs, but sustaining very, very well. And the advanced decline ratio kind of gave that away, right? It indicated that the broader markets were doing fairly well, because when you saw the breadth on the Nifty, it was largely balanced. Let's take a few names. While these are really moving, I'm not so sure whether they're only moving on the back of news, because we've seen a bounce in markets after quite a few days, or rather tough days, and therefore some of these really moving also on the back of the fact that we've seen such a large correction, at least through last week. So let me pull out some names. RVNL and All Cargo Logistics, Lemon Tree, all up 5 to 11.5%. Irida is also doing fairly well for itself, 5% up. 63 Moons and Transformers and Rectifiers locked in upper circuit, 5% up, both of those. Bank of India is also up 4%. Rajesh Exports is up 2% odd as well, as promoter buying has taken place in Rajesh Exports. And Aurobindo Pharma on the other end, down nearly 2.5% odd. Bharti Airtel down 1.6% after those blocks that came through. Cipla down 1% as well. So Oro and Cipla, I'm sure that a little bit of it is tariff, a little bit of it is also the fact that you have those US FDA observations to take care of. So some of those also weighing down on indices. But I'll also talk about some notes which are basically keeping stocks abuzz. Suvain Pharma is up 6.5%. Macquarie super bullish, 1500 being the target price. Blue Jet Health also doing fairly well, 4%. Same note. KEI Industries is up 4, Venus Pipes is up 3, Westlife Food and some of the QSR cores are also buzzing in trade today, along with the Divi's Labs. So some of those stocks obviously on our radar as well, and we'll speak about some of those through the next hour and a half of trade. The Pharma pack is in focus, two completely different reasons for that. But let me go across. We have Kush with us, founder kushbora.com, to give us perspective on what he makes of the markets as well as the index. Kush.
Hey, hi Harsh, very good afternoon.
Good afternoon.
I think something similar that we spoke of yesterday during the closing show. I'm sure a lot of you must be busy with the conclave, which by the way was a fantastic event. It was genuine pleasure attending it, and some of the top voices, sounding out the opinions on the Indian economy and what markets are likely to do going forward. So fantastic event. So kudos to you and the entire team on that. Now, as I was mentioning, yesterday we spoke of something very interesting, which is for now, the selling seems to have stopped, and for the buying to resume and the markets to move up, the first thing that has to happen is that the selling needs to stop. Now, that might not be evident, from the cash segment. If you take out the Bharti Airtel numbers, I don't think the FII buying figure is going to look as pretty, right? They've been on a selling spree. But the reason I say that is because the FIIs have had a 84% short position on the index futures, but then that position they've had for the last 3 to 4 sessions. which means that's not going up. Also, as we mentioned yesterday, stock future segment is starting to see some buying. If you see the last 4 out of 5 sessions, there has been buying in the stock future segment, which means at least at the stock level, they've started some sort of a short covering activity. Now that is a very interesting sign. As I said, the selling needs to stop before the buying begins, right? Now multiple attempts have been made to hold to the 22,800 support level. We've seen the last almost week or so for the Nifty to hold above that level. Also, if you look at the options data, while the 23,000 call option has nearly added almost 100% of the open interest that it carried yesterday, a similar number is also true for the 22,800 put, which is suggesting that from a near-term perspective, this could be the range for the market, which is 23,000, 23,100 on the upside, and about 22,800 to 22,700 on the downside. I still believe that the play to be made in the market is one of a rebound, one of a recovery, because the risk-reward ratio is favorable and the markets are attempting an up move. So with the stop loss around the 22,700 mark or levels of 23,300, 23,500, I think there's still a positional long play to be made in this market.
The index future long-short ratio remains sticky below the mark of 20% for longs from an FII standpoint. So, of course, a point taken when Kush suggests that a little bit of a rebound is expected. Of course, you can't time these moves. But Kush, let's talk about the Bank Nifty too. At least today, it seems like it's stronger than the Nifty. What's your reading here?
Hi again. And very well put. That it's very difficult to time the rebound rally. I mean, in the FIs could stay short in the market for a while before they actually start buying. So, excellent point, which is, yes, you can't time these things. What's important is to just gauge the broader trend, and that trend right now, as I said, is suggesting that for now the buying seems to, the selling seems to have abated, if not completely stopped in the derivative segment. Now, you're right. Bank Nifty seems on a stronger footing today. If you see, it's about 0.75% versus a flat Nifty. But I'm not sure if that's entirely the case from a data perspective. What we're seeing today is more of a rebound rally because the PCR OI for Bank Nifty up until yesterday was, I think, close to 0.7, 0.75 thereabouts. And right now it's jumped to 0.8. For the Nifty, the PCR OI currently stands at 0.85. So if you look at it from an objective standpoint, a data standpoint, I think there are still some shorts that still need to be covered on the Bank Nifty. Also, while it is closer to the 20 DMA than the Nifty is, in fact, it is at pinpoint the 20 DMA. I think this will act as a near-term resistance as it has for the last 3 to 4 sessions. I do believe that, yes, Bank Nifty has room on the upside, but for me, very stiff resistances remain near the 49,800, 50,000 mark. So up until those levels are taken out, I think it could be a range-bound play on the Bank Nifty. So while Bank Nifty is showing good strength today, I think the rebound play could be much stronger on the Nifty than on the Bank Nifty.
Kush, your picks for this afternoon?
Sure. Still going with 2 long positions, given that, I am still a little optimistic on the markets, at least from a very near-term perspective. Kotak Mahindra Bank, the stock has done rather well, over the last few sessions, consolidation for about a month and then a breakout and sustaining above that in a market like this, which is a very heartening sign. So for targets of 1990 and 2015 with a stop loss around the 1940 mark, you could consider Kotak Mahindra Bank for a long trade, position long trade advisable. The second one is Hindalco. Some of the metal names, interestingly, are starting to make a play. JSW Steel is one of them. Hindalco is now making a cut. So I think some of these names are starting to show signs of upward movement, a change in trend. Hindalco from the current levels for targets of 635, 645 and a stop loss around the 615 mark does look like a good momentum play building up.
Okay. Well, all right. So, on that note, I think it's time we can get in Siddharth Khemka as well, because we have him with us. He's the head of research and wealth management at Motilal Oswal in the financial services, who joins us the show. Good afternoon to you as well, Siddharth. We've actually spoken a lot about valuations at this point in time, broader markets, larger stocks. So I'm going to actually just focus on the headline numbers, the benchmarks, the Nifty 50. What are you making of the Nifty 50 at the moment in terms of how you would want to potentially move ahead? And if there are pockets in the Nifty 50 that still look interesting to you at this point in time?
Yeah, good afternoon, Agam. Thanks. Glad to be on the show. So if you look at, we have already seen the broader market and Nifty specifically correcting about 12-13%. What we have also seen is that when at the start of the financial year, we were expecting the Nifty earnings growth in the range of 14 to 16%. And right now we have seen 3 quarters of 4 to 5% earnings growth in Nifty, and even fourth quarter Q4 the expectation is of a subdued or a muted growth of about 4-5%. So for the full year, we are likely to see a growth, earnings growth of just about 5%. Next year, on this low base, while the estimates suggest a 15-16% growth, even if we grow at about 10-12%, I think the market will start making a bottom. On the other side, the Nifty PE, 1 year forward PE has come down from about 21-22 times to now about 19.5 times, which is below its long-term average, at least the last 10-year average of 20.5. So that gives definitely some comfort. But at the same time, it is difficult to call out whether the market will make a bottom at these levels, or there could be a further downside of about 3-5% once the reciprocal tariffs are put in place. So that's a big overhang for now, because earnings, also slowdown in earnings is already there in the price, is what we believe. The only overhang that remains is at what rate and at what form the reciprocal tax could be applied in India. We got some news flows yesterday evening or today morning, early morning, about Pharma being included in the list, auto being included in the list. So these are some of the items where it can impact India being one of the larger suppliers of generic pharma in US. Technology is another space which could get impacted. So I think looking at that and looking at what the budget has pivoted from a capex theme to a consumption theme, I think 2025 would be a year where we would be constructive on the domestic consumption theme. The consumption revival is taking place. Urban is still not picked up, while rural has picked up, and for that the government has provided some tax relief in the budget that should start yielding results from the September, you can say Q2. So June quarter, we should start seeing the impact of the higher spending. So a lot of these consumption sectors, both within staples, durables, larger consumption themes like auto, travel, hospitality, some of the consumption finance, also retail financing companies, which are been under a lot of pressure last year, both in terms of business slowdown plus the RBI restrictions. So I think that would be the larger space where valuations comfort is there, stock price comfort is there, and the institutional participation has been low. So them moving from a sector rotation from the capex theme to consumption theme, I think that could be a good play for 2025.
So interesting thoughts coming through. We've had a couple of big events and we are past those, but there's just plenty of volatility. I believe that's what Siddharth is alluding to. Let's pull up the Nifty Auto Index, absolutely flat in trade, maybe slight negative bias if at all. And the Nifty Pharma Index, though, reeling under some bit of pressure, 0.2% lower on the Nifty Pharma, has been in the red all day since the morning. We've seen a bit of a recovery. But, you know, there are some stocks within that pharma basket which are doing fairly well for itself. But let me first talk about those stocks where a potential tariff could get applied and what the impact of that could be. Varsha is here with some of those stocks which are in focus. Varsha.
Thank you, Harsh. So first, let me start with 4 pharma stocks where Macquarie has, initiated a coverage, starting with Suven Pharma, wherein it is set to benefit from high growth cutting-edge CDMO. Now, we all know that Suven, the history of Suven is that Suven normally acquires CDMO companies, at least in the last few years, and because the CDMO, if you see as a sector, is actually growing at a double digit. So one is Suven Pharma, and they see its earnings, Macquarie see its earnings to grow 6-fold by FY30 of FY24 base. Next on the list is wherein Macquarie has initiated coverage is Blue Jet, wherein company is actually moving up in its value chain when it comes to contrast media, which is again growing in a double digit, and profitability and return ratios are expected to improve according to Macquarie, and they expect pharma CDMO business to grow significantly with the ramp up of existing molecules and addition of new molecules. Next on the list of Macquarie is Divi's Lab. Now we all know Divi's has been it's basically the largest CDMO when it comes to India, and they worked with majority of top 20 global innovative pharma companies on small molecule products, and the Divi's has a large economics of scale. They produce in volumes and at very low prices. Custom synthesis is what Macquarie is bullish on, which forms almost 51% of revenue for Divi's. So custom synthesis will actually set for a significant growth, and as per Macquarie, Divi's is poised for triple digit when it comes to top line and 4 times when it comes to bottom line by FY30. Last on the list of Macquarie is Syngene International, and we all know company did a good comeback when it comes to Q3. Maybe the things are on track when it comes to US biotech funding. So according to Macquarie, they are gearing up for the next growth phase and in a unique position to benefit from biotech funding recovery, supply chain de-risking and higher pharma outsourcing, and they expect its medium-term earnings to materially improve, and its increasing capabilities are matched by higher expansion and utilization.
Okay. Okay, so that's of course the story on CDMO, Varsha, and why some of those stocks are really doing well. But talk to us about Trump tariffs and impact on pharma cores.
So pharma has been in focus since many days because of the tariffs that has been spoken about. Now we all know that President Donald Trump hints at imposing 25% of tariffs when it comes to pharmaceuticals. Full announcement will be made on April 2nd, and tariffs may actually go very substantially over the course of the year. Now if I were to talk about the data points, Indian companies supply 60% of generic drug volumes to US, and so basically US is a bigger and important market when it comes to Indian pharmaceutical companies. A hypothetical 10% tariff could reduce Indian pharma companies' EPS or earnings by from 1 to 6.5%, and the bigger concern over here is the long-term impact on growth, as the US is a major market. Companies might shift production to US US-based plans to lessen this tariff concerns, but few of the analysts are also of the view that this will not impact Indian pharma companies, because even after tariffs, the Indian companies will have that cost advantage over US companies, number one. And number two, if the tariffs have been imposed, Indian companies will actually pass on those to the customers. So we need to see how this will impact the EPS. But if I were to talk about the revenue contribution of companies from US, you have Aurobindo Pharma, wherein 46% of revenue comes from US. You have Dr. Reddy's, again 46%. Cipla, almost 28% of the revenue is from US. Lupin has 37% contribution, while Torrent Pharmaceuticals have a very little contribution of 10%. But what if this, so there was this research done by HSBC wherein the 10% tariff impact on earnings per share of these companies. So Aurobindo Pharma will have a negative impact on EPS of 5.5%. Cipla will have a 4%, but the majority impact will have on Dr. Reddy's Lab at 6.5% impact on EPS. Then Zydus Life Sciences will have almost 6% impact on its EPS. Sun Pharma mere 1%, and Torrent Pharma 0.8% as the US doesn't contribute much when it comes to Torrent Pharmaceuticals.
Varsha, thank you so much for that very, very comprehensive look on the impact of tariffs on the entire healthcare space. Well, actually pharmaceutical space. Healthcare is a much broader term. But Siddharth, come in on this particular aspect. We've presented a lot of reports and a lot of analyst views on the impact of pharma, and it does seem like we're looking at about a 4.5% to 5% cut maximum in your EPS estimates based on the tariffs that could come through on some of these, well, pharma names. How are you looking at this particular issue? as well as what are your picks in this particular area? Any interesting ideas that you have here?
Yeah, sure. I think a lot have been discussed, but the underlining factors are yet not clear. How much of the tariffs, or what percentage of tariff would be applied to Indian pharma companies? B, and most importantly, will the companies absorb the full, suppose most of the assumptions are taking a 10% tariffs on the pharma imports, and they are assuming that the entire 10% is being absorbed. So at 40 to 50% contribution from US, you are getting a 4 to 5% hit on the EPS. What we believe is that actually, if you look at the US generics in the last 5 years, the price erosion has already happened to the tune of about 11%. And this has led to a lower cost for the patients, or you can say the consumers in the US. And we know that almost 60% of the generics is being supplied by India. So our guess is that some of this tariff hike will be passed on in terms of price hikes that these companies will take. So the actual impact could be even lesser. The US doesn't have that much of manufacturing facility. It will take at least 2 to 3 years to build facilities in United States, get those facilities under the compliance, the US FDA regulation clear, and then only they can come into the market. So till that time, I think there would be a minimum impact, because this is a healthcare space, and that is something which is very sensitive to the impact will be very sensitive to the people, compared to something like an auto, where the government can take a stand of increasing the price and take a hit in inflation, compared to something in the core pharmaceuticals industry, where the medicine prices will have a direct impact on the patient. So I think, again, coming back, there are players which have a lesser impact or lesser exposure to the US. Those companies could do well. For example, Cipla is something that we like from the US generic space. Sun Pharma, being a large player, has a diversified presence. Only 30% comes from the US space. But again, in this environment, better to stick with the CDMO players. Divi's is our preferred pick there. The earnings have been better due to the better product mix. Revenue grew about 25% in Q3. We see that the overall impact on the generic could be as a positive for some of the CDMO players, where Divi's is the market leader. So I think overall, better to stay with something like a CDMO player. Then we also like Mankind Pharma, where 97% of the business comes from the India market. The recent acquisition of Bharat Serum, that also acts as a key trigger. So given the global volatility, better to be safe. We will have the next 1 month, a lot of commentaries coming from US about the tariffs, reciprocal things. The clarity will emerge. Then only one should look at taking a bet on the US generics. Till that time, would suggest to stay with CDMO players and India-specific players.
Okay. Coach, your views with regard to pharma names? Of course, it's a tricky day for pharma, either moving one way or the other.
Well, in pharma, there are a couple of names actually that do stand out. Divi's is one stock which is actually holding ground for the last few weeks, if I can call it that. The range has been 5,700 on the downside. On the upside, it did attempt to break out above the 6,200 mark, but wasn't successful. So as long as 5,700 is held, I think Divi's could be a good positional play, from a near-term perspective. So that's one stock. But the one that we prefer over Divi's as well is Abbott India. Yesterday in the closing show, we did discuss this for targets of 29,750 and 30,300 with a stop loss of 28,500. In a market like this, Abbott is still holding ground, in fact, gaining ground almost about 1% higher today, closer to that first target. Quite a substantial move on this one in the last 3 sessions and on the back of very decent volume. So if I were to pick one stock in the space, I think Abbott would be it at the moment.
Okay, well, hold that thought. We slip into a short break, but as we do, and since we are talking about the pharmaceutical space, here are a view coming in from the chairman founder of Wockhardt, Habil Khorakiwala, making a point that reciprocal tariffs by the US would not hurt Indian industry and the road ahead for Zenith. Listen in.
The fact is, we have been contributing for all these years. Nearly 50% of our production is exported today. and government has set up fairly ambitious plan for our industry. And our industry is manufacturing industry, yes, but it is much more technology driven industry for its success. And therefore science and research play a very, very important role. I think we spend roughly as an industry 6 to 7% of our revenue on research every year. For example, we spend about 12% of revenue because we are also in a drug discovery space. So from that point of view, what will be important for us to continue to make this kind of contribution or even a greater contribution is we need to absorb newer science and newer technologies like biological products which are coming. A lot of advances are made in genomics or a stem cell. So unless the industry will have to move forward in this area, and I think we need government support in creating regulatory infrastructure for this new science.
Can you elaborate on this, sir?
See, our regulatory infrastructure has not changed over the last 20-30 years. And the science has moved so much forward. And therefore, the way the drugs are getting approved, the way it is being looked at, the people competence to manage new science. We are still very largely process driven, not so much science driven. Now globally, all these regulators are highly science driven along with the process driven. So we have captured the part of process quite okay, but we need to upgrade ourselves in terms of scientific competency which is available in the country. That is one. Second, the level within the government bureaucracy or hierarchy of leadership of scientific people are relatively at a lower level, and it has to be upgraded to much higher level according to us, so that you get a better competencies available. They are available in India, they are available, we have large number of scientists working worldwide. So that knowledge and competency is there with Indians.
You want it to be incorporated?
It has to be incorporated in regulatory mechanism. Otherwise, regulators will take much longer time, and the pace at which the world will move would be slower. So for industry to be competitive, which is important in terms of knowledge, I believe the government organization has to be competitive in a global sense.
Understood, sir. So now that we are talking about regulators, the pharmaceutical regulators, and incorporating some sort of a scientific sense into them so that they become more expeditious and more efficient, we have also heard about a new drug for whose regulatory provisions or regulatory approvals you have gone ahead, WCK-5222, which as per some market rumors could have a market market valuation of about, or the area of about $25 billion. So how do you feel about that? Like, is it something happening very soon?
We already have completed a phase 3 clinical trial for that drug, Zenic, we call it a brand name, 5222. And this is a global clinical trial. So we are in a process of filing to Indian regulators and the US and European regulators in next several months. And we believe it should be in Indian market hopefully early next year.
But are you excited about it?
Very excited because I must tell you, multi-drug resistance today claim in India about 1 million lives. Worldwide it claims about 5 million lives every year. Just to give you severity of this problem, which is not recognized, during COVID time, the total mortality over 2 years was 4 million.
And every year 5 million
5 million people die of multi-drug resistance, and our drug works in fairly large portion of gram-negative, literally every gram-negative multi-resistance, which is roughly claiming 70 to 75% of lives.
So once this comes, you intend to solve the problem of being resistant to...
No, our drug will work.
Okay.
And it is working because we have conducted a clinical trial which has given outstanding result compared to existing drug. And it has proved superior, significantly superior to existing drug. We have also conducted a very difficult clinical trial for India. Drugs controller asked for a fast approval against the best existing drug, organisms which are resistant. Okay, that drug doesn't work like meropenem. And we got 97% success in that.
Entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock.
Okay, welcome back. Thanks for staying with us. Had a longest chat on auto. Would be curious to take views. But before that, we have Anushi waiting by since quite a while. RVNL, that's the stock on our radar today. It zoomed 11%. Of course, after a decentish correction also that the stock has essentially made. But a 554 crore order is what is keeping that one in focus. Here's a bull versus bear case on this one. Anushi.
Hey Harsh, so as you mentioned, we've seen quite a bit of correction in terms of where RVNL is. This is especially after the Q3 numbers which came out, which were on the weaker side. So recovery over there in terms of where the order inflows are concerned. In fact, this brings us to the first bull point which is there higher order inflows. Now every other day we keep on seeing more orders coming in for the company. In fact, if you look at the FY25 order book, the company is targeting over a 1 lakh crore of an order book. This is in comparison with the 90,000 crore current order book which currently holds. If we go back and even check what has been the trend in terms of the order book, FY23, the order book stood at about 56,000 crore. From there on, 85,000 crore, and now a 1 lakh crore order book is what we are looking at. So high growth in terms of where the higher order inflows are concerned, but is this translating to revenues is the main question, because in the end, it all boils down to the execution pattern. So revenue growth doesn't match up to the order book growth pace that is there. So this is on the bearish side by the case that we are making. We have seen in the last couple of fiscals, the growth has remained in the range of 5 to 6%. It's been a single digit growth for the company. In fact, if you look to the book to bill ratio also, in FY23, 3x is something is what the book to bill ratio stood, which is now around 4 times. So execution is something that we should be watching out for. The company does plan to execute this 1,90,000 crore of order book in the next 3 to 4 years. So focus would remain on that. But coming to the second point is on the revenue growth, which was there. We just spoke about it. Now, if you look at the 9-month picture, the revenue picture, the growth has been, there has been a degrowth of around 11% at 13,496 crore, and this is on the back of couple of factors which are in consideration. This includes elections as well as delays in some of the projects, which has led to this kind of a downtick. But the management remains very bullish. We just had recently we had a conversation with them, and they expect a 6 to 8% of a revenue growth in FY26, and this growth is not going to be based on the FY25 number, which is the low, which will form as a lower base considering this decline in revenues that we are looking at. But it's over FY24 that they project the 6 to 8% of growth coming back for the picture. But moving on to the third point that is there, now the expectation is that the margins also, if you are looking at, they have remained in the 5 to 6% of range, but the company is bidding for projects with higher margins in the range of 8 to 9%, and going forward in the next 1 to 1.5 years, they expect an uptick in terms of where the margins are concerned. However, what we have seen is that the markets have not been too kind to this stock in the recent time. This is because of the kind of results that we've been seeing in the last 3 quarters. The stock is down about 35% in the last 6 months. In the last 1.5 to 2 years, we have seen a strong rally for a lot of railway stocks that are there, but valuations is something which has remained a concern. So if you look at what the valuation picture is for the business now, the current valuation that stands at about 49 times the trailing PE multiple if we take, and if we compare it to the 3-year average, that was at 23 times. So despite the correction that we've seen, is valuation still pointing towards a downward trajectory for the company, something that should be watched out for. But coming to the final point is this shifting focus from the traditional business. Now it is also concentrating in its non-railway business. It has a 40,000 crore of its order book is from the railway side, but the rest from the non-railway side. So it wants to diversify accordingly. However, in budget allocation, in Ministry of Railways, if we see the budget allocation stood at 2.52 crore. Last year, we had seen about a 5% growth. This year, the growth in terms of where the railways was remained majorly flat. So this was on the bearish side, and this is the overall outlook that we are seeing in terms of where RVNL is and what the industry outlook is.
Okay, Anushi, thank you so much for joining us and giving us that update on RVNL, the bull versus bear picture. But Ajit, I want to come back to you on Tata Motors because this is something that was interesting. So while we cover the fundamentals, I wanted your view on the technicals here as well.
So Agam, we are in the 7th month of correction, and despite the oversold position, we are not seeing any sign of a decisive rebound. Means the stock had made multiple attempts to reclaim its first area of resistance, that is 20 EMA. But after a couple of days of consolidation, it eventually resumes the overall downtrend. From the last 7-8 days, we are seeing some sign of pause, or the volumes have dried up substantially also. So this indicates somehow that sellers are also exhausted after this complete mayhem in the last 7-8 months. So this could trigger a surprise move, a positive move, once we see the stock surpassing 705 levels. In that case, it could be a very sharp move towards 760, 780 area also. So as of now, it's in a wait and watch. But yes, the way the price and volumes are portraying the current picture, possibility of a strong rebound is high. But having said that, one should not get carried away because we are not seeing any decline. Wait for the confirmation, wait for a breakout above 705 before entering any fresh trade.
Okay, Ajit, we leave it at that. Thank you so much for joining us and taking us through your views on the markets and, of course, a handful of ideas that we discussed. But on to another set of stocks that may remain in focus today, and that is the IT pack. That's on the back of Capgemini announcing their calendar year 24 results. Rucha joins us to give us more update on this one. Rucha.
So for sure, Nifty IT is buzzing in trade, and this is on the back of Capgemini reporting its CY24 results. Now, Capgemini is a global IT company. It has reported its numbers slightly above consensus estimates and towards the top end of its guided range. But what is more important for Indian IT companies is the 2025 guidance which it has given. Now, in terms of constant currency revenue growth, the guidance range stands at -2% to +2%. Operating margin range stands at 13.3% to 13.5%. But what are the implications for the Indian IT sector? Let's talk about what CLSA believes. Well, CLSA believes that the guidance definitely implies more uncertainty. However, this is more specific to Capgemini than setting an overall trend over here. And this is also because Capgemini has largely proved to be a laggard because of its high exposure to France, EU, UK, and also the manufacturing vertical, which has been under pressure over the past few quarters. Therefore, they reiterate their optimistic stance on Indian IT companies. They also believe that discretionary demand is now picking up, especially in the US and in the banking and retail space. And remember that this is what we had heard from most of the management in the latest earnings as well. Now, in terms of what Infosys has guided for its FY25 number, the FY25 constant currency revenue growth guidance stands at about 4.5% to 5%. HCL Technologies have also guided in a similar range, in actually a same range, 4.5% to 5%. But we'll definitely watch out for what the management are actually talking about discretionary demand and demand pickup in the US. So this can be sentimentally weak for Indian IT companies, but as CLSA believes that this is more specific to Capgemini than setting an overall trend.
Okay, so more specific to Capgemini than the overall trend. Sudeep, is that your view as well?
Well, absolutely. I think Capgemini has significant exposure to defense, and they have a vertical which is on manufacturing. I think there can be some pressure. Indian IT, by and large, doesn't fully kind of replicate this model. They have a different model, and I would go company-wise as far as exposure and as far as the guidance is concerned. The way things are positioned, I think companies having exposure in travel tourism will do well. Companies having significant exposure in BFSI will do well. So you have to pick up pockets and see if the underlying industry is doing well, and if an IT company has significant exposure in an industry which is doing well, I think their projections and their expectation of performance also should be accordingly tweaked and accordingly estimated.
Kush, we did take your view on IT. Cautious, right? Overall as well.
Indeed, I mean, among the large caps, only HCL Tech stood out among the mid and small names. You've got a persistent that seems to be doing well over the last couple of sessions. In fact, if you look at the IT index, it is trying to dearly hold on to the 200-day moving average, also the medium-term support zone of 40,500. Any break below this could actually perhaps weaken the sentiment further. So you're right, a bit cautious, maybe selectively. You could start nibbling, but I wouldn't go all out because of the dip that the sector has recently seen.
Okay. Kush, coming back to you on RVNL as well, since Kanushi was talking about it, and today we have seen a very sharp up move. How are you assessing this one on the charts?
Rather delicately poised. It's been in a downward sloping channel for some time now, and by that I mean a goodish about 8-9 months or so. Every time it does come to that upper band of the channel, you see some sell off. This time around, the upper band of that channel and also the 20-day moving average seem to coincide by a margin. So 400, 405 thereabouts is where that resistance comes in once again. If someone wants to do a range play, then perhaps on the kind of bounce that we've seen and on the back of a positive RSI divergence on the daily setup, there could be some more momentum that could come in up until the levels of 390, 400. But any meaningful up move will only begin once this 400, 405 band is taken out. If you're looking for a quick momentum trade, then perhaps for a target of 395 and a stop loss, a tight stop loss near the 370 mark, something can be considered. But if you're looking at positional play, something like a turnaround, I would wait and watch to see the 400 and 405 rather mark taken out convincingly on a closing basis, then perhaps we could see some signs of a reversal on names like RBNL.
All right. Well, on that note, let's get in Mahima as well, and she is going to tell us about why Venus Pipe has surged in trade today after Investec has initiated coverage on the stock. Mahima, over to you.
Right, Agam. So basically, Investec has initiated a buy on this particular counter, which gives a target price of 1,665 for the company. It's up almost 4% on the back of that. They've mentioned a couple of reasons as to why they're bullish on Venus Pipes. First, it being the fastest growing player in this particular industry. What they're saying is that backward integration will boost overall profitability going forward. Incremental expansion offers are attractive right now in terms of ROC profile in the titanium tubes, the hygienic tubes as well as the fittings. And lastly, what they're saying is that they expect EBITDA to grow at a CAGR of 21% over FY24 to FY27. So these are the key reasons as to the reason as to why they are bullish on Venus Pipes.
Okay. Thanks so much for that, Mahima. Kush, your quick take with regard to technicals on Venus Pipes, 4% higher.
Very interesting setup. Positive divergences on multiple time frames. Stock very close to the medium term or rather long term support zone of 1175. So if you do want to consider, it makes a good bet from a risk reward standpoint. 1175 is where I would place that stop loss. On the upside, you're looking at targets of 1300 once that is taken out, 1375 as well. So as I said, quite a bit of risk reward play here. And some of the technical indicators do suggest that the stock could be poised for a turnaround.
Okay. Sudeep, your quick take with regard to this one. Want to quote Investec on this one. They're saying it's the fastest growing player. Incremental expansion offers attractive or a better return profile for some of the higher end tubes that they are selling at this point, and EBITDA growth expected to be 21%. Are you positive on this one?
Well, definitely positive. I think this entire sector, according to me, should be doing well. One has to, of course, be cognizant of the valuation at which some of these stocks are quoting, and then you can take position. And if you're a investor with a slightly longer term horizon, considering the economic activity which is happening or expected to happen in the near future, I think this is one sector which definitely should do well. This is a well managed company, and just the issue is on the valuation. So one has to be careful. If you have a longer term horizon, as I said, it's absolutely fine.
Okay, well, let's move on and in fact talk about NDTV Profit's first ever conclave, where we also spoke to Ridham Desai, MD and Chief Equity Strategist at Morgan Stanley India, where he reveals what he has been doing for 30 years to ascertain and why this might be the best time to invest in the Sensex. Hear him out.
I like to measure the Sensex in gold ounces. I've been doing that for 30 years. This is the cheapest the Sensex has been in gold ounces since November 2020.
Sorry, can you explain that?
How much Sensex can you buy with an ounce of gold?
Achha, okay, fine.
Okay. So this is the cheapest since November 20. It's like COVID.
Oh, okay. Okay.
So people like to measure the Sensex in earnings term, in INR terms, in dollar terms. I like to also measure it in terms of gold ounces. So
interesting.
This is the cheapest it has been in 4.5 years.
Okay, so of course, while we continue to keep an eye on the Sensex, Sudeep, I did want to come to you on yet another interesting stock, and that's Paytm. The reason why it came on my radar is because it's actually trying to stay afloat around the 200 daily moving average. I know you don't look at technicals, so you give me the fundamental view on what you're making of Paytm.
But they are getting into distribution of financial products in a big way, and I think this can, in the long run, give them definitely good returns. Business model, finally, I think, is kind of stabilizing around the distribution of financial products, and I would expect the company to start performing. At some point of time, they will start making profit also. But I think, considering the valuation, I will be still a little careful. Yes, they have a lot of cash in the balance sheet, they have a lot of firepower, and they have started doing well. But still, the valuation to me is rich. And a company with a distribution business, financial services product distribution business, probably doesn't deserve this kind of a multiple. Of course, they have other businesses which are also growing, but I will be still careful as far as valuation is concerned.
Okay. Now, I want to try and take your view as well, Sudeep, on something like a Nuvama. You've seen a bit of a fall in the stock price. It's a fast-growing sector. Capital markets to trade at the valuation that it has. Would it interest you at this point?
Harsh, financialization of saving in Indian economy is real. It is happening as we speak. Last 3-4 years has been great for all these capital market related stocks, whether it's directly capital market related stocks or capital market infra stocks. All of them have performed well, reached valuations which were unthinkable, let's say about 5 years back. And I believe the way forward is also good. It's not that you have hit a major roadblock. Yes, there are challenges in the capital market, so the valuations have come down. And in any case, the valuations had reached a level where some bit of correction was probably warranted for the performance to catch up with the valuations. So long term, I continue to remain very positive on all these capital market related, including capital market infra stocks. Short term, I think there will be volatility and there may not be major upside in the short term. But from a long term point of view, these are good buys.
Okay. Would any of these look attractive on charts, Kush? A BSE, a Nuvama, all of them buzzing in trade today.
Sold my stock. I was just going to say that, while you're looking at a Nuvama, perhaps even a 360, why not BSE? I mean, that's one stock that has done so well. Especially if you put it in context, the markets have been all over the place. This stock is just consolidating within a broadish band, but still, see the kind of recovery, the recovery move that it has made today. BSE for sure stands out, and as I said, it's done rather well in a volatile market like this as well. So from from a positional standpoint, also not a bad idea to consider something like a BSE with a stop loss, a deepish stop loss near the 5200 mark. On the upside, my target would be the recent highs, the recent swing high it made, which is 6,000 plus. Once that is taken out, you're looking at a 6350 kind of a move as well. Why not stick to something like a BSE, almost a monopoly duopoly kind of a space, price action also very comfortable. I would have this one on top of my radar from the capital market player.
It certainly was on the top of my radar at the start of the show. I don't know how I missed out on talking about BSE today, but well, we have addressed it finally, so not worried about that. But Kush, now that we're moving towards the close of the session, any interesting buy today, sell tomorrow ideas?
Indeed, Agam. Shri Cement, this stock has been popping on my on my system for a while now. The way we track markets and the way we screen them. If you look at the kind of move that it has made over the last month or so, it's been phenomenal to say the least. Especially when you put things in context. From 25,000 up all until about the 28 to 700 mark right now. The volumes have been fairly decent. Today also the price action is fairly encouraging. I think this up move could continue, and if the markets do support, I think the stock could very well see 30,000 plus kind of levels. But from a near-term perspective, if you're looking at trade, 29,250 and 29,900 are your targets. 28,100 is where you place that stop loss. So BTSC trade plus something also that can be considered as a positional bet for weeks to come.
Okay, but Sudeep, let me pose this question on BSE to you, because while the company does pose a good runway in terms of growth going forward based on what we've already seen, the question really is that in terms of valuations, this is one of those stocks which has just not corrected, even as we see so many of the other peers correct about 30-40%. So how would you rate BSE at this point in time?
I will continue to maintain my view, which I gave a little while earlier. I think long term, these are good stocks. Valuation, yes, it is a rich valuation. But, some of these stocks you'll never get cheap. So if you really want to build your portfolio, want to include some of the capital market infrastructure players, BSE is definitely a good place to be in. Couple of things which is particularly relevant for BSE. Compared to 3-4 years back, I think the regulatory framework has changed in a manner that does help BSE. And rightly so, because we didn't want to have a monopoly. We wanted to have a structure where BSE also gets a share of F&O volumes. The weekly closures and the way the regulations have come over the last 6-8 months also has favored BSE. Not unduly, but rightly helped BSE, I would rather say, to increase volumes and increase business. They also have a significant shareholding in CDSL, which again is doing very well, and their also valuation is, there's a decent valuation there as well. So that CDSL valuation also, part of that comes into BSE. Overall, the way the Indian market and financialization of savings is happening, I think long term is definitely good for an exchange like BSE. So there is absolutely no problem in somebody either acquiring BSE for a 3 to 5 year kind of a time horizon, or somebody holding BSE continuing to hold it.
Okay, one stock which is on a tear is Hindustan Foods. I want to quickly address this one with Kosh. Kosh, 12%, you're seeing a spike on the stock, maybe a few minutes late to catch that spike, but we've caught it now, 12% higher. What's the sense?
Not a bad move at all, and I don't mean that by the kind of by the kind of percentage gain or the price action that you're seeing today. More from a technical standpoint, the stock did attempt a recovery about a month ago, fizzled out, but that was more in line with the markets today. With the kind of move that you're seeing, the stock will, in all likelihood, close above the 200-day moving average, which is at the 550 mark. Give it one more day. This is very likely a reaction to a news or numbers or something that at least I am not aware of. But if the follow through does come in tomorrow, and if the stock does sustain above the 550 mark, which is the 200-day moving average, I think this momentum could well continue. It's broken above some resistance levels. So this is a very interesting spot, I must say. I will have this on my radar. I will not buy it today. This could be an emotional reaction or perhaps a reaction to a news that, as I said, we are not aware of. But tomorrow, if this momentum does sustain, then even from there on, the risk reward ratio will be attractive and can be considered for a buy. So put this on the radar, see if it holds above the 550 mark tomorrow as well.
Okay. I'm itching to take a question with Sudeep, but I'm going to hold on to that thought. What to watch? Let's quickly close on that one. You have the European Commission winter forecast, okay. You have US FOMC minutes. That's something that I'll have my eye out on. China loan prime rate, okay, that also. Let's look at a couple of corporate actions also coming through. You have IRCTC's dividend and you have PNG Hygiene also dividend. Both of those record dates also tomorrow. But Sudeep, what I'd really want from you and help me understand this. You've seen sharp falls in the Nifty Realty, and it's one of those spaces, sectors where you've seen a decently large correction, right? Anything you're liking within the Realty pack? Is this an opportunity to buy within Realty? Because I know you mentioned certain stocks at the start, maybe an hour or so back. Realty wasn't part of that.
Yes, Realty wasn't part of that because, the way Realty always has worked in India is there is enough and more volatility in this sector. And I believe that this volatility will continue. To your specific question, whether we like something amongst the Realty stocks after the recent correction, we do. DLF has been our favorite for quite some time, and we continue to maintain that view. I think, DLF for a little aggressive investor.
Okay, all right. I think we do have a technical problem with Sudeep, so we will be back with that one. But while we are, okay, I believe we do have Sudeep back. Sudeep, please go ahead and complete what you were trying to tell us.
Well, I was talking about DLF, and I think you guys got that. Other than DLF, I think some of the Mumbai real estate plays also will continue to perform and deliver. So whether it's a Macrotech or an Oberoi Realty, both can be looked at current level for a slightly longer horizon. There is absolutely fundamentally no problem. The real estate up cycle, which we are witnessing for the last 3-4 years, I think we are in the middle of that cycle. So another 3-4 years, this cycle is expected to continue. In interest rates, remember, are coming down, and this does help real estate generally, and specifically some of these companies will also benefit. We may also see some of the smaller real estate players also getting into the act once the real estate interest rate starts coming down further. But at this stage, if I have to recommend, I will recommend DLF and also maybe Oberoi Realty and Macrotech.
And while we're at it, Kush, if I can get a very quick view on Oberoi Realty, how would you address that one?
Attempting a recovery, there's a base formation attempt in place near the 1550 mark, and there is a possibility that it could rebound, but I would let the price action confirm that. So let it sustain above 1600 for one more day. This is the first day after a couple of sessions that it regained that level. So if it does sustain, then it will make a play. Up until then, as most of the sector continues to remain volatile, and I'll put this on a wait and watch.
Okay, wait and watch. Thanks so much, Kush, Sudeep, for joining us this afternoon, giving us all of those views. Minute and a half from close, so we'll let you go on that note. But let's quickly look at the Nifty 50 index. We're largely flat, right? And no harm done per se, frankly, Agam. Let's look at the intraday graph on the Nifty as well. And there you go, just about 0.1% in the red, but not inching meaningfully towards 23,000.
Yeah.
Is that possibly a concern?
Yeah. No, you look, we were always going to talk about 23,000, but it's more than a resistance. It's a little bit of a fulcrum, a pivot point. But it's going to be something of a wait and watch. But Harsh, why don't we show them how the heat map has turned out?
Absolutely. So the Nifty 50 heat map, some names which didn't do well is what I'll start off with.
Yeah.
A few names in the IT space, of course. Pharma was under pressure selectively, even though some pharma names did well on the back of a decentish Macquarie note which came out initiating coverage on CDMO names. But outside of that, it was pretty much a mixed bag. Banks and financials stood out. They did decently well for themselves. On the larger private banks, a Kotak and Axis standing out. But outside of that, look at a Hindalco. Metals also did decently well. Let's pull up the heat map on the sectors as well. Try and zoom in, and likely that's how the screen is shaping up. Look at metals, 1.25% higher. The Nifty Private Bank and the Nifty Bank roughly 1% or so thereabouts. But the Nifty PSU Bank is 1.25% higher. So that too has done fairly well for itself. What's not done well? Pharma, FMCG largely flattish, but IT 1.4% down. That's where some of the pain really is, Agam.
Yeah.
Quickly on the advanced decline, if we can have the graph, there you go, the intraday. Largely in favor of the advances. Broader markets did well for themselves.
Yeah.
They outperformed the Nifty. And Agam, I'll let you take that one.
Absolutely. So let's talk about that. Let's bring up the mid-cap index. Let's bring up the small-cap index and see how things have fared. So the mid-cap index, a clear outperformer as compared to the Nifty 50, up around 1.4%, as is the case for the small-cap index. Clearly the gainer, the top mover here, up around 2.2%. So let's pull up the list of all the stocks from the broader market index, which have also moved considerably. So we do have JBM Auto, Tata Investment, RVNL, of course, is something that we addressed in the show as well, along with Aegis Logistics. Mazagon Dock, along with a handful of other companies from the defense sector, are also doing very well in trade today, and Bikaji Food and Capri Global. On the losing end, do remember, firstly, in terms of momentum, there isn't as much as compared to those advancing, but credit access under pressure today, as is the case for Archean Chemicals, JK Paper, and Godfrey Phillips continues to show weakness in today's day of trade. But say for that, overall, considering the market breadth is a positive one, at least in the broader markets. And in fact, even on the Nifty, I know that it's a flat day of trade, but more gainers than losers is always, or bodes well with sentiment in the markets. The question really is that, do we continue to see a positive market breadth sustain over the next few days? And if that does come through, can we expect a bout of short covering, something that a lot of market participants are waiting? That's a wait and watch. But on that note, well, thanking you for joining us, and well, giving the chance to Harsh and me to present this closing show. It's a wrap on this edition of India Market Close, but lots more lined up. On the other side, stay tuned in. You're watching NDTV Profit.
very special package and measures are kind of focus on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invested? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11.
It's an NDTV Profit exclusive. A day after Tesla posts the hiring update for India on LinkedIn, sources now say retail operations for Tesla are likely to start in the second half of 2025. The Elon Musk-owned company has also listed new engineering and IT jobs for Pune and Mumbai. In a fresh salvo on global trade, US President Donald Trump floats tariffs of 25% on automobiles, semiconductors and pharmaceuticals. The announcement comes on the heels of 25% tariffs on steel and aluminium. NDTV Profit's first conclave ended successfully yesterday. We saw a slew of corporate leaders and impactful market voices delivering their views on important matters like tariffs, manufacturing and the India story as a whole. A 30-year-old man in Bengaluru wins 65,000 rupees in compensatory damages after he sues PVR Cinemas, Inox and Book My Show for wasting 25 minutes of his time by running lengthy commercials before the screening of a movie and causing mental agony. Nifty Sensex end flat amid range-bound trade. The highlight comes from the stellar recovery in broader markets that snap a 9-day losing streak to outperform benchmark indices. Swearing-in ceremony of the Chief Minister and new cabinet of Delhi will be held at Ram Leela Maidan tomorrow, 20th February. However, suspense and speculation over who the next CM of Delhi is continues. The Delhi High Court goes hard on the centre and Indian Railways over the stampede last week at the New Delhi railway station in which 18 people were killed. The court demanded to know why the railways had continued to sell tickets in excess of the numbers of passengers who could be accommodated on a couch. After a slew of controversies, the ICC Champions Trophy begins with host nation and defending champion Pakistan taking on New Zealand in the opener at the National Stadium in Karachi. India plays their first match tomorrow. The 50-over tournament makes a return after an 8-year hiatus. Hello and welcome. Good evening. This is Profit 360 on NDTV Profit and I'm your host Malika Mishra. Along the next half an hour, we will bring you the latest on markets as well as national and international news. It's an NDTV Profit exclusive first. The most exciting news of the year. Elon Musk's Tesla is all set to finally make its grand entry in the Indian market. We have learned that Tesla will start its retail operations in India in the second half of 2025. Also, their cars will not be assembled here and will in fact arrive fully assembled from Berlin. Understandably, this could possibly heat up competition in the EV space. My colleague Tushar, who's brought us this story, is joining us now. Tushar, firstly, what kind of Tesla car are we going to see on Indian roads and as early as second half of this year?
Yeah, that's right, Malika. So what we are gathering from sources is that Tesla will enter India in the second half of 2025 with the Model Y in tow, because that's one of the two right-hand drive cars that Tesla makes at this point of time. The Model Y right-hand drive, or the RHD, is manufactured in Berlin, while the Model 3 right-hand drive is manufactured in Shanghai. So the likelihood of the Model Y right-hand drive coming in from Berlin is higher as compared to the Model 3 RHT coming in from Shanghai, because of the import restrictions that India has placed on China at this point of time. The Model X, the Model S, as well as the Cybertruck will not come to India because they are only available in the left-hand drive configuration at this point of time. Like you said, yes, completely imported cars, completely built-up units, which is CPU, no assembly operations at this point of time. New jobs have also been announced, one for an engineering post in Pune and as a charging developer in Mumbai.
Okay, got it. And right now, Tesla's entry will also create job opportunities, as you said. And we saw on LinkedIn yesterday that Tesla was hiring for 13 positions. And today we're seeing more openings across Mumbai and Delhi for especially engineering, IT, R&D, and more such venues. Now, obviously, implying that it's not just one arm or department of the company that's looking into hiring from India, right? Give us some more sense about what kind of job opportunities are we going to see, and where else can people expect to apply?
So most of the jobs that have been listed on LinkedIn as well as on Tesla's careers page on its website are to do with sales and service operations. So essentially front end as well as the back end for their showrooms that will actually come up in BKC in Mumbai as well as Aerocity in Delhi. That's what sources are saying, and that has also been reported by other publications. Essentially, the bulk of the hiring at this point of time is for the retail operations. Only 2 positions have been for beyond that, so to speak, in terms of, say, R&D, supply chain. We also know that that the company Tesla has stepped up its hiring or stepped up the workforce for its supply chain within India. Remember, the company already imports into the US about $1 billion worth of auto components from the country.
Okay, got it. Now let's talk about the competition right now. We saw yesterday Indian players are unfazed by Tesla coming in. Mahindra & Mahindra's Group CEO and Managing Director Anish Shah told NDTV Profit at the conclave that happened yesterday that he's confident about competing with foreign players.
Because that's exactly the question that was there 25 years ago when various deep-pocketed global players came into India and Mahindra was written off as dead, saying you're not going to be able to compete with them. Right? That's happened on multiple occasions. Today, we have the products that speak for themselves. And in fact, we went to the extent where at our launch, at our test center in Chennai, we actually had some of the best vehicles in the world there along with our vehicles, and we invited the folks at the launch to drive all of them. And our vehicles stood up extremely well against some of the best vehicles, some of which were priced 3 times or 4 times our vehicle as well. So that confidence today comes from the people we have, from what they've done, from what they've developed. And therefore, we feel fairly good about the fact that we can compete with various folks.
And then Chairman Anand Mahindra also took to X and said Mahindra is here to stay and will be relevant in decades to come, after a user asked him about Tesla. But Tushar, what have you gathered on the competence of Indian players? Do they really have no reason to worry at all?
Yeah, actually, both the Mahindra executives are right. This is 2025 and not 2021 when Tesla first brought the Model 3 as well as the Model Y for testing in Indian conditions. Now both Mahindra with its B6 and the XEV9e have some really good products which are built as an electric vehicle ground up. Again, obviously, MG as well as Tata Motors are doing wonders in this space. The EV market in India is growing at about 20%. So the the EV ecosystem in India has also matured. Charging is more commonplace as compared to 5 years ago. So in the event that Tesla decides to go down to those levels of 25 to 35 lakh rupees, yes, it will ruffle some feathers for Tata Motors and Mahindra, but I'm sure they'll. It seems like it that they will actually hold their ground in that space. What's more worrisome or immediate impact will be for the Germans, the Audis, BMWs, and the Mercedes-Benz, who play in the 60 to 70 lakh rupees price bracket for their entry-level electric cars in India. That's where the Tesla Model Y as a fully import will sit at this point of time. When manufacturing starts happening, if Tesla decides to start manufacturing in India, it will go up against Tata Motors and Mahindra. But by that time, both these companies, as well as Maruti Suzuki and Hyundai, will be more than ready for the challenge that's coming up.
Right. Thank you for explaining that story to us from all sides possible, Tushar. Viewers, moving on in another addition to Trump's tariff saga, US President Donald Trump is likely to impose 25% tariffs on imported automobiles, semiconductor, chips and pharmaceuticals, a move that could significantly impact global trade. Trump suggested that auto tariffs could take effect as early as April 2nd, coinciding with cabinet reports on trade measures.
We're going to be announcing some very, very big momentous decisions are being made by companies all around the world, the biggest, and they want to come back into the U.S. Car plants are being canceled in other locations now because they want to build them here. I think it's a very important thing, and you'll be seeing this over the next, probably over the next 2 years, to be honest, but you're going to see a lot of it over the next couple of weeks. A lot of big ones are going to be announcing.
Decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%.
What about semiconductors and pharmaceuticals?
It'll be 25% and higher, and it'll go very substantially higher over a course of a year. But we want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariff.
Earlier, President Trump implemented a 25% additional tariff on imports from Canada and Mexico and 10% additional tariff on imports from China. Energy resources from Canada faced a lower 10% tariff as well. President Trump took bold action to hold Mexico, Canada and China accountable to their promises of halting illegal immigration and stopping the flow of poisonous fentanyl and other drugs into the United States. My colleague Puneet will give us a better perspective on the impact of Trump tariffs on the automobile sector.
The Trump administration has come out and announced another essential 25% tariffs on automotives, pharmaceuticals as well as semiconductors, and we speak about the automotive part currently because while India's overall share of export of automobiles is quite minimal, the auto component and the tire makers might get impacted because of this particular move. Now we've spoken about this in the past as well that companies like Sona BLW as well as Samvardhana Motherson are key focus on the export markets, while players in the tire space like JK Tires as well as Balakrishna Industries have focused on revenues and have local manufacturing facilities as well. So we just break down some of the key companies to watch out for in case these tariffs do come in. The first one is of course Sona BLW. They have roughly 40% of revenues coming from the North America region. Now what is unknown is how much is it which is localized, which won't get any kind of tariffs. That is the kind of number that the company doesn't give out, but they have an overall exposure of 40% in terms of revenue. They also have an operational plant in Mexico and another one coming in about 3 to 4 quarters time. So any kind of tariffs will be detrimental for the company. The second one, Samvardhana Motherson. Now they have roughly about 400 facilities all over the world. Some of them are of course in the North American region, but currently about 18% of the revenue comes from the US, while roughly about 4% is coming from Mexico, and they already have and are commissioning one more plant in Mexico in this particular quarter itself. So any kind of measures will of course be very weakening in terms of the profit margin for the company. And
right. And despite Trump's mega announcement on imposing reciprocal tariffs on a variety of imported products, industry leaders across India Inc. seem to be in a wait-and-watch mode. We in fact spoke to various business moguls at the NDTV Profit conclave, and most of them echoed confidence and eliminated fear of being negatively impacted. Let's give you a peek into some of their comments.
our situation with America is pretty much different than many other countries. And therefore, as I said earlier, we complement each other. We can give mutual concessions to each other, tariff reductions, make it easier to import and export both between the two countries. We've already taken a significant number of measures to strengthen the US-India relationship. We have both strategic, bilateral, multilateral engagements. We have defense ties. We have strong ties in education and people-to-people ties. So together, we are working on several initiatives. Trade will supplement our efforts to do much greater good for the people of US and India.
While we talk about the tariffs, I think, first of all, I think it's going to be more bilateral, because I think when we're talking about two countries, they've already come to a conversation where they're going to be talking about growth in both the countries, and it's going to be beneficial to both the countries. So I think for me, I'm more positive about it. To Mr. Khurakwala, when he talked about it'll be passed on to the consumer. For us in home textiles, it is a very small part of that wallet share where, we are that towel or a sheet or that rug that they use, and it is very, very sensitive.
Yeah.
So I think it will be something that we will have to work mutually.
Basically, to make a change in formulation, for example, takes roughly 3 to 5 years. So from that context, there is, unlike steel or cement, you can switch suppliers at a day's notice. You can't do this in our industry. So the view I have is short term. Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
Okay.
But long term, one doesn't know what happens after 3 to 5 years.
In an interesting case, a 30-year-old man in Bengaluru has won 65,000 rupees in compensatory damages after he sued PVR Cinemas, Inox and Book My Show for wasting 25 minutes of his time by running lengthy commercials before the screening of a movie and causing mental agony. In his complaint, Abhishek MR alleged that in 2023, he booked 3 tickets for the movie Sam Bahadur for a 4-5 p.m. show. He claimed the movie was supposed to end by 6:30 p.m., after which he planned to return to his work. But to his utter surprise, the movie began at 4:30 p.m. after advertisements and trailers of movies were streamed, which wasted nearly 30 minutes of his time. PVR has also issued a statement saying they will appeal as they have a strong case and did not violate any trade practices. My colleague Shubhana is bringing us all the details from the ground.
A district consumer court in Bengaluru has fined over ₹1 lakh on PVR and Inox for wasting viewers' time by showing long ads before a film begins. Now, a viewer has actually complained against PVR Cinemas, claiming that they were showing and telecasting ads and trailers for over 30 minutes before the scheduled time of a film screening. Because of this, a viewer was actually late to work. Now, the consumer court, apart from the fine, has also ordered PVR Cinemas and Inox to pay ₹20,000 to the complainant for the mental agony and inconvenience, and as well as ₹8,000 for the expenses that he bore to file the complaint. Now, the consumer court has also ordered PVR Cinemas and Inox to stop engaging in such unfair trade practices and to make the payment within 30 days to Consumer Welfare Fund. Now, the matter is dated as of December 26, 2023, and the viewer had actually purchased 3 tickets for the movie Sam Bahadur.
Let's now take a look at the Indian stock market. Indices closed flat as concerns over potential US tariffs on automobiles, pharma and semiconductors weigh on sentiment. Sensex ends below 76,000 levels, whereas Nifty ends below 23,000. The highlight, however, comes from broader markets that snapped 9-day losing streak to outperform benchmarks. Harsh is joining us with a complete market roundup.
Well, the Nifty closed absolutely flat in trade today, but some bit of positivity, at least in broader markets. Let's look at the Nifty 50 index first. Let's look at it intraday. We've gone higher, but we've come off those highs as well. So it's a little bit of a bittersweet, but we've closed flat, and that's the one key positive on the index itself. That's the intraday chart, just off the lows, but off the highs for sure as well. 23 and 50 is what we've done, so maybe 110 points odd lower from the highs. But let's talk about the Nifty 50 heat map. And what you'll see is while financials did fairly decently for themselves, with some of the PSU banks as well as the slightly medium-sized private sector banks doing very well. What you did see was IT was the key drag. And within IT, TCS, Infi, and that's because of the Capgemini commentary which came out. And that kind of led to the whole sector seeing a bit of a drag. FMCG also was fairly muted. Look at the likes of a Nestle. Look at what a Trent has done today. So largely 0.5 to 1% lower on some of those FMCG names. Britannia was down 1.1% odd. Some names which stood out, a BEL, a Hindalco's on the top gainers, and Dr. Reddy's was the top loser in trade today. Let's look at the mid space. The small and mid cap space was buzzing in trade today. You look at the advanced decline as well. We saw a healthy one at that, 1.5% on the Nifty mid cap, 2+% on the Nifty small cap. And when you're looking at the advanced decline, the breadth was extremely healthy. So nothing like what we saw on the Nifty reflected here. So that's one of the positives that we take home. But the other piece is also with regard to sectors, and let's zoom in a little bit on that. You look at IT was sulking, 1.3% lower. Pharma was down 0.7%. FMCG 0.25%, slightly muted. Auto was flat, and auto particularly under pressure because tariffs, of course. Pharma too, similar reason. Let's look at what did well. Within the broader markets, Realty was the one index that stood out, along with the metals pack as well. Those are the BSE 500 top gainers, top losers for the day.
Whoever has control over AI will lead the global soft power. That's the word coming in from India's first AI unicorn, Fractal AI's Shrikant Velamkane. From the sidelines of NDTV's maiden conclave, my colleague Rishabh caught up with him and discussed the global AI landscape and India's potential in this space. Listen in.
See, AI is one of the most game-changing, general-purpose technologies out there. It's on the same scale as internet, mobile, cloud, but only much bigger. And it's probably bigger than all of the three things combined. And because it's general purpose, it means that it can be used across a wide range of applications in defense, in civilian uses, and a number of other places. And because it's such a powerful technology, it also has impact on how industries will be shaped, jobs will be shaped, and therefore whoever has control over this technology and the advances in this technology has higher bargaining power, soft power in the world. So you can see that people want to be ahead. And the DeepSeek revolution that happened just a month ago, and when DeepSeek was launched, before that the prevailing notion was that AI models are very expensive to build, not every country can afford to build them, and you know what, people are so ahead of the race that don't compete with us. But what it has done is two things. Number one, it has told us that the AI revolution is just getting started. We're in the first chapter of this book, not the final chapter of this book. There's a lot to do. And number two, that it's not that expensive. A country like India with 1.4 billion people absolutely must compete in this race. My guess is that in the next 10 years, for every major company in the world, India will be the second largest destination of talent after their home country, if not the greatest destination of talent. So that is the power that we're talking about. Now coming to your question on AI and what role does India have to play on AI? So you're absolutely right. India already has the world's best talent in AI. It's 1 in 3 AI researchers worldwide is of Indian origin. So therefore, India is obviously contributing to the AI mission. Some of the greatest researchers I've met in AI globally have been of Indian origin.
In fact, viewers, at a dedicated panel discussion on India's positioning in the field of AI, where Microsoft India's Puneet Chandok and Upgrad's Ronnie Screwvala also weighed in. Take a listen.
in the next few years will be a guardian angel. He'll be a coach, he'll be a companion to all of us. He'll have a lot of intelligence, he'll have a lot of empathy, he'll have a lot of agency. I think he'll make all of us a lot more efficient and effective at what we do.
Empathy. So how smart is that? Because if you're getting into a very exciting theme already. Empathy.
I think technology, for the sake of technology, of course matters, but what matters is how technology feels, right? And I think where these agents and where this AI is headed is a lot more personality, a lot more context on who you are. And I genuinely believe in the next 5 years, it'll be Puneet plus Puneet's AI. So if somebody hires me, if I'm on LinkedIn as an example, I'll say it's Puneet plus Puneet's AI. It'll be you plus your AI.
All right.
And I think that's the world we're getting into.
Ronnie, 5 years from now.
I mean, if intelligence meets artificial intelligence, it has to be a 2 plus 2 is equal to 22. And I think that's what it will be, because it's going to be a combination of both. And I think for all of us, we need to take it that it's going to be in that manner, rather than actually looking at it as going to be a threat. I think today everyone's looking at it much more from a threatening perspective. And again, as my favorite saying goes, overall we need to take this on as more as an evolution, more than an sort of an apocalyptic event where we'll always keep dreading it. And if you differentiate between the two, I think it's going to evolve. I think 5-year statements today will be almost impossible. We'll need to be better than astrologers to actually talk about where that takes it.
Gyanesh Kumar has been appointed as the next Chief Election Commissioner. He is the first CEC to be appointed under the new law with regards to the appointment of members of the Election Commission. His term will run until January 26, 2029. My colleague Sunil Prabhu joins us with more details on his appointment and the process involved.
Well, as you rightly pointed out, Mr. Gyanesh Kumar has taken over, and the first thing that he said is that the voter who turns 18 and enrolling them and making them vote is uppermost in their mind. The Election Commission will always be uppermost the interest of the voters, something that it is constitutionally mandated to do so. The Supreme Court will also hear a matter regarding his appointment, which has now been postponed to the 19th of March. And it's something that the Supreme Court will look at the constitutional validity after Parliament passed a law amending what was a unanimous judgment of the Supreme Court wanting an independent selection body which had the Chief Justice of India. That was removed and replaced by a cabinet minister. That is now going to be legally discussed, and ultimately today the Supreme Court said we'll hear it on the 19th of March. But nevertheless, in the days ahead, the Election Commission has its task cut out because it's going to be under great amount of scrutiny among stakeholders about holding a free and fair election.
Right. Moving on, the Adani Foundation has prepared a new framework for empowerment of women in the country. It's called the Supporting Her Exponential Empowerment, that is SHE. It outlines a holistic framework for empowerment of women across all stages of her life, from infancy to the adult stage. NDTV's Himanshu Shekhar spoke to the CEO of Adani Foundation, Abhishek Lakhtakia, on the SHE framework. Listen in.
So Adani Foundation has a legacy of 28 years of empowerment, and we have been working at various life stages for very long. Now what we have done is we have compiled the women empowerment journey through a life cycle approach, and through that we have created a framework SHE, which says that if you work through a butterfly effect and touch each life stage with a critical intervention, you will see an exponential empowerment in the women's journey. So for that, you have to look at infancy stage, a child stage, a youth stage, an elderly stage. You have to do health intervention, education intervention, livelihood interventions, but those which are critical to that particular age group. So not just one particular age group or one particular intervention, but the holistic life stage approach with multi-sectoral approach, you empower a woman. So this is what have been now consolidated under framework SHE, which we call it Supporting Her Exponential Empowerment.
Well, that's all the time we had on this edition of Profit 360, but do stay tuned to NDTV Profit for more news and updates.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
This entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Well, welcome to 2025, the big idea, and we have the top team of Citi in our studios to try and understand how is it that they think about the year ahead. We used to do a quarterly conversation with them about how results have gone by, but at the start of the year, it's pertinent to talk about how does the Citi Think Tank think about 2025 as a year. With me, Surendra Goyal, Head of India Research at Citi, Kunal Shah, Director of Indian Banks and Financials at Citi, Arvind Sharma, Director of India Autos and Transportation, and Rashi Chopra, Director, India Metals and Cement. All of you, thank you so much for taking the time out. Absolute delight to have you. And I think it's just pertinent to talk about 2025 because if people were cribbing about how Indian markets are not giving the opportunity, maybe, just maybe, this dip gives the opportunity. Surendra, let me start with you. And on hindsight, while you may not have changed your targets, etc., but suddenly a target of 26,000 makes you sound bullish related to what's happening in the markets and others. Tell us about how do you think about 2025 as a year for Indian markets?
Sure. Thanks for having us on the show. And just to give some context to the target, when towards the end of last year, the market was at more than 25,000, our target was still 25,000. So we rolled it forward and now it's 26,000. So we are more constructive on the market compared to say 3 months and 6 months back, and it's a combination of 2-3 reasons which are kind of playing out together for being more constructive. Firstly, if you look at the growth slowdown that we have had, say over the last 6 to 9 months, firstly public capex was slow, government capex was slow for a bit. So that in December saw a good recovery and should improve going forward. Secondly, the budget did provide the tax cuts and interest rate also. We have seen cuts and we are expecting more cuts as we go forward. So I think a lot of those things should help growth as we go forward from here. And which is why at a overall earnings growth trajectory, Nifty earnings growth trajectory, we are expecting the low to mid single digit growth this year to improve to low double digit growth in the coming year. So that is the first argument. Secondly, valuations. There has been a fair bit of a pullback. Nifty had gone to even 22 times 1 year forward. Now we are below 19 times 1 year forward. So I think, and that's like the 5-year average, 19 times. So in that context, it is a lot more reasonable level. And the third thing I would say that large caps, there are enough stocks where valuations are now becoming more reasonable. So compared to our view, say some time back, we are more constructive, and that is what is reflected in the 12-13% upside that we have on the market from current levels. Having said that, I would also add a point that there is still a fair bit of uncertainty on the global side, right? There are so many announcements or comments on tariffs, right? And I think you need some kind of clarity to come on that point. That will give the market comfort, because what has happened between November and now is a stronger dollar has resulted in EM outflows, and then even within that, India was a more expensive market with a bit of a cyclical growth slowdown. So everything, that is what has impacted Indian markets. And now going forward, it looks a better kind of a situation compared to say 3 months or 6 months back.
Interesting. if 2023 and 24 were years of US exceptionalism, it doesn't seem that 2025 will be any different, even if it's concentrated for now. But my question is largely this, Surendra. When a global money manager sitting out of Chicago or New York is getting 4.5 fixed, plus currency, plus the equity risk premium missing, why would that investor want to come to an emerging market or India? And if the FI flow is not coming back, I mean, if US interest rates were to rise, who knows, then that makes the case even worse, if you will. So if the FI investor is not coming back, can Indian markets on the back of the domestic flows still give a reasonable return, or is it a difficult argument?
Yeah, so a couple of points there, Neeraj. So this discussion always comes in when we have a correction. And despite that, the Indian market in the longer term has continued to compound fairly well. And these questions typically come in when there is a lot of pessimism.
Okay.
Right? Finally, what do investors come to India for? You have a GDP growth which we expect to be, say, close to 6.5% going forward, which is the best, one of the best in the world, at least among the major markets, right? And Indian companies are generally good at converting that to earnings growth. If you look at the 10-year growth CAGR of, say, Nifty or any broad-based index, it will be like anywhere between 11 to 13%. So that is what people come in for. There will be situations, short-term events where the currency depreciates a lot, so it becomes more difficult. Flows, and we have seen foreign flows, they have been volatile. If you look at the last 4 years data, there have been months of significant outflows, couple of months, and then you see stability and then money comes in again. So I think that would be kind of taking it too far, because we have seen this play out so many times. If the underlying growth improves, okay, and things stabilize a little bit on the global front, I think that's a clear situation for money to come back in India, even on the foreign side.
Cross fingers.
And last point, I think you started by saying US. So I think even in the US, it's been one theme which has been dominating. It's not a very broad-based market performance, right?
That's true.
And even there, I think with what happened with DeepSeek and so on, we'll really need to see how that plays out. I don't think it's a given that everything continues to play out the way it's played out in the last couple of years.
By the way, at some point of time in the show, we'll talk about that, because I think the word for 2025 got set in January itself, DeepSeek. I think that's probably the biggest telling point. But okay, if FIs were to come back, one of the larger sectors that they might want to come back is BFSI, because for the longest time, very well valued, aayega paisa, it hasn't come thus far. But we're seeing signs of that, right? Signs of there being some demand at the tape, wherein companies have delivered numbers. I mean, Bajaj Finance, a case in point, some others. How constructive are you relative to how you have been over the last 2 or 3 quarters on BFSI at large?
So overall on growth side, definitely when we look at it, as Surendra was highlighting, with respect to the tax cuts that will help in terms of the consumption and the retail finance demand. Even if there is some uptick on the capex, the overall corporate credit, which has been in say somewhere high single digit, we could see some uptick out there. And in initiatives which were taken by RBI to manage the unsecured portfolio, we have already seen steep moderation out there. It seems like largely that base is set, and on that we will see relatively better growth on the unsecured side going forward. So all this can actually lead to a percentage point or 2 higher credit growth than where we are today. And many of the players, and that's where maybe we turned positive on Bajaj, we turned positive on Kotak as well, because we clearly saw the visibility in terms of growth, wherein they would outperform the industry average by a significant number. So Bajaj, we are still confident, like easily 25% plus is something which will continue for next 3 years. Kotak also, we are pretty confident that they can give like more than 15% growth. And last quarter also their growth was amongst the highest in the private banks. So these 2 stocks in particular from the growth perspective.
Okay, but large banks at large, or large financials at large, Kunal, you would reckon that they are in a safe space right now from a valuation perspective? Would that be a fair assessment?
Yeah, so when we look at it in terms of the historical valuation, last 5 years average, we are trading at almost 20% discount to that. Okay, and when we look at it in terms of the asset quality noise which was there, now it's almost factored into the estimates as well for FY26, FY27. If growth picks up, now the only thing that needs to be watched out is margin behavior amidst the rate cut. But if it's a shallow rate cut, it should not have that much of an impact, and everyone has displayed operating efficiency. So when you look at it in terms of the ROA, that is something which has surprised quite positively, despite maybe the noise around asset quality, growth and all. Large banks have been able to manage the ROA profile. But still valuations are like almost 20% down from 5 years average. So to that extent, there is definitely the room.
Okay, and just one follow-up on the banking space, the pecking order. You mentioned Kotak, of course, that seems to be number one on your list.
And ICICI and HDFC are the other one, so we stick to that.
You stick into the large ones. Okay, I'll come back on some of the other aspects as well. But Rashi, let me get you in. I mean, and again, I'm not completely sure of the valuations, but if we can talk about banking as being below 5-year averages, maybe some of the cement names, and let's start with that because I'll get to tariffs in a moment with both you and Arvind. But cement maybe, again, a sector which virtually has gone nowhere, right? Now, if government capex has picked up and at some point of time if private capex were to come back, is cement in a sweet spot or are you negative?
Cement is in a sweet spot, but I think it'll have to be a little bit of a selective sweet spot in the sense that, of course, we've had a low base here. The first 9 months demand hasn't really gone anywhere. But now, like we're hearing, December demand was better than November, January's been better than December, and things are clearly picking up. So in that sense, I think the growth trajectory becomes like a clear-cut one, and we're not even exposed to like global sort of, it's not exported or anything like that. It's all domestic demand in a way. Second thing is that we need to play the stocks which are essentially kind of levered or, prepared to play for this growth with the cost efficiencies kind of playing out. Because despite demand moving up, the general thought process, or at least our view, is that pricing may not necessarily move up significantly. And that's because a lot of the capacity is again being added by the larger players, so that fight for market share still remains. So we need to kind of focus on the growth plays with, the cost benefits. So I think the players which are like the strong ones will continue to remain, like the valuations have come off a little bit, but not significantly. But there's a reason why they're kind of holding up. And they become a safe place to kind of be in. So stocks like Ultratech, for example, trades at about $180 a ton today. But I'd still say that would be our top pick because you're getting growth there, you're getting cost, and you're continuing to see the benefits of consolidation, and the acquisitions that they're making.
Got it. A follow-up there. Would market cap by capacity or EV per ton be the preferred way in which you gauge companies currently? Part one of my question is that because capacities are coming up, if you will, and therefore for a lot of companies they might look cheaper than what they were 5 years ago. And just question to roll into that. A lot of people are preferring some specific regional plays. I mean, investors tell me, for example, that they are bullish on the Andhra focused companies because of the Amravati setup, etc. and stuff like that. Are you kind of constructive with themes like that?
Sure. So firstly, on the EV per ton valuation, I think it just becomes like an easy benchmark to kind of look at. We know replacement cost, again, depending on the dollar value, is probably somewhere around $90, $95 today as we speak. And like I said, Ultratech trades at 180, right? So how does one kind of say that, one should still buy it? But in the context of the fact that they're continuing to grow, the market is obviously giving them that value. Then we have stocks like, ACC, where we also have a buy, but they trade at like $80. Dalmia trades at $80. And it's very clear, visibly so, that there's not a lot of growth visibility coming out of here. So the market is willing to give them a price around replacement cost, right? So it just becomes like an easy metric to kind of work with. Of course, we work with EV, EBITDA on our valuations when we value the company. But then again, it's, 5-year averages, 10-year averages, what is the context of the market? But growth becomes the key parameter over here. Secondly, on the south, obviously there's a lot of expectation around growth. A lot of the M&A activity that you've seen has happened with the south-based companies. They've been the acquisition targets. Having said that, pricing has been most volatile in the south and the eastern markets. So again, I won't be very nitpicking on these southern players just because they're in the south. They have to kind of come with the other criteria to make them work.
Okay. And then to tariffs, and question to both of you specifically on your themes. But Surendra, can I just briefly, before I get to Arvind, because I have a bunch of questions for him. But tariffs by and large, I mean, everybody's talking about how the next couple of quarters, forget fundamentals, forget valuations, focus on where Trump is going, where the tariffs are coming, and that will be the key point. Now, he said April 2nd, key reciprocal tariffs coming in. How big a negative for a clutch of sectors, including pharmaceuticals or some of the others, including the pockets that Rashi and Arvind track as well, how big an impact could that be?
Sure. So I think the first thing I would say is there are still a lot of unknowns and uncertainties around that. So like whatever I say is kind of making certain assumptions. Everything could change, right? Like it could change tomorrow, for example, right? But the point I'm trying to make here is, like, if you look at some of the sectors which are more commonly talked about, you will also have to keep in mind angles like, say, let's take an example of pharma, right? Generic pharma, a lot of the supply in the US is from India, right? So how does it really impact the cost there? Because these companies don't make very high margins. So at some point they have to pass it on to the channel and eventually to the consumer. So then how does it really work? Because it will lead to healthcare inflation. So that's the other thing to keep in mind. Like, let's take chemicals. I think there it also becomes important to keep in mind which are the other countries which manufacture chemicals and supply to the US, and how does it change the relative competitive positioning between those countries, right? So I think there are just too many unknowns at this point of time to be making a very informed decision. And then some of the other sectors where there is a tariff differential, like agri products or say jewelry, not a lot of the major listed players have an exposure there, at least to the US. So firstly, I would say India still looks relatively better placed versus a lot of other countries as far as the tariff is concerned. But there are uncertainties, and that is what I think the market is clearly pricing in, and that is why there is a lot of nervousness, and depending on the comments that come out, stocks and sectors do move.
Okay. Well,
and then finally, like, of course, like again, one of the things we'll also have to see is this more for negotiations? So what happens? That's the other angle. There is a talk of a bilateral trade agreement by, say, fall of this year. So I think a lot of those things are very unknown right now. So having a very clear picture, I don't think we'll get it at least in the next month or two.
Got it. Yeah. If Mexico and Canada are anything to go by, some of it is negotiating tactics as well. One certainly hopes that stays that way. But it puts autos firmly in the thick of things, not tariffs per se, or not just tariffs, but everything that's happening around what India could do vis-a-vis global majors setting up shop, etc. in India. Let me start with the bigger macro picture first. Then I would also love to understand from you how you thought of earnings gone by. But how big a problem could it be for Indian automakers, particularly car companies, if large global majors set up shop in India? It's not that it's not happened in the past.
Sure. If you see till now, I'm talking about say January or December, EVs in India from the Indian companies were aimed more towards people looking at value, total cost of ownership. But in the Auto Expo and over the last couple of months, we've seen companies launching more high-end models. We are targeting people who are, who want more premium cars, better features, connectivity and the likes. And therefore, they're at a higher price point also. So if we have global companies setting up shops in India, obviously their cars would be priced at a slightly higher point, right? So they are also targeting the same clientele that some of these recent models are targeting. So naturally competition is going to heat up. Again, manufacturing in India, how much localization do these companies do versus say companies in India who already have a very strong vendor network. It's not just batteries and motors, obviously they are high cost items, but apart from that, the vendor network that these legacy companies in India have, the footprint, the sales footprint that these companies have gives them an edge. But again, you're talking about customers, if they are looking at more premium end electric vehicles, naturally the competition heats up, puts a pressure on pricing and therefore margins. Again, PLI is something that some of these Indian companies have. So PLI helps them become more competitive, 10, 12%, whatever they get from the government. So the government has taken these steps in the past to protect the interest of Indian companies. Nevertheless, and it's again a situation which is still evolving. If you have global companies coming in India, setting up shop, maybe take a bit of a hit on the pricing, but try to gain market share, it is going to heat up the competition quite a lot.
Okay, so we were wondering about why is it that despite selling 30,000 EV vehicles on the day of the launch, M&M got beaten down in one day straight, so on and so forth, right? We were talking to Anish Shah yesterday at the conclave. He was fairly confident of not just them, but every Indian company beating up or standing up to competition. What is already captured in the price for some of the four-wheeler auto companies when it comes to this? And what did you make of the results? Because, Maruti's numbers, December, Jan look rock solid. M&M's December quarter numbers look very good. What have you made of the four-wheeler numbers and the commentary?
Sure. So, in our top picks, we have both Maruti, Mahindra and Hyundai. So, we are clearly very constructive on the four-wheeler space. And I think numbers have been better over the last couple of months. Even in sub-segments, even like hatchbacks and cars, which were weak for probably last 3 or 4 years, we've seen some sort of a stability, if not a revival. So to that extent, yes, things are reviving. Of course, there's a large base, so our YOY growth number might seem a little underwhelming at low to mid single digit, but clearly we have seen a revival in the numbers, especially in passenger vehicles. But again, all these three companies, Maruti, Mahindra and Hyundai, they have launched their born electric vehicles just last couple of months. So naturally, they are playing into a space which till now was not well discovered in India. Models we've had till now were more ICE models or ICE platforms converted to EVs.
Right.
Apart from some of the again global companies which had a few models, but most of these companies, the Indian majors, had ICE model converted to EVs. You talked about Mahindra and the launch. It's probably for the first time we are having a born electric vehicle coming into the market. Yeah. And perhaps the benchmark is set up by the previous models where you had 50, 60,000, 100,000 numbers in the first hour of booking. I guess that benchmark will have to be recalibrated. We're talking about a different price point, a different customer segment, and not only a product, but even a segment which has not been tried by customers, right? So it will take some time to play out. So, let's see how the actual volumes pan out. It's still 5,000 a month, the capacity, so they are 30,000 in a way. Theoretically, 6 months of bookings have been done. Let's see how it plays out once the car is on the road. What's the feedback? What's the word of mouth publicity? I think those things will play out.
Maybe just to add to that, your question was more on Indian companies kind of holding up to competition. See, I think from a market perspective, the market always cares about increased fragmentation in any industry. Indian companies may hold up, right? Just look at the example of what's played out in paints. The incumbent might still end up 2 years, 3 years later being like the strongest player in the market, but the market in the market business, but the stock market still cares about increasing competition and increasing fragmentation, and that does impact stocks at least in the short term. So I think